We'll have the market thinking all the more certainly that the ECB is going to keep on cutting, weighing down on the euro, while at the same time some comments that we heard out of the BOJs who waited today maybe suggested that a December hike is still in the cards, and so that had the market a little bit more hawkish or bullish on the yen. So you have lower euro, lots of pressure there, stronger yen as well. That seems to be the market's favourite trade.
Paul, great stuff. Thank you very much indeed. Paul Dobson, Bloomberg Executive Editor, Asian Markets, joining us on what we've got going into the European Open in terms of the setup, kind of the macro setup. Let's go from the macro to the micro. Joe, what do you got?
Morning, guys. So Novartis is upgrading its sales guidance today, citing a swathe of launches across a number of illnesses, including in oncology and also cardiovascular. They're speaking at their capital markets and Investor Day, and they do say that a lot of their new drugs will get exclusivity within the next 5 or 6 years, and therefore that will drive their sales higher by around a full percentage point, according to their statement. Now, in terms of that stock, it has continued its steady run over the past couple of years, but it was actually part of that drop that we saw last week as we got news of Robert F. Kennedy Jr. coming in potentially at the US Health Department. So maybe expectations were slightly lowered ahead of this update, could potentially boost that stock even further today. Then going the other way, in retail, we've got JD Sports looking pretty negative once again in terms of their guidance. They're saying that they've seen a decline in consumer sentiment since October in their latest trading update. They say they've seen much softer consumer demand toward the end of the period, reflecting promotional activity, unseasonable weather, and a cautious consumer more generally. Now, JD has issued a couple of profit warnings over the past few years. We can see that stock selling off a bit, particularly around a year ago, where they had a big warning, though a lot of that was related to their US business, where they now get around half of their sales, with companies like Nike being the main suppliers for them there. But this does in general look like another downbeat one in terms of the retail stocks today. Then in ice cream, we've got the Ben & Jerry's maker Unilever on our radar. The Financial Times reporting that they are moving away from selling the ice cream business, potentially going to look to spin it off instead. So maybe there will be a separate listing for this business rather than an outright sale to private equity, which had been speculated over the past few months. It's actually been around a year since we got news of a potential private equity bid for that. As we can see, 4 sales on that stock now, pretty high for a steady consumer staples stock for Unilever, but potentially, given that there might be a separate spin-off, it might take the edge off that disappointment around the sale. A couple of ratings. Ryan Mattel has a new buy over at Deutsche Bank, pretty topical given the headlines we've seen around Ukraine today. Logitech comes up to neutral over at UBS, and Imperial Brands in tobacco has a new price target increase at Morgan Stanley.
Joe, great stuff. Thank you very much indeed, Joe Easton, running us through some of the stock stories that we need to watch out for. We're also keeping a firm eye on what is happening with the car sector this morning. Disappointing data out of Europe in terms of the numbers that we've seen. Yes, we're getting a bounce back, but not by much. We've also got this Ford story, which we need to focus on in the next hour. And the latest news is that VW's Labour side, i.e. the Labour side of the current conversation, is seeking clarity on restructuring before Christmas. This story beginning to accelerate. Futures actually up this morning. The Open is next. This is Bloomberg.
Was going to keep bringing the World Cup. This is a 3
as the economic picture
covering the intersections of Hollywood, Silicon Valley, and beyond.
Asia is at the forefront of some of the world's biggest stories. I'm Sherrian in Tokyo.
And I'm Heidi Stroud-Watts here in Sydney, where the trading day begins. We're here in the centre of all the action to get you set up with the numbers, news and knowledge you need for the day ahead.
The demand is
did. Recovering. We've been waiting for this moment.
The opportunity of a century.
Join us on Bloomberg The Asia Trade. Weekdays only on Bloomberg TV. Context changes everything.
Bloomberg Surveillance covers the latest in global markets and the political events that influence your world. Join Jonathan Farrell, Lisa Abramowitz, and Anne-Marie Hordern only on Bloomberg. Context changes everything. From our studios in New York and San Francisco, our expert hosts have the data and analysis about the companies you know and the startups to watch, plus the interviews you don't want to miss. Watch Caroline Hyde and Ed Ludlow on Bloomberg Technology, the only daily business show dedicated to tech, right in the middle of the trading action, every weekday, only on Bloomberg Television. Context changes everything. U.S. jobs numbers are released. Bloomberg has the report under surveillance with crucial data and expert analysis at terminal speed. Nobody covers jobs day like Bloomberg. The countdown is on. Everything you need to get the edge at the end of the market day.
Big tech earnings kick off later this afternoon.
Gilead is coming out right now.
We have take two numbers. Back to the markets, right? Our bread and butter.
NVIDIA is one of the best stories in the tech space.
That actually matters a whole lot more.
It might shock some of your viewers.
You're watching The Close.
Get ahead of tomorrow's trading with The Close. Weekdays on Bloomberg. Context changes everything.
Thursday morning, good morning. So let's talk about the legacy out of the States. Think about how we're pricing in NVIDIA and think about how Europe is going to open this morning. So Europe faded into the close yesterday. That's the white line. The US then picked up into the close. You've got that dispersion, that gap that you need to price this morning. After hours, though, we get NVIDIA. NVIDIA drops, but it's not having that big an effect on the indexes. So it'll be interesting to see ultimately kind of how we trade this morning, because you've got to factor that in. The Nasdaq's down a touch, but not by much. You've also got some geopolitics to fold into the equation as well. So basically what you've got this morning, I think it is basically a net cancelling each other out. And I think that's what you're seeing in Eurostoxx futures, which aren't moving. The FTSE's up a little bit, but not by much. The CAC 40 is absolutely flat this morning. So at an index level, I think all the factors we put into the funnel probably net don't actually deliver much for Europe this morning, Anna.
Yes, it's a complicated picture, isn't it? Because as you say, there's a bit of catch-up trade to do on where the US closed yesterday, but then a lot of moving parts since then. So the futures picture, as you pointed to, does look modestly positive. What will feature at the stock individual level? Well, some of these names could be in focus. Novartis is certainly one that we're going to be watching. This as the business lifts its sales guidance, citing upbeat expectations on new medicines. Jefferies saying that these goals imply significant upside potential to consensus. So we watch that one. Unilever in focus. This on a report just late last night from the FT that perhaps the business is not going to seek PE buyers for the ice cream unit. Perhaps instead it decides to spin it off, to list it in some way or do something else with it rather than sell it to PE. Apparently some of the issues around Ben & Jerry's part of the story there. Volkswagen also in focus. We've heard from the union today and we know those talks, Guy, continue between the union and the business.
There's a lot to fold in. There is a lot to fold in this Thursday morning. But net doesn't do very much to the markets. And I think that's the trade at the moment. That's what you've got to watch out for. None of these things are big enough, even NVIDIA, to basically disturb these markets. So what you're going to see this morning, I think, is basically a flatline trade. You're going to kind of see the FTSE 100 opening up a little bit, which you've already got. You're going to see most of the other major markets opening up a little bit as well. The Stock 600 is flat as a pancake. I appreciate that is a little bit of red that you're seeing on your screen at the moment, but really not by very much, less than 1/10 of 1%. The IBEX is up by less than 1/10 of 1%. Nothing seems to upset the apple cart, and that is the kind of maybe the bigger takeaway from all of this. Even NVIDIA and its numbers, which ostensibly were really very good, hasn't really done much to change the narrative, the overall narrative. And I think that's what you're seeing basically being reflected in European indices, at least, at the get-go of trade this morning.
Yeah, I think when we started preparing this programme a few hours ago, Guy, it did seem as if markets might go a little higher than they are right now. And that's because we had that positive handoff, that rally in the States late in the session there that we maybe needed to factor in. And that was to do with unwinding some of the tensions, geopolitical tensions that had been priced into the markets earlier on in the day after we saw the news around use of UK missiles into Russia. Well, then we get this reminder this morning that the market is still jittery about that. So perhaps the market's then less keen to sort of unwind that geopolitical tension than they might otherwise have been. Add into the mix the NVIDIA factor, which, as ever, is so difficult to get a nice, easy, simple read across into European markets from. So we have NVIDIA going negative at the end of, after hours, Guy, but a lot of that due to exceptional expectation. And there weren't necessarily negative lines more broadly around the chip space or around AI for the market to cling to. So net, as you suggest, we go nowhere in a hurry. And the sector picture, I mean, it's half and half, really.
Absolutely. So at the moment, you've got 285 stocks up in the stock 600 and 273 down. So, as you say, we're basically even Stevens in terms of what we're seeing on the breadth of the market. What you are seeing, I can't see any discernible NVIDIA effect into the stock selection story either this morning. So Novo is the biggest points dropper. National Grid's down a little bit. LVMH is adding a little bit on the downside. In fact, luxury and healthcare stocks seem to be the two areas that we are seeing weakness most pronounced this morning. SAP is the biggest gainer, so maybe there is that cloud technology kind of read across, but feels a little marginal.
It does. And if you're looking, look at the sectors where they are. I mean, technology is hardly moving. It's up. The sector as a whole is up by 0.1%. So it's really not moving much. To your point, consumer products and services, that's where the market's attention seems to be to the downside. And that sector is down by 0.6%. Kering, Puma, Richemont, they seem to be the names that are moving there. And on the insurance side, this is the biggest gaining sector. Actually, we have insurance moving higher, but some of that's to do with Zurich Insurance. In fact, that one up by just over 2%. So we'll keep an eye on that sector. Let's get back to technology, though, because this has been the big story overnight. Whether the markets choose to move whole scale on it or not, the NVIDIA number certainly captivating the market's attention. Let's hear, shall we, from Dan Ives of Wedbush, who weighed in on NVIDIA's results.
I think you print this press release off and you can put it in the Louvre, just frame it. Oh. Because look, I mean, what you're really seeing here, this is a stock that's going to be green tomorrow. I mean, what they're putting up in terms of Hopper, in terms of overall growth, it's exactly what the bulls want. And he'll continue to underpromise. I mean, next quarter, that could be a 4 in front of it in terms of ultimately revenue. This is just the beginning of the AI revolution, $4 trillion on its way.
Let's bring in Robert Lee from Bloomberg Intelligence with his thoughts on what we heard. The results, some of them, some of the numbers look to be pretty strong, but if you were looking at the top end of expectation for the current quarter, that seemed to be where the areas of weakness were. Robert, if that's not to overstate it, the market certainly sold off on something.
No, I think that's exactly right. There was nothing of any great fundamental consequence either way. There were strong results, but the story is very well known. The stock's been flirting with all-time highs over the last couple of weeks. Arguably it's priced in. I say arguably it's priced in. The stock, has experienced a bit of profit-taking after the market. And as you mentioned, just on the margin, the guidance for the coming quarter didn't quite meet the most bullish of expectations. So again, it's inevitable, isn't it? Go back to your ABC book of stockbroking, you're going to get a bit of profit-taking.
Yeah, that seems all logical. I think it's hard to read anything more into it than maybe that. We'll wait and see how the market digests this over the next couple of days. The positives are understood. We understand this narrative. We're getting comfortable with the idea. Maybe we don't fully appreciate the extent of it yet. But there are things that do stand out, and one of which is that the hyperscalers are becoming increasingly important, not less important. Is there an alternative narrative around how this story develops from here?
Okay, so it depends whether you mean on the bullish side or the negative side. But I think, just to flag some of the risks, and I don't want to take anything away from what is ostensibly a positive outlook for the company. But I think, the easy wins are behind them at this point. So obviously we've got a lot of execution risk on the Blackwell chip. That's a highly complex and large chip. So it is sampling. They've got over the initial niggles they experienced a couple of quarters ago. But, ramping that up to volume production over the next 2-3 quarters is a challenging task. So I'm not suggesting they're going to miss the milestones, but there is residual execution risk. Second thing is, as you said, they're highly reliant on hyperscalers and a very limited number of them. It's a very concentrated customer base. So in the long run, they need to diversify away from that, maybe customers on the sovereign side and within other sectors. I think it's all about execution. We've seen what's driven the story really over the last 18 months has been both revenue beats and also margin beats, but there is growing evidence that the margin has sort of topped out. So it's all about the volume and all about the top line at the moment. And I think the biggest risk that they face, or the AI faces across the board, a point I've made many times in the past, is monetization. It's fear of missing out that's driving the capex spending plans of the hyperscalers, but I would argue that they're not monetizing anywhere near fast enough at the moment. So that is the main area that investors need to be focused on over the next year to 18 months. If they don't monetize, then potentially, worst case scenario, a day of reckoning is coming. You know, when all these tens of billions have been spent a quarter on capex, if they're not monetizing that, then there is potential scope on the more distant horizon for a bit of a, as I said, a bit of a reckoning and a pullback. But we're not there yet. It's just something to bear in mind. Everything has risks. Risk reward, as they say.
So, yeah, indeed. So those are the risks, nicely spelled out, Robert. Let me ask you then, where are we in the AI cycle? How far through it are we? We had a nice illustration of this. Dan Ives likes to talk about this as a party. The AI party, he says, if it runs till 4 in the morning, we're still only at 9:30. Where do you think we are in the AI cycle?
Well, we're definitely in the early days of this, and I think people need to understand there is more to AI than generative AI. It's generative AI, ChatGPT, that have made the headlines, but AI can be applied in various different ways across a range of sectors. So in terms of that, you know, this is a multi-year or arguably multi-decade sort of trend. But again, I think it comes back to monetization. You cannot continuously spend 10, 12, $13 billion on capex per quarter if there's no real prospect of monetizing that. And even if they were monetizing it at a similar rate, what sort of margin are they generating? Because as we know, these models are very, very energy intensive. So what we don't know at the moment is what is the sustainable margin that these companies can generate in the long run. So I think, you know, it's early days. It's still a growth sector, but there is still a lot of uncertainty as to where things will go in the long run and how companies will ultimately monetize and profit from their developments.
In terms of the valuation, though, what we're seeing at the moment justifies the valuation, right? That is okay. That valuation stacks up.
While the momentum is with them, while sentiment is with them, again, well, that's what the market is telling you at the moment. But I think ultimately, like everything, whether it is a, you know, I think most people would describe this as still as a hype cycle. And we've seen this many, many times across the technology sector, whether it was metaverse, crypto, or something else. So, but as I said, at some point, these companies need to start monetizing. There needs to be a payback. So I don't think there is firm enough evidence of that at the moment. And I think that's really what is going to drive the valuations and the stock movements in the sector over the next 12 to 18 months. And I would say there are a range of possibilities that could come through with considerable risk there if they don't monetize as fast as some people out there are expecting.
Maybe the police show up at the party at some point and it all gets shut down. Punch bowl gets taken away. Robert, thank you very much indeed. Robert Lee from Bloomberg Intelligence, greatly appreciated. Let's talk about where we are with the Core 6 this morning. This is what it looks like. Europe kind of struggling for a sense of direction, but as you can see, largely the Core 6 is lower. But look at the numbers. They're not down. It's not down by much. Actually, where you are seeing some weakness this morning is in the drug sector and in the luxury sector. Elsewhere, I think you're seeing some weakness in technology, but these aren't huge moves that we're getting. As you can see, Schneider going to unchanged, but ASML is down by 1.61%. Let's talk about some of the other individual moves we're watching. Joe Easton, over to you.
It's one place we are seeing a big move today is in sportswear. JD Sports falling around 10% at the moment. That's the biggest drop in 5 months for the UK listed company, and it is now trading at a 2-year low following that guidance upgrade. Remember, they did say in their update that they have seen some weakness in the consumer, also promotional activity as well, people cutting their prices, and therefore they've downgraded their guidance pretty significantly today, saying it will be towards the low end of their previous view. So that stock coming down 10%. We're seeing a bit of a feed through as well in some of the sportswear makers. Adidas slipping very slightly, down 0.6%, and Puma coming down almost 2%. I guess that is a bit of a read-through from those numbers from the retailer in terms of that outlook there. Then in terms of chips, all the focus is on NVIDIA, of course, but the big gainer in chips is a smaller company, Soitec. We have been speaking to the management in some of the shows earlier today, and they've upgraded their guidance. There was some worries around weakness coming through from the smartphone market in terms of some of of the companies that they supply to, but that doesn't seem to be the case, and therefore a gain of almost 10% for that one. As Guy mentioned a moment ago, we are seeing ASML slipping potentially. Nvidia disappointing very slightly. Remember, $35 billion in quarterly revenue really isn't that bad at all, so potentially it has just missed those high-end of expectations, but a bit of weakness in some of the semi stocks, apart from Soitec leading those gains today. Then in terms of Novartis, we did get that boost to their annual growth target, around 1 percentage point higher than they previously said. Oncology, also the cardiovascular drugs boosting the stock, coming up very slightly, around 0.3%. Today, we've got a number of other Swiss companies reporting as well in terms of a couple of capital markets days today. We've got Zurich out. They've upgraded some of their key insurance targets. The CEO there trying to do more bolt-on M&A to boost the outlook, and it does seem to be having a bit of an effect at the moment, gaining around 1.6% for Zurich today. Going the other way in Switzerland, though, we've got a bit of a share sale in Galderma. Now, this is a cosmetics company, an injectable skin cosmetics company, falling 3%, a massive share sale by investors last night. Remember, L'Oreal recently bought a big stake in this company, and there was speculation that L'Oreal would go and buy more of it, but they haven't done that, and that's why traders say this is disappointing for Galderma. It's a big company over in Switzerland, but coming down slightly today. Then finally, in those ratings changes, we mentioned Rheinmetall. Obviously, a lot of headlines around Ukraine over the past couple of days, and Deutsche Bank thinks that you should still be buying Rheinmetall, even though that stock has doubled over the past couple of years. They move it up to buy, and Rheinmetall once again gaining today, up 2% over in Frankfurt, as Deutsche Bank recommends buying the stock.
Joe, thank you very much. Joe Easton from our equities team. And given we are seeing a little bit of movement in Novartis, interesting to just underscore what we've heard there. Novartis upgrading its sales growth guidance for the period 2023 to 28 to plus 6%, driven by strong momentum in market growth drivers and upcoming launches. So just getting a little bit more detail on that one. Coming up, we'll turn to the auto sector. Car sales stall in Europe. We look at the latest data and what this means for the sector next. This is Bloomberg.
From the beating heart of global finance, economics and politics, and wherever newsmakers are moving markets, Bloomberg brings you conversations that allow for deep discussions and important insights. What do you think the future is for inflation? Is this a new normal? Are markets too optimistic? How do you worry about the things that are outside your control? How does the current fighting completely stop? I'm Francine Lacroix, and this is The Pulse, every weekday only on Bloomberg.
This real momentum from Wall Street.
We are basically deep in the European earnings season.
Take a look at how we're faring when it comes to Asian markets.
Jumpstart your trading day on Bloomberg Open Interest.
2 hours of single stock stories that are driving the opening bell action. We'll take you to Wall Street, Main Street, the C-suite, and beyond.
These are companies that are growing their market.
The great companies in the U.S. are the companies hitting the cutting edge. That's a different story.
Get the inside track on what's buzzing in markets.
With the players who are shaping the narrative.
If you have bad earnings reports, you're going to get punished.
They're not buying what the industry is selling. Join us on Bloomberg Open Interest. Every trading day, only on Bloomberg.
As we spend some time here on the broader presidential race.
Let's focus in on European politics.
Makes you wonder how politics might play out.
Well, Welcome to the world of decentralized finance.
Massive outperformance from Bitcoin.
Bloomberg's covering all things crypto, the people.
The tectonic shift emanating from Washington.
All we're looking for is clear rules and an ability to build in the United States.
Crypto shouldn't be partisan.
The transactions.
Really a record-breaking moment.
Crypto VC is back.
And the technology.
It's really the beginning of a global on-chain economy.
And if America doesn't embrace it, we're going to be left behind.
Bloomberg Crypto, only on Bloomberg. Get your fixed income fix. Watch Bloomberg Real Yield every Friday right here on Bloomberg. Context changes everything.
Monetary policy needs to adjust in order to achieve our dual mandate goals. And while the final destination is uncertain, I believe some additional policy easing is needed, as policy currently remains at least somewhat restrictive.
Boston Fed President Susan Collins, of course, they're talking about the fact that maybe there are further rate cuts coming through. The market is beginning to question that, particularly for 2025. We don't know what we're going to see at the back end of this year. There's so much noise in this market right now, so much uncertainty. We don't know so much, particularly when it comes to the United States and what policy ultimately is going to look like with the Trump administration. How do you filter that out? How do you figure out what to do next? Or is the default position just to kind of stick with it? Stick with what is working, keep the momentum trade going? Let's answer that question now with Willem Sells, Global CIO at HSBC Private Banking and Wealth Management, who joins us around the table. Is that the right trade? We just don't know so much right now. But there's momentum in this market. It continues to track higher, particularly with risk assets. Credit spreads get tighter. Equities continue to track sort of higher. Crypto's going to the moon. We're approaching 100. Is that the logical thing to do? Just stick with what's working and worry about what could change later on?
Well, stick with it, but also prepare and analyze, obviously. Stick with it for the reason that, we are going to continue to see rate cuts because, as it was just said, we are still in a restrictive territory in terms of Federal Reserve monetary policy, so they can continue to cut. We have resilient growth powered forward by the US and probably even going to accelerate. And then earnings, most importantly, are resilient. Analysts continue to underestimate that. Now, on top of that, obviously, so that's a good starting point. Now we're going to have that uncertainty around policy in the US and therefore also monetary policy. So particularly in the bond market, I think you need an active approach, but in the equity market, clearly an overweight.
Okay, Villa, good morning. So let me ask you about the earnings story. You say we often don't spend enough time maybe thinking about that as opposed to some of the other dynamics in the markets. And you say that clients are showing a lot of interest in some of the themes and where they come together. We've talked about NVIDIA a lot this morning. That clearly the poster child for the AI theme. But do you see a sweet spot then where you unite that with energy independence, with infrastructure, and that's the dream investment, is it? Does that look through any cyclical weakness?
Exactly. It's so clients also like to, especially given the uncertainty over the next 3 to 6 months, as that US policy starts to formulate itself, clients like to think about what are the longer term trends. So the thematic investing, you can do that, or you can look at how does this inform my sector choices. And so clearly AI is something that people are very interested in, that not just generative AI as the previous speaker said, but also AI more generally, because it leads to innovation in other sectors. So for example, robotics, for example, medical technology and innovation there. What it also leads to is a huge need for electricity and therefore investment in utilities, in infrastructure and so on. So if you look at capital goods investing this year, it's up around 6%, but it's driven really by technology and by utilities, so that electricity. So people like to take exposure through going directly in the chips, but also the first and the second derivative in the other sectors.
What's the bond yield that gets you out of your overweight in equities?
So probably you need to sustain and you need to be above 4.5%. I think that becomes relatively critical, and therefore you're not too far from where you currently are. But it probably needs to be a little bit sustained. Otherwise, in the 4.5, 4.75, you probably get more volatility and so on, but your earnings can still push you higher. Whilst, if you are at a 5% level, then it becomes really critical. The bond market, the reason why we still have a neutral allocation and not an underweight allocation to bonds is because we do think that, the market is now only only looking for 3 rate cuts until the middle of next year. You need to wait for that 3.5% until the end of 2026, which is quite far.
Yeah.
And then your real yields are attractive. Your term premium is attractive. So, we do think that you're starting to get to some resistance on the bond yield side.
And that's the monetary policy side of things. What about the fiscal sustainability side as we go into another US administration where some voices are concerned about what the direction of policy in terms of how sustainable it is fiscally, and then we don't know who the people around President-elect Trump will be and what messages he will be getting from them.
Yeah, clearly always a very, very big discussion point with private clients around debt loads around the world. It's, structurally over the last 10 years we've been talking about this. Again, some of this is compensated by that real yield and by that term premium already in the market. We're also obviously going to go to the debt ceiling, where you're going to have the first test as to whether there is resistance within the Republican Party by some Republican Party members at least, to even raise the debt level. And then, from there on, it's a second step to actually then have all of the fiscal expansion. So, probably there will be a limitation on this, but clearly this is an administration that is pro-growth and reflationary.
In terms of the gap between Europe and the United States, does it close at all next year?
Probably not. So we have that overweight in the US and the underweight in the Eurozone. We continue to stick, as you said, stick with what is working at this point in time. Clearly in terms of the news flow as well, we have Europe that is quite vulnerable to tariff headlines. We have low growth. We have the German election that is coming through. Over the last few days, we have the geopolitical risks and so on, where there's upside and downside for the Eurozone, obviously depending on the scenario. But less earnings growth as well. When you look at the sectors that are having the biggest earnings potential around the world, that is technology, healthcare, and industrials. And clearly from a... Yes, but not the technology side. Yeah.
Willem, thank you very much. Thanks for bringing us your thoughts this morning. Willem Sells, Global CIO at HSBC Private Banking and Wealth Management. Let's pivot to the car sector. A lot of news flow there in the past 24 hours. Car sales in Europe are stalling, with new car registrations increasing just 0.1% in October compared to a year ago. Let's get more on this and some of the other dynamics in the auto space. Bloomberg's Craig Trudell joins us this morning on set. Very good to see you then, Craig. So let's start with some of the data. What are the brighter notes then in the data coming through this morning when you're looking at this from Europe?
Yeah, I mean, actually, the headline numbers for electric vehicles, round numbers, plus 7% for October, not so bad. But when you kind of pan back and look at year to date, we're down 2% for electric vehicles. And then I think if you sort of go through the list, just powertrain-wise, I mean, plug-in hybrids have been down for the year. We're down in October. Same for petrol and diesel. The big bright spot actually is hybrid. So you had plus 16 for the month and plus 19 for the year. So it is kind of remarkable that, for all of the attention that we paid to electric vehicles, the hybrids that don't plug in, the Priuses of the world, are actually having this real renaissance.
So the car companies are going to talk about this. You want to fix the problem. You want us to get us to electrify. You want us to hit the targets that you want us to hit. You've got to invest massively in charging infrastructure, because that appears quite clearly. I appreciate the price is a factor, but clearly there is a range anxiety story in all of this. I can't go from A to B if A to B is in excess of 200 miles and be certain of it. The hybrid story just demonstrates that clearly. If Europe wants to get back on track, does it need to invest in its car companies, or does it need to invest in its grid?
I think you absolutely need more investment in charging infrastructure, and you have heard the manufacturers crying out for that. I would sort of counter some of that bellyaching on the part of the companies to say that these companies could play more of a role and themselves put up more of the money.
But they're struggling to sell the cars. They can't. Like, you look at Ford cutting jobs, Volkswagen, huge battle taking place in Volkswagen at the moment. They've got a fight on their hands to make this work anyway.
They've got to also make their electric vehicles, price-wise,
competitive with the Chinese,
more competitive with with the companies that are coming in. It is not to give them some benefit of the doubt here. It is not just a simple matter of making battery prices more affordable in Europe. This is going to take time. It took China years of heavy investment and sort of patient policy to subsidize this, and we've seen the sort of fruits of all of that effort. But what we also need, I think, as well is affordability. You still have to pay a huge premium for an electric vehicle over a hybrid, let alone a petrol or diesel car. And I do think it is the case that until and unless you don't have to pay so much of a premium, even if you have the infrastructure there, the consumer just can't afford it. It's not possible.
It's affordability, and just the fact that it's so difficult to charge in so many places just remains such a hurdle, as Ford's chairman, I think it was saying just yesterday. Craig, thank you very much. Bloomberg's Craig Trudell. Coming up, we will be speaking about FX. We will talk to Jane Foley, head of FX strategy at Rabobank. We've seen a bit of a flight into some havens this morning, limited as it is, including the yen, as a result of some of the geopolitical headlines. We'll return to that shortly. This is Bloomberg.
In case you missed it on Bloomberg Technology.
We are very focused on playing one game and one game only, and that is being free, frictionless entertainment for consumers. But what I will say is we are doubling down on the strategy. We believe it's working. We think the tailwind's in our favor, and it's on us to continue to deliver.
Whenever you're doing something innovative that hasn't been done before, there's a lot of trial and error and iteration. It just always has these zigs and zags along the way, and I think where we've been successful is really being reactive.
Hollywood is the history of technology. Like, we are here because of a technological breakthrough, right? And so we sometimes forget that art and technology kind of like come together always. And for us, it's like demystifying a little bit the technology. Again, if you understand AI as a tool for humans, then it changes the narrative. And it's less about fearing it and more about embracing it.
Don't miss Bloomberg Technology, live every weekday.
Asia is at the forefront of some of the world's biggest stories. I'm Sherrian in Tokyo.
And I'm Heidi Stroud-Watts here in Sydney, where the trading day begins. We're here in the center of all the action to get you set up with the numbers, news, and knowledge you need for the day ahead.
The demand is indeed recovering. We've been waiting for this moment.
The opportunity of a century.
Join us on Bloomberg The Asia Trade. Weekdays only on Bloomberg TV. Context changes everything.
From our studios in New York and San Francisco, our expert hosts have the data and analysis about the companies you know and the startups to watch, plus the interviews you don't want to miss. Watch Caroline Hyde and Ed Ludlow on Bloomberg Technology, the only daily business show dedicated to tech, right in the middle of the trading action, every weekday, only on Bloomberg Television. Context changes everything.
Good morning. This is Bloomberg Surveillance.
Welcome back to the opening trade.
This is Bloomberg Technology.
This is the Asia Trade.
You're watching the close.
Welcome to Balance of Power.
This is Bloomberg.
So Ukraine, let me just update you on this. Ukraine has said that Russia has launched an intercontinental ballistic missile, an ICBM, during an attack that has taken place on the country. Now, it appears, and we're also looking through the fog of war here to understand what is happening, that this is the first time that Russia has fired an ICBM in this conflict. Now, that would obviously significantly raise up the ante but it goes hand in hand with the fact that we're now using, or Ukraine is now using, Storm Shadow missiles, the ATACMS missile as well, that has been provided by the Americans. So this appears to be escalation. But there is the sort of fog of war factor that we're trying to work our way through this morning.
Yeah, absolutely. Let's get some thoughts on havens and moves into havens, shall we? Jane Foley joins us from Rabobank and on the FX side of things. Jane, good morning. Good morning. So we do see the yen a little bit up on this morning. We've been dealing with these headlines for the last sort of hour or so. We saw NASDAQ futures and E-minis drop a little on this earlier on, but they seem to have stabilised, actually. It feels as if the market has been having to deal with these kinds of headlines a few times this week, and perhaps we're becoming a little more accustomed to them. But what do you make of this move into the yen and the sort of significance of where the money goes, which havens it goes into?
Well, I mean, it's clear that the market really since Tuesday has been trying to work out what the response to this sort of news really should be. I mean, on Tuesday we were worried about the nuclear war. Many military commentators saying, well, look, we're taking the military war issue seriously, but perhaps that's not something that we should be worried about. Maybe we should be worried more about a hybrid warfare response from Russia. So there's a lot of confusion, I think, as to how worried should the markets be. And I think we're seeing this in some of the responses. Some of the response on Tuesday, for instance, sort of diluted really quite quickly. And I think we've seen that again during the course of the week. Now, in terms of the normal FX safe havens, well, we've got the dollar, we've got the yen, and we've got the Swiss franc. Now, that in itself is being muddled through with some fundamental changes. So, for instance, this morning, Bank of Japan Governor Ueda indicating that he was watching the FX market closely. Now, that, of course, triggers the expectation in some minds within the market that, well, look, if Ueda doesn't hike interest rates in December, at the Bank of Japan's December meeting, well, the yen's just going to, weaken on the back of dollar strength. So he has to hike interest rates. That, of course, is a debatable view. Not everybody has that view, but it's a view nonetheless. So you have this haven flow for the yen muddled up through with some fundamental factors, but nevertheless, I think we saw on Tuesday the Swiss franc, the yen, for a while, for a little while, were the best performing currencies. The dollar is also a
but it seems but the Swiss franc not reacting this morning.
That's
to that
right.
Point.
That's right. Now again,
also undermined by fundamentals.
I think that maybe some people are taking the view, well, look, if there is an escalation, then Europe is very close. So maybe the yen. Maybe the dollar, are better safe havens for this particular type of news, Russia-Ukraine type of news. The euro perhaps more vulnerable. I mean, it certainly highlights some of the shortfalls in Europe's defence spending over the last, couple of decades, perhaps. So from that point of view, maybe the yen or the dollar is a better way to perhaps express a safe haven view.
Ueda also saying this morning it's not possible to predict the outcome of the December meeting. It feels like a coin toss. The market's pricing this as a coin toss. How do I make a decent call on a yen if I don't know what the outcome of that meeting is? Can I make a decent call?
I mean, it was tough, clearly, but I think we know that we are getting perhaps closer to levels where there is maybe intervention risk as well. So that's out there in the mix as well. And if they don't hike interest rates in December, well, what are the chances that they go in January? I'd say fairly strong. Now, tonight, we have, or early hours of tomorrow, we have the next round of Japanese CPI data. And perhaps that's going to give us a little bit more information as to whether or not they can go. But Ueda spoke, earlier on in the week. Now, of course, he didn't tell us whether or not they're going to hike interest rates in December or not. But there is clear, cautious optimism, confidence coming through that this virtuous cycle that the Bank of Japan have been trying to, form for years is now in the making.
The market feels like it's trading headlines at the moment, a lot, and it feels very tactical. Is it possible to take a step back and make some strategic decisions on where big currencies are going to go in 2025?
I think maybe the market's done that, and it started to do that, perhaps at least in early October, and that was a Trump trade. You look at the strength of the dollar since then, and I think, many of those positions have been made, and that perhaps was the strategic view through next year. But now we've got a point where the market's long of the dollars, and we still don't know really exactly what Trump is going to do. We don't know how big those tariffs are going to be. We don't know what the secondary impact of tariffs is going to be on Asia and on Europe. So that there is now, I think, a point where the market's made that strategic call, and now it needs to wait for the details. And that's going to be quite interesting, given that we have all of this geopolitical news coming through too, which is another factor which, of course, could move the dollar.
If the market has made a strategic call then on the strength of the dollar, how weak does the euro get? What's the market's view? What's your view then, Jane, on where we go on the euro?
I think the euro is certainly on the back foot. Now, it very much depends, of course, on the ECB as well. We've already seen 2 consecutive interest rate cuts from the ECB, which is fairly unusual. We're likely to get a 3rd consecutive interest rate cut in December from the ECB, which is very unusual. How inflationary are the Trump trades? Well, we just don't know. It's extremely difficult to know that because we don't know the size of the tariffs, and therefore we don't know the tit-for-tat measures that we're likely to have. We don't know whether or not China's going to dump goods, that were bound for the US into Europe. We just don't know. Villeroy said, I think, in the last 24 hours that it won't have a huge impact. And actually, the domestic fundamentals as they are in Europe now are for weaker growth and, and weaker inflation. And I do think that if the ECB, carries on in this more dovish path, then perhaps that exposes the euro to these structural issues that Germany has, that France has. And I would imagine that a lot of German exporters would actually welcome
it. Yes, that certainly is one of the messages I was picking up when I was in Germany, just that the dawning of the realisation that we were facing another Trump presidency. That seemed to be the thinking there, was the silver lining was, well, a weaker euro might actually help the European economy. We spoke to Jennifer McKeown earlier on in the programme, and she was saying she's penciled in 2 50 basis point cuts from the ECB. Are we at those extremes? Are we going to see that kind of cutting?
I mean, we're not forecasting 250 basis points move, but I certainly think it's out there for discussion. The same way that a move below parity is out there for discussion. It's not an unrealistic scenario. And much will depend on the outcome of the German election, much will depend on what they do with their debt rate, much will depend on whether or not they can stimulate from the fiscal side. That's all, factors unknown. But I do think that, we've got to discuss the possibility that we could be trading below parity. Again, that's not in our forecast table yet, but it is a realistic possibility, as is the view that the ECB could become more aggressive.
Well, let's come back to the tariff conversation. The logical thing with tariffs, and we saw this to a certain extent previously with Donald Trump, is that you drop your currency to compensate. Is that the trade that is going to work this time round again as well? Is it just simply whatever the application of tariffs on China is, they just drop the yuan to a certain level that compensates for that? And the market effectively, as Jennifer was actually pointing out a little bit earlier on, effectively does that for them.
Well, I mean, the market would have to do it for them, although obviously in China that's not necessarily the case because it's a managed currency. And there are political implications that, China doesn't necessarily want their currency to weaken so much for the political show of it. Yep. I think when we get to Europe, I think, that is certainly something that is in discussion. The weakness of the German economy, certainly could mean that the euro goes a lot weaker against the dollar. For the UK, perhaps it's a little bit different because we're seeing more of these sticky inflationary pressures lasting a little bit longer. I mean, certainly we saw that in the CPI report for the UK yesterday. So the market is still of the view that the Bank of England is going to have to be much more cautious. And that, of course, is something which could support sterling against the euro.
Also supporting sterling could be the idea that actually the UK economy, with its service story export to the United States and running a deficit on goods with the United States, could be less susceptible to that tariff story. And therefore, if you extend the argument that if you do get tariffs, you basically drop your currency to compensate, the UK doesn't face that problem, which is another way that maybe sterling gets supported.
Yeah, well, quite likely. I mean, the US is the UK's biggest trading partner. I think about 6%, I think, of all trade is between the UK and the US, although, of course, the EU is the bigger trading partner with the... Now, a lot of that trade is in financial services, it's in insurance services. And again, how would that be impacted by potential tariffs or not? Are we just talking about goods? The UK imports an awful lot of crude from the US right now. And that, of course, Trump is going to be very happy, to carry on exporting crude oil from the US. So yes, that certainly is a factor. But right now, it's very difficult to work out exactly what Trump might do. It's very difficult to second-guess him.
It's a lot of known unknowns that we need to factor into our thinking. Jane, nice to see you. Thank you very much indeed for joining us. Jane Foley, Head of FX Strategy at Rabobank. Coming up, the EU is set to back the French government's budget. Will the French Parliament back the next French budget, I think, is probably a bigger question. Anyway, we're going to talk more about the latest euro area and what is coming out of its second biggest economy. We'll do that next. This is Bloomberg.
DraftKings hit a milestone in the second quarter of 2024. For the first time as a public company, it turned a profit.
Is this a new era for DraftKings?
There's an inflection from when you're cash flow negative and you're operating off of equity raises from the past to when you're self-funded and you're cash flow positive and able to control your destiny a lot more.
You've had your first quarters of profitability now. Does that take pressure off? Does it increase pressure?
I think it increases pressure. I mean, once you start making profits, people expect you to make more, and all of a sudden you're valued on a multiple of those profits as opposed to the theoretical what could be. So very important, I think.
When you're cash flow negative, you've sold a vision of what the company should be working on, and you're very focused on working on that and delivering against that. When you've pivoted to profitability, the world of what you can work on is a little bit open, and there's a lot of different ideas, and it requires more focus than ever to make sure that you are prioritizing on the most important things that are going to deliver the most value.
DraftKings' solid standing in a booming sector gives them the luxury to play the long game. They're not under pressure to cut costs.
When you have really strong revenue growth, you don't need that. If you look at where we are today and where we want to be and where we believe we will be, the vast majority of the incremental EBITDA is not coming from any cost reduction. It's coming from increased revenue.
We don't feel like we need to cut costs because we're growing our revenue so much. We want to grow our revenue into our existing cost structure, and there's no need to reduce the cost as long as we're being efficient with what we allow our cost growth to look like.
From the world of politics to the world of business, Joe Matthew and Kaylee Lines deliver news, insight, and analysis live every trading day. Balance of Power live around the world every weekday, only on Bloomberg. It's a multi-trillion-dollar industry. We'll show you what's happening in ETFs like no one else. Bloomberg ETF IQ, Monday on Bloomberg.
Good morning, welcome back. You're watching the opening trade. We are 43 minutes into the equity market session. Europe is fading a little bit this morning. We're now down, the CAC's down by 0.5%. The rest of Europe's not actually down by very much. There's not a kind of discernible, obvious NVIDIA effect in the market this morning. We'll see what happens when we get pre-trade in around, 15 minutes time, 16 minutes time. The European Union, let's talk about France. The European Union set to approve France's budget for next year, even as it seeks more clarity on how Paris will control longer-term expenditures. Bloomberg understands that the Commission believes that the French government is on the right track to cut its deficit in 2025 after it presented a draft budget bill with 60 billion euros worth of tax increases and spending cuts. Zoe Schneeweiss leads our Western European economic coverage and joins us now. Great. The Commission's backing the budget. Fantastic. The first point of business, though, has to be that the French Parliament backs the budget, isn't it?
That's completely right. The issue is since those premature legislative elections that they had in the early summer, that Macron no longer has a majority in Parliament. That means that everything they pass, they need to find partners, and the left has already said that they will just reject anything that comes. So that means that puts Le Pen in the driving seat, that puts Le Pen's group in the driving seat, and means that Macron's government, and now headed by Barnier, can be blackmailed and can be just forced to do whatever they want, and is constantly on edge.
Or the government could be brought down, because it's going to be a confidence vote, potentially.
Exactly. So confidence votes are one of those that should happen, will be happening regularly, probably. Le Pen has right now shown no interest in having the government fail, but she could change her mind any time, and that just puts so much unease over the whole French situation.
Then, as we said many times on the programme, she's the one who has the hand on that lever of power, if you like, and is able to do that. Thinking about the broader ECB story, which we know you cover very closely, Zoe, I know that we've been hearing from many ECB speakers, many more to come, busy week. We've heard from De Guindos talking about the trajectory from here. Let's just have a quick listen to what he had to say.
I think that the trajectory is clear if our projections will become a reality, and I think that our projections are becoming more accurate. But I think that given the level of uncertainty, I think that you have to be extremely prudent on the steps that you have to take. The direction is clear, but it's much better, to be prudent in terms of, the size of the steps that you take. When you're in a dark room, you have to be very careful in order to try to avoid, making a mistake.
So when you're in a dark room, just be careful to avoid making a mistake. You have to be careful not to hit something, I suppose. And I mean, a lot of the thinking we've been hearing from the ECB of late, Zoe, has been around, you know, inflation's almost done. We're done with that problem. Now it's a growth problem. And I wonder how quickly we're pivoting in that conversation.
Overall, the ECB will always say we have an inflation mandate, not a growth mandate. Generally, all these comments and those comments about the dark room would suggest that what the ECB wants to do is move gradually. If you remember, about a month ago, we were hearing these ideas of maybe a 50 basis point cut in December. Now it looks very much like a 25 basis point cut. And that cut, we had the Greek Central Bank Governor Yanis Stonaras speak with us on Monday, and he was like, yes, basically it's a done deal. So the issue here is a little bit, what can you do? And especially given that there's this threat of Donald Trump coming in and implementing tariffs and in a way that it really is quite unpredictable, what can they actually do on this? And how carefully do they have to move? Because tariffs will have a huge growth impact on Europe.
What's the reason for not doing 50 at the moment?
50, the issue is if they do, first of all, inflation, the economy isn't doing that badly. So the soft indicators obviously aren't great. But if you look at third quarter GDP numbers, they actually were much better than anticipated. And that's partly because Germany defied everyone.
Is the monetary policy still restrictive?
It is still restrictive.
So why not get it to neutral as quickly as you can?
It's partly also signaling. If they do 50 now, markets will start betting they'll do 50 at every step.
Well, we heard from a guest earlier on who was saying she was penciling in 2 times 50 cuts. You know, I mean, that might be quite aggressive, but yeah, that would be quite a negative signal, I suppose. But maybe that's justified. Maybe the economy is deteriorating to that degree, or is it not? Are we overstating that, Zoe?
We might be overstating it, and the issue always is if they do 50, the markets will start thinking, what does the ECB know that that we don't know? And then this panic kind of builds up. The ECB also wants to avoid pivots, and they've had some embarrassing pivots in the past. And if they go 50, and then Trump tariffs actually start being inflationary, then they might have to go back to maybe hiking again. So if you've done 50 and then have to go to hike, that's just embarrassing. And they want to avoid embarrassment.
Seems a long way to a hike, though, doesn't it? But yeah, is that what you mean? Yeah.
The other argument is that you're behind the curve and maybe you need to catch up, which is what the Powell kind of initial argument was on doing 50 when it came to the Fed. It's great stuff, Zoe. Always fantastic coverage. Thank you very much indeed. Bloomberg's economic editor, Zoe Schneeweiss, joining us around the table this morning. European gas prices have been pushing higher and higher over recent days. We have seen commodity investors weighing a premium related to the war in Ukraine. Kyiv said that Russia has launched an intercontinental ballistic missile during an attack on the country. It appears to be the first reported use of this long-range weapon. So we're watching that all really closely. Just before we get to Kriti, who's in Brussels, so we'll just come to her in just a moment. The gas price is really interesting as well because a transit agreement is about to end across Ukraine, and nobody knows within the gas industry what is ultimately going to replace that. I spoke to Equinor yesterday, and the CFO there was saying the market's tight, and we still don't know what's going to happen, and Europe is really exposed, therefore, to the LNG price story going into this winter.
Yes, and the storage question going into a winter that could be pretty cold is a big one. I know that Javier Blas has been writing a lot about this and talking about how Europe survived through, yes, some quick responses to the Ukraine invasion, but also through a lot of luck, and perhaps that some of the luck around the weather, around the wind and other things are going to run out. So certainly we keep that in mind. Let us get over to Kriti Gupta then, who's in Brussels, in fact, and keeping an eye on all of the geopolitical news flow for us. Kriti, good morning. So we've been covering a lot this morning, some of the details of attacks by Russia into Ukraine, of course, coming hot on the heels of the ATACMS and Storm Shadow attacks by Ukraine into Russia. So what's the reaction where you are in the sort of corridors of power in Brussels to these latest news lines?
Anna, Guy, it feels like everyone's at the edge of their seats in terms of looking at the developments in just the last 24 hours. I'll start with the latest headlines to your point that we got around the intercontinental ballistic missiles, the ICBMs. The reason this is so significant, in addition, of course, to being a potential response to those long-range missiles that you were just referencing, Anna, is the idea that this is traditionally used as part of the nuclear arsenal. Now, I should say, and I should really disclaim here, there's no indication, no confirmation from a lot of the intelligence authorities that there was indeed an ICBM as a part of that missile barrage, and specifically that it carried nuclear weapons. But historically, that's where you start to see your ears kind of perk up a little bit, because when people hear the word ICBM, they associate it with the nuclear arsenal. At net, what you need to know is that there's only 3 countries in the world who can defend against an ICBM. It's Russia, it's the United States, and it's China. So you can see why the tensions have risen quite extremely. But Anna, you mentioned those Storm Shadow missiles and the long-range missiles from the United States as well. The strategy from the Ukrainian side seems to be, if, and big if here, if there is a potential ceasefire discussion on the horizon between Vladimir Putin, between Vladimir Zelensky, and of course, one that Donald Trump may or may not be a part of, the Ukrainian people and Ukrainian forces need to be coming at it from a position of strength. And that means increasing their attacks specifically on ammunition, on storage bunks within Russia. And that's the strategy that's being echoed not just from the Ukrainian delegations here in Brussels, but several of their allies here in the EU as well.
In terms of what Ukraine does next, are we in an escalation cycle? What are people talking about, how the way that this is going to evolve, Chrissy?
We are absolutely in an escalation cycle, and you're seeing that showing up in this kind of almost tenacity and courage around not just the physical defense infrastructure that's happening into Russia. And of course, those are being talked about, but so much of it is funded and supplied by the United States and the UK. And right now, a big question here in Brussels is that if we do see some of that support that, by the way, the Biden administration is ushering through as fast and as quickly as they possibly can, not only in terms of defense, but in terms of aid, in terms of debt forgiveness as well, you are asked, there's a big question that's being asked here, which is, well, where do Europeans fall into this? And this is where Olaf Scholz is getting a lot of pushback, Guy. This idea that, of course, he's said no to providing Taurus missiles. He's also initiated that phone call with Vladimir Putin. It is not serving many people well, many of his colleagues well, not going very well in the halls here in Brussels. The idea from French delegates, from Lithuanian delegates, from Italian delegates that I've spoken to have all really been disappointed in his actions and talked about the fact that it was done unilaterally. So one of the big questions here is, right now, the offensive is escalatory, to your point, but so much of it is driven by the U.S. and the UK. What happens in 2 short months where European countries need to start stepping up to that aid, if that is indeed the policy decision they continue with?
And remind us of some of the broader reaction that we've seen then from European countries.
Well, as I mentioned, the disappointment around Olaf Scholz is a big one. The other piece as well is around food security, and this is a really big one as well, simply because commodities, and this is where you're seeing it priced into the market as well, commodities are suddenly front and center. Guy mentioned that natural gas agreement through Ukraine and the transit agreement. Also keep in mind the LNG story out of the United States is happening at the same time, where one of the previously reported pieces of a ceasefire agreement or aid through Congress, the Biden administration had talked about taking away some of the kind of permits and some of the red tape around some of the fracking and some of the LNG projects in the States, some of that gas that could help kind of offset the impact that you may get from the war in Ukraine and the tensions over in Germany as well. But food security is another one. Remember, Ukraine and Russia combined make 25% of the world's grain supply. So that, again, is becoming a big concern. If you have even more escalation, are you going to be seeing it show up in food security as well? And that has ripple effects for farmers across Europe.
Chrissy, thank you. Bloomberg's Chrissy Gupta, of course, in Brussels, and she's on the road. We saw her yesterday talking to the Belgian Prime Minister, but also, of course, taking soundings on what we're hearing from Ukraine, what's developing in Ukraine. Let's remind ourselves of some of the data points we have ahead of us then, Guy. We've got US initial jobless claims. It is Thursday, so that's the usual way of things. We have some data on the US housing market. Plenty of speakers. We talked to Zoe Schneeweiss about the ECB speakers who are coming up. We've got plenty of those. The BOE's man is going to be speaking as well. Interesting that we have, watching what's going on US futures, we sort of stumbled a little around some of those Ukrainian lines earlier on this morning, but we don't continue to stumble there. We've retreated a bit, but it's down about 0.3% right now. Not a substantial, not another leg down.
No. The market is getting through this stuff really quickly. You see an initial reaction, and we get through that reaction very fast. We've seen that all week in terms of what we've been watching in the Swiss franc, etc. I'm waiting to see in 5 minutes' time, 4 minutes' time, what the NVIDIA trade is, pre-trade, what that is going to look like. How big an impact could that have? Is that something that's actually going to have a meaningful impact on the US session a little bit later on? So we're going to watch that very carefully. But it does feel as if we are through the big kind of volatility event of the year. Is geopolitics going to provide us with...
Unless that's it.
Yeah.
Yeah, geopolitics being as unpredictable as it is. And we have the ability to look through it so often, but then sometimes we do not.
It's Thursday. Are we going to get a Treasury Secretary by the end of the week? I think is the open question.
Yeah, that's going to be really interesting, isn't it? That key point, that key position still not yet confirmed. In terms of the European market story, then, we're pretty flat across the FTSE 100 this morning. The Stock 600 down by 0.2%. Market's not really moving anywhere in a hurry, but we've learned a lot about the price of bananas.
Trade of the morning. The trade of the morning is basically a banana and a piece of gaffer tape. 6.2 million. Who'd have thought this? To say these markets are bananas, I think we now have evidence. This is Bloomberg.
I will show you how to get the best funding for your startup idea. Let's get started. Here's the deal. If you have an amazing startup idea and need funds to fuel it, we're here to help. Simply send us a video where you explain your idea. Make it clear, concise, and compelling. Hook us in with your passion and vision. Don't forget to include your contact details so investors can reach out directly. This is your chance to shine and get your idea in front of people who can make it a reality. Imagine turning your startup dream into a thriving business. It all starts with that one simple step. So what are you waiting for? Grab your phone, hit record, and let your idea fly. The future of your startup could be just one video away. Remember, be clear, be passionate, and most importantly, be you. We can't wait to see what you've got. Let's get funded now.
Context changes everything.
From the beating heart of global finance, economics, and politics, and wherever newsmakers are moving markets, Bloomberg brings you conversations that allow for deep discussions and important insight.
I will show you how to get the best funding for your startup idea. Let's get started. Here's the deal. If you have an amazing startup idea and need funds to fuel it, we're here to help. Simply send us a video where you explain your idea. Make it clear, concise, and compelling. Hook us in with your passion and vision. Don't forget to include your contact details so investors can reach out directly. This is your chance to shine and get your idea in front of people who can make it a reality. Imagine turning your startup dream into a thriving business. It all starts with that one simple step. So what are you waiting for? Grab your phone, hit record, and let your idea fly. The future of your startup could be just one video away. Remember, be clear, be passionate, and most importantly, be you. We can't wait to see what you've got. Let's get funded now.
European stocks and U.S. futures fall while oil and gold are up after Ukraine reported that Russia fired an intercontinental ballistic missile overnight. Well, NVIDIA fails to meet the high bar set for the outlook. The chip giant says shipments of its highly anticipated Blackwell product are on track. Plus, Adani shares and bonds tumble after U.S. prosecutors charged founder Gautam Adani with participating in an alleged plot to bribe Indian government officials. Adani Group denies the allegations. Also later this hour, a conversation you don't want to miss. We speak to legendary investor Carson Block, and his latest short position. We'll also hear the pushback on this call. Now, first thing is first, let's take a look at the European markets map. It's definitely geopolitics that's driving a lot of the equity markets, but also the bond market. I would like to point out that Bitcoin is at 97,000, so we'll do cross-asset in just a second, but you can see Europe definitely on tenterhooks. The DAX, the CAC down some 0.4%. The FTSE is also seeing a bit of pressure when it comes to the FTSE. The IBEX and the DAX are pretty much unchanged. Again, we got through. We're still expecting a nomination, of course, for the Treasury Secretary of the U.S. We got through the election. but it seems that a lot of the risk is now given what's happening in Ukraine and Russia. Let's also look at 10-year yield. I think we have cross-asset. If not, we'll get it up for you in just a second. Treasury yields, again, edging down ahead of this release of U.S. initial jobless claims. Investors continue to wait for President-elect Donald Trump's picks for his cabinet. The 10-year yield, 4.4. And then when you look at euro-dollar, 105.38. So for the conversations that matter and the insights you need, let's get started.
Newsmakers and market movers. This is The Pulse with Francine Lacqua.
Well, good morning, everyone, and welcome to The Pulse. I'm Francine Lacqua here in London. NVIDIA, the chip maker at the heart of the AI boom, down pre-market after its revenue forecast actually failed to meet Wall Street's highest expectations. Now, during the earnings call, the chief executive, Jensen Huang, assured investors that the firm is on track to meet high demand for its hotly anticipated Blackwell chip.
We will deliver this quarter more Blackwells than we had previously estimated. And so the supply chain team is doing an incredible job working with our supply partners to increase Blackwell.
Well, Tom McKenzie, Bloomberg Daybreak anchor, now joins us. Tom, so if you look at what they're saying, NVIDIA saying that the new chip is on track. Are they disappointing because forecasts were expecting too much, or are there question marks about the fact that they could disappoint going forward?
Yeah, I mean, I think to your point, look, was this a blowout set of results? No. Was it a miss? Absolutely not. And in terms of that demand, they see that progressing for the latest chip, the Blackwell, into the next quarter, so into 2025, pretty comfortably. The question really is whether they can meet that demand. So let's go back to the quarter that they reported on. It was a beat in terms of the earnings, around $35 billion US, above the average estimates. And then in terms of the current quarter, so looking ahead to the current quarter, 37 billion is what they're looking at. Now, that's not at the top end of the range. Some had expected 41 billion, but it was above the estimates in terms of expectations for the current quarter. If you're looking for potential flies in the ointment, then maybe it is around the margin story, and you touched on that. The margin did soften a little bit and is expected to soften in the current quarter. But again, executives think that will turn around again next year. And then there's a question about whether or not they're overly concentrated in just a handful of customers. And the concentration actually has increased when it comes to their exposure to some of those hyperscalers, so Microsoft and Amazon.
Okay, Tom, thank you so much. We'll, of course, keep a very close eye on everything that's happening with NVIDIA and the impact it also has in Europe. Tom McKenzie, now Treasury yields edging lower after surging since mid-September. This comes ahead of U.S. initial jobless claims data a little bit later today. So let's bring in Themis Themistokleous, the Chief Investment Officer for EMEA at UBS Global Wealth Management. Themis, when you look at the three main questions, which is frankly what Tom was saying, which is where AI goes and what that means for valuations, what the Trump trade means and what that means for the economies and geopolitics, what do you think that the markets will latch onto in the next couple of weeks?
Thanks, and good to be here. So, obviously, all very relevant questions. On artificial intelligence, I think what is important is to look through where is that technology going and where the opportunities are. And obviously, through that journey, there can be volatility. But the way we look at it is that this is a multi-year huge opportunity, trillion-dollar opportunity. And if you look at the large cap companies, they're still spending heavily on artificial intelligence. CapEx is 50% up this year, next year another 20%. And obviously some of the enablers around semiconductors, artificial intelligence chips, and also data centers are likely to be benefiting from that. Obviously, as the previous speaker said, there will be occasions that expectations tend to run away from reality, and then you could a little bit of volatility. But this, for us, is a key opportunity in the market, not just for now, but for multi-years. And this is where we see a lot of earnings potential continue to support valuations.
So, Themis, I mean, what do you do with Bitcoin? It's at 97,000. If this is going to be a linchpin of actually the American administration, do you have to look at it, or can you still just do equities, bonds, currencies, and leave Bitcoin to one side?
Sorry, I missed the question.
So the question is on Bitcoin. What do you do with Bitcoin, as we understand that Donald Trump is a very much proponent of Bitcoin, even a lover of Bitcoin?
Yes, our view on Bitcoin is, remember, we're advising private clients. And for us, Bitcoin is not something you can value. It's not like a company where you can look at the cash flow and then discount it back. And it's a concept. Is it an asset? Is it a currency? We don't think it's a currency. Is it an asset? I can see why people can put a speculative investment on that. When we look at it from a portfolio perspective, it's an asset that, if you call it an asset, is very volatile, and we think you can have in your portfolio other hedges like gold that over time prove to be a much more effective hedge and with lower volatility. So it's not something that I can understand why people can have a small part of their portfolio, very small part of their portfolio for speculative reasons. But for us, it's not an asset that we can recommend to our private clients.
Okay. Themis, when you look at what's happening in Ukraine, there seems to be an escalation. We don't know where it ends, but it's definitely moving stocks, it's moving bonds. How much volatility do you expect that to bring?
Yeah, geopolitics always has the potential of introducing volatility in the market, and we've seen exactly what's happening in Ukraine. At the end of the day, the way we look at geopolitics is to try to always keep a focus on how is that going to impact the economy. And again, if we look at Ukraine, Middle East to a large degree, the transmission mechanism is often through oil in both cases and some of the other commodities. And that's why when we look at geopolitics, we have been advising our clients to include oil into their portfolio or derivatives of oil to be able to hedge against potential volatility relating to geopolitics. And that's the main mechanism through, and we saw this morning the reaction in oil, basically. But that has the potential, and it's not surprising in some ways ahead of the President-elect Trump taking power. It's not surprising that we will see escalation, potentially Ukraine, and we could see something similar in Middle East.
Themis, when you look at some of the bond movements, I mean, there's an expectation in the market that the bond vigilantes will keep in check what Donald Trump does on trade, on tariffs, but also on taxes. What does it mean for your appetite for treasuries?
We actually think the market is going to be too far, at least for the short term. Clearly, what you mentioned is going to have an impact on term premium. But if we look at where yields are, they seem to be implying very few cuts in the next year and a half. We think with inflation still coming down, there should be support for treasuries and also in credit. We see opportunities in investment grade as well. So we do see opportunities in that space. Volatility, again, will come and go, but underlying the inflation is still coming down, and there will be opportunities for the Fed to cut, and that should be supportive.
All right, Themis, thank you so much. Themis Tikleos, they're the Chief Investment Officer for EMEA at UBS Global Wealth Management. Now, in the last couple of minutes, we have a couple of breaking news from Russia, from the Kremlin, but also from Commerzbank. We now have a new Chief Financial Officer at Commerzbank, Carsten Schmitt. So he's going to succeed the now Chief Executive, Bettina Orlopp, who was Chief Financial Officer, who was promoted to CEO. So there was a vacant place. The handover, we understand, is planned to be completed by the spring of 2025 at the latest. Now, Carsten Schmitt joins from Danske Bank, where he's been Executive Vice President of Group Strategy and M&A. Coming up, U.S. prosecutors charge the Indian billionaire Gautam Adani with bribery. The conglomerate denies the allegations. We're live in Mumbai with the latest next. This is Bloomberg.
Welcome to the world of decentralized finance.
Massive outperformance from Bitcoin.
Bloomberg's covering all things crypto, the people.
The tectonic shift emanating from Washington.
All we're looking for is clear rules and an ability to build in the United States.
Crypto shouldn't be partisan.
The transactions.
Really a record-breaking moment.
Crypto VC is back.
And the technology.
It's really the beginning of a global on-chain economy.
And if America doesn't embrace it, we're going to be left behind.
Bloomberg Crypto, only on Bloomberg.
Bringing you up-to-the-minute geopolitical news whenever and wherever it happens. I'm Stephen Engel at the Forbidden City in Beijing, and this is Bloomberg.
DOJ or other authorities
could face bigger challenges next.
It was going to keep Green World Cup. This is a 3
as the economic picture
covering the intersections of Hollywood, Silicon Valley.
Asia is at the forefront of some of the world's biggest stories. I'm Sherrian in Tokyo.
And I'm Heidi Stroud-Watts here in Sydney, where the trading day begins. We're here in the center of all the action to get you set up with the numbers, news, and knowledge you need for the day ahead.
The demand is indeed recovering.
We've been waiting for this moment.
The opportunity of a century.
Join us on Bloomberg The Asia Trade. Weekdays only on Bloomberg TV. Context changes everything.
Welcome back, everyone. The conversations that matter, the insights you need. This is A Pulse. I'm Francine Lacqua here in London. Now, just moments ago, again, we're keeping a very close eye on everything that's happening in Ukraine and Russia. The Kremlin has said that the Storm Shadow attack at Russia is a new escalation. That's according to the TASS news agency. The spokesperson for the Kremlin, Mr. Peskov, says Russia is holding responsible position in the conflict. I think from the other side, we haven't had full confirmation that some of these weapons were actually used, but Ukraine said that Russia has also launched this intercontinental ballistic missile during an attack on the country following Kyiv's strikes with Western-made weapons inside Russian territory. So this was overnight. So you can see this actually escalating bit by bit. It did appear to be first reported use of the missile designed to hit targets thousands of kilometers away since the beginning of the war. So we'll have plenty more on that throughout the day. When you look at what we've heard in the last 24 hours, embassies of the U.S., but also some European Union countries in Kyiv, for example, we know temporarily closed on Wednesday in anticipation of a major retaliation missile strike after reports that Ukraine used these U.S. supplied ATACMS and UK-made Storm Shadow weapons against Russia. So this was just the latest from the Kremlin, saying that actually this feels for them an escalation. Let's bring in our news director for the EMEA region, Ros Matheson. Ros, so good to speak to you because there's a lot going on. It's like a tit for tat. Is this full escalation?
What we're seeing is that posturing from each side. What they're trying to do is get in the strongest position for the possibility of negotiating an end to this war or a ceasefire in this war. So they're escalating to potentially de-escalate. So we're seeing Ukraine obviously now firing Western-made long-range missiles over the border into Russia, though just into that border area. We're now seeing that Ukraine saying this morning Russia's fired an ICBM at Ukraine, possibly the first use of an ICBM in this conflict, a new type of weapon. And so each side is escalating, and they're also on the ground trying to accumulate as much of each other's territory as possible. Russia is pushing aggressively on the ground inside Ukraine. Ukrainian forces are still fighting inside Russia because they want to use that as a bargaining chip if they get to the table. So it is escalating, but it's probably about getting towards a negotiation. Of course, the danger is when you escalate, you could accidentally or inadvertently push things too far. So it's like, it's risky, of course, and could it go the wrong way? Absolutely.
Okay, Ros, thank you so much. Many more questions, actually, as we try and figure out exactly what happens next. Bloomberg's Ros Matheson. Now, entities in the Adani conglomerate, such as Adani Energy, Adani Total Gas, and Adani Power, says no allegations have been made against them by the U.S. Department of Justice. Now, shares in Adani Group companies have been tumbling after U.S. prosecutors also charged the founder, Gautam Adani, with participating in an alleged bribe plot. Now, the conglomerate has also scrapped a $600 million bond sale. Adani Group denies the allegations and says they will be seeking legal recourse. Now, for more on all of this, let's bring in Sanjay PR in Mumbai. So, Sanjay, what exactly is the latest on this? How bad could it be?
So Adani Group has clearly denied all those allegations made by U.S. prosecutors, and they've said, they are going to seek legal recourse on this one, and they are also seeking legal advice because the jurisdiction is different. And very interestingly, all companies have come out with a denial statement. They say that there's nothing against the company per se, Adani Green Energy Limited or Adani Power Limited, be any of these group companies. There's no direct allegation made by the U.S. prosecutors. That's what the companies are maintaining the stand, and they are saying that they will be seeking the recourse and they will be finding a way. They will be seeking advice from the right people, and they will be taking this ahead. So, and they are clearly saying that they compliant to the rules, and they will remain to be compliant, and they are cooling off all stakeholders, partners, investors, etc. by this statement. But it's slightly late, and we are expecting a detailed one. But they've chosen to have a brief statement to deny these allegations made by U.S. prosecutors.
All right, thank you so much for the briefing, Sanjay PR in Mumbai. Coming up, COP29 UN Climate Summit has released a draft deal that includes at least $1 trillion in financing. Rachel Delacour, Chief Executive Officer at Sweep, a sustainability data management platform, joins us next, and this is Bloomberg.
From our studios in New York and San Francisco, our expert hosts have the data and analysis about the companies you know and the startups to watch, plus the interviews you don't want to miss. Watch Caroline Hyde and Ed Ludlow on Bloomberg Technology, the only daily business show dedicated to tech, right in the middle of the trading action, every weekday, only on Bloomberg Television. Context changes everything. Bloomberg Surveillance covers the latest in global markets and the political events that influence your world. Join Jonathan Farrell, Lisa Abramowitz, and Anne-Marie Hordern only on Bloomberg. Context changes everything. The countdown is on. Everything you need to get the edge at the end of the market day.
Big tech earnings kick off later this afternoon.
Gilead is coming out right now.
We have take two numbers. Back to the markets, right? Our bread and butter.
NVIDIA is one of the best stories in the tech space.
That actually matters a whole lot more.
It might shock some of your viewers.
You're watching The Close.
Get ahead of tomorrow's trading with The Close. Weekdays on Bloomberg. Context changes everything.
There is this real momentum from Wall Street. We are basically deep in the European earnings season.
Take a look at how we're faring when it comes to Asian markets.
Well, the COP29 UN Climate Summit has released a first draft deal on which puts at least $1 trillion of financing on the table. Yet key details on where the money will come from still need to be ironed out. Well, Rachel Delacour, the Chief Executive of Sweep, a sustainability data management platform, joins us now. Rachel, thank you so much for being with us. So when you look at the Trump election and actually the key positions that he's filling right now, and he's going very fast, what do you think it means for climate goals, for countries and for companies?
It can definitely slow down the signals about, taking care of the planet and decrease, our global emissions. But I really think, I'm working every day with customers, large-scale customers who are telling me, whatever the color at the White House, whatever, what needs to be, voted or else, we need to make our companies, last forever. The CEOs of companies, they are on a mandate to make sure that their companies are lasting forever, and for that, they need to transition to that low-carbon economy, whatever policies, politicians, are saying on the go.
Of course, that would be our aim, but you already see companies being less interested because not only do they not have to do it because it's not encouraged, but they actually worry about a backlash, especially if you do business in red states.
I think, I'm from Europe, and what I hear from my customers and from also U.S. companies doing business in Europe is there is two threats, when it comes to not transitioning to that low-carbon economy, not being on your ESG mandate. There is two threats. There is the regulatory threat, and there is the reputational threat. So the backlash or else, at the end of the day, what they are saying, what they are telling us for those who are advanced in their journey, in their climate strategy journey, and we are the tech strategy to that, to measure the outcomes. But what they are saying is we are already seeing an ROI of it. We are seeing an ROI on our top line, on our bottom lines. We have access to a cheaper cash. We are able to renew much more markets, much more. Our RFPs are able to be much more successful to get access to new markets and to renew ones. So, what I'm hearing from the on the ground from businesses is, and for those who are even the U.S. companies operating in Europe, they must align actually with what the world is telling them. We are all living in this finite resources world, and it's a matter of competing. It's a matter of ROI at the end of the day.
Yeah. So, Rachel, you seem to think that actually the Trump election will make no difference in terms of climate reporting or tracking.
I think that we have to be absolutely vigilant on what will be done exactly. But regulations like CSRD in Europe applying also to companies who are whatever their headquarters who are doing business in Europe. That CSRD, that playbook to be more sustainable is the shot has been fired. Actually, they will have to comply to this. They will have to apply that playbook. They will have to report and be compared to their peers. So. We may think about that I would say slow down in terms of sustainability, but even if the regulation could be potentially slowed down, okay, still, CSRD in Europe has already been fired, and the reputational cost of not acting, is something that companies must absolutely understand and act on it. This is
Rachel,
really testimonials that we have from companies.
Yeah. Yeah, and this is 100% the right thing to do. A lot of companies say it still comes at great expense. Is that a disadvantage for Europe?
It's not a disadvantage for Europe. I think that Europe is really leading the way in how companies have to be sustainable, and that playbook that we are doing, that Europe is giving to companies to organize, to harmonize the way they are gathering their carbon emissions KPIs, their ESG KPIs. It's that comparison is actually asked, by the consumers. Is actually asked by the planet. And what I mean is that at the end of the day, there will be winners and losers. So it's about competitiveness. It's about profit. So yeah.
Rachel, thank you so much. Rachel Delacour, their Chief Executive Officer of SWEEP. Coming up, we talk to the ECB Governing Council member, Yanis Stournaras. This is Bloomberg.
missed it on Bloomberg Technology.
We're excited to really change the expectations for space companies, where you have this always-on, reliable, and frankly dynamic satellite connectivity that you would expect of your power grid or of your cell phones. And so we think that this is a huge opportunity space, and our first contribution to it is through shared infrastructure.
You can see this whole ecosystem developing, and you have an exponential growth right now because easier access to space means more demand for space, and that's the definition of an exponential growth function. So if you think about someone like Varda, who is only possible now because access to space is cheaper and easier, we're demanding more access to space.
I think that's what's so exciting from a business perspective, the fact that if you can do it, you're one of the few numbers of organizations in the history who've actually pulled it off. And so it creates a very defensible position, because again, space is very, very hard.
Don't miss Bloomberg Technology live every weekday.
From the beating heart of global finance, economics, and politics, and wherever newsmakers are moving markets, Bloomberg brings you conversations that allow for deep discussions and important insights. What do you think the future is for inflation? Is this a new normal? Are markets too optimistic? How do you worry about the things that are outside your control? How does the current fighting completely stop? I'm Francine Lacroix, and this is The Pulse, every weekday only on Bloomberg.
As we spend some time here on the broader presidential race.
Let's focus in on European politics.
Makes you wonder how politics might play out.
Good morning, everyone, and welcome to The Pulse. I'm Francine Lacroix here in London, and these are your top stories. European stocks and U.S. futures fall, oil and gold up after Ukraine reported that Russia fired an intercontinental ballistic missile overnight. Well, Nvidia falls in U.S. pre-market after failing to meet the high bar set for its outlook. But the chip giant also says shipments of its highly anticipated Blackwell product are on track. Plus, Adani shares and bonds tumble after U.S. prosecutors charged founder Gautam Adani with participating in an alleged plot to bribe Indian government officials, while Adani Group denies the allegations. Now let's talk monetary policy for a change. My next guest warns that the U.S. tariffs could weaken European economic activity and lead to recession and deflation. Now, all of this comes as President-elect Donald Trump threatens to impose 60% tariffs on China and 10 to 20% on the rest of the world. Well, I'm delighted to be joined by Yanis Stornaras, the Greek Central Bank Governor. Governor, thank you so much for joining us. We also had a great conversation in Athens on Monday, where you really talked to me about expectations for inflation's growth and the Trump tariffs. I mean, do we at Bloomberg Economics estimate that actually these Trump tariffs could roughly take around 1% off euro area GDP at already a time of difficult economic performance? Is that your assessment?
Yes. This is a reasonable estimate, I'm afraid. Yes.
So it could actually, could it even push the European Union in a recession?
Well, if you take into account now that our growth forecast is for about 0.8%, if you take out 1 percentage point, we might enter into a slight recession.
Governor, you were very interesting also giving a speech yesterday, talking about inflation where you're expecting to hit it for 2%. What's the right way of looking at economics now? Do you have models, without talking about tariffs and Trump? And do those need to change when we have policy, or you already need to try to incorporate it in your forecasts?
You mean the tariffs?
The tariffs, yeah.
Yes. Well, first of all, we have to wait until the new president takes office, sits down with his advisors, and we'll see what they have to say, because now we just have what he has said during the election campaign. But we know from experience, we know from economic theory, from practice, from 200 years experience, the tariffs are never a first best policy. Whatever you can do with tariffs, you can do it in a much more efficient way and cheaper way by other means, by domestic taxes if you want to support your industry, by a set of taxes cum subsidies, but not tariffs. Do not interfere with trade. This is the dictum of economic theory and practice and experience of many, many years now.
Is there anything that Europe can do to defend itself against tariffs?
If somebody imposes tariffs, you must retaliate, I'm afraid. So this is going to have second round effects because nobody will stay quiet if somebody imposes tariffs. But of course, we need very careful thought here.
Governor, when we spoke on Monday, it seemed that a 50 basis point cut is off the table for December. Is that also
I cannot say whether because we discuss these things very carefully in the Governing Council in very good spirit, but it's my own assessment is that 25 basis points now perhaps is the right response. After all, we still don't have anything on the table. On the other side, we don't know how markets react, what the Fed will do. So I think 25 basis points is the right response now. But later, we can see.
So, Governor, when you look at, given all of these complexities, do you want to hit a swift return to normal? And so does that mean that we would have a cut almost at every meeting until you get to 2%, which is, I think, where you see more or less a neutral rate?
As inflation develops now and as the real economy develops now, I think, yes, we should have a cut in every meeting from now on until we get to what we call the neutral rate.
And that is 2% actually in your eyes?
And that is 2% according to, of course, as I said on Monday, this is an elusive concept, but according to the estimates, it's about 2%, 175 to 225. But on average, it's about 2% in the long run.
And Governor, do you see any need to go into expansionary territory?
You mean even below 2%? Well, it's very early to say. Very early to say. If the worst comes to the worst and we have a hit in European activity, maybe. But it's very premature to say now whether we should go to an expansive territory.
So this would mainly depend on geopolitics and Trump trade tariffs.
Well, no, and the domestic policies as well. It's not only foreign policy; it's also the domestic policies in Europe that count.
What do you worry about the most in some of these domestic policies? Do you worry about the election in Germany and the instability that brings?
Well, the ECB issued a financial stability report in the last few days. We described there all the financial risks. We worry about public debt. We worry about financial stability. If the worst comes to the worst, if there is a trade war, yes, there's going to be perhaps chaos in international trade that will affect financial stability.
Governor, when you look at inflation, I mean, if you talk about it, very precisely, has the risk of undershooting the inflation target become a bigger risk than overshooting it?
There is some risk, although now risks are, I would say, neutral as far as inflation is concerned. Okay, we had 1.7% in September, and then back to 2% in October. Well, I think now we are going to hit the inflation target on a sustainable manner much earlier than we thought in our September forecast, perhaps towards the end of the first quarter of 2025 rather than in the last quarter of 2025. So inflation is falling.
So the negotiated wages, I think, actually had a pretty big jump in the third quarter. How does that complicate matters for the path forward?
Well, I think that reflected backward cases like wage negotiations in Germany, but we expect that to fall in the months to come. So we thought it's one blip, but not a permanent increase.
Governor, in the ECB policy statement, there's been for a while a reference to rate saying sufficiently restrictive for as long as necessary. Would you drop that language come December?
Well, we discussed these things in the Governing Council. Nobody can say before.
But it seems like things are changing. I'm trying to understand basically how you would do it and how you see the way forward.
Maybe the time has come, but these things are being discussed in the Governing Council after a very careful examination of data. We are still data dependent. We examine all the evidence. But we are in quite restrictive territory now. It's true.
Governor, talk to me about how much we should worry about central bank independence, especially coming from the U.S. and the worry that because of President-elect Trump's certain words about Jay Powell and about the Fed, this would also then migrate actually to potential concerns in Europe.
It is a very important issue. I think even more important than tariffs. I think governments did one of the best things in economic policy in the past to give central banks independence. So if we backtrack on this, it will be tragic, I think. Jay Powell is an excellent central banker, so it wouldn't be advisable to intervene in the independence of the Federal Reserve. That will be an even bigger mistake than tariffs, I'm afraid.
And this would have huge implications, actually, for the rest of the world.
Oh, yes, of course. Of course. Both for other central banks, but also for the markets, for the bond market.
Do you
but
believe...
I don't think it will happen. It's my estimation.
Governor, do you believe, I mean, again, we talked, and you talked so eloquently about these uncharted territories, that there is a real role for the markets and for bonds to try and keep everything in check, including, central bank independence? The market would be the first to react to any such event.
But we don't want to arrive at this point. It will not be nice. I mean, we don't need to invoke market turbulence in order for governments to understand that they should not intervene in central bank independence.
Governor, as always, thank you so much for your time.
Thank you. Thank you very much.
Very wise words. Yannis Tornaros, the governor of the Central Bank of Greece. Now, coming up, the renowned investor Carson Block explains his latest short position, despite the company in question being defended in some quarters. That's next, and this is Bloomberg.
Jumpstart your trading day on Bloomberg Open Interest.
2 hours of single stock stories that are driving the opening bell action.
We'll take you to Wall Street, Main Street, the C-suite, and beyond.
These are companies that are growing their market.
The great companies in the U.S. are the companies hitting the cutting edge. That's a different story.
Get the inside track on what's buzzing in markets.
With the players who are shaping the narrative.
If you have bad earnings reports, you're going to get punished.
They're not buying what the industry is selling. Join us on Bloomberg Open Interest every trading day, only on Bloomberg.
U.S. jobs numbers are released. Bloomberg has the report under surveillance with crucial data and expert analysis at terminal speed. Nobody covers jobs day like Bloomberg.
Good morning. Good morning. This is Bloomberg Surveillance.
Welcome back to the opening trade.
This is Bloomberg Technology.
This is the Asia trade.
You're watching the close. Welcome to Balance of Power.
This is Bloomberg. Welcome to the world of decentralized finance.
Massive outperformance from Bitcoin.
Bloomberg's covering all things crypto, the people.
The tectonic shift emanating from Washington.
All we're looking for is clear rules and an ability to build in the United States.
Crypto shouldn't be partisan.
The transactions.
Really a record-breaking moment.
Crypto VC is back.
And the technology.
It's really the beginning of a global on-chain economy.
And if America doesn't embrace it, we're going to be left behind.
Bloomberg Crypto, only on Bloomberg.
Welcome back, everyone. Now, short seller Carson Block has said he's shorting the shares of cosmetic brand Elf Beauty. Now, Block says He suspects e.l.f. Beauty has overstated revenue in recent quarters and that a buildup in the beauty company's inventory was due to lackluster sales. Now, a representative for the beauty company did not immediately respond to a request for comment. e.l.f. Beauty has been defended by Piper Sandler, with an analyst at the investment bank saying e.l.f. Beauty's inventory build is not a new development and it remains confident in its overweight thesis. Now, shares in the company dropped as much as 16% in yesterday's session after the announcement before pairing losses, and actually shares a little bit lower, I think, in pre-market trading with the light trading volume. Now, Carson Block of Muddy Waters joins us now to discuss all of this. Carson, so good to speak to you, and actually so good to have you in London. There's a lot we need to talk about. But even before you announced this short, e.l.f. stock was down some 44% from its high in June. So why is now, you think, the right time to place the bet?
Well, obviously, shorting it in June would have been more opportune, but I mean, for us, in late summer, early fall, that's when we stumbled upon e.l.f. And what was actually the catalyst for us looking at it, one of our analysts got curious because they'd read an article, there were a bunch of articles in February of this year comparing e.l.f. stock performance to that of NVIDIA and showing that e.l.f. had actually outperformed NVIDIA for 5 years. And so there was all this hype around the stock. And so our analyst, this is strange. This is just a cosmetics company. You know, the other company is an AI company, and I get that. So first thing they did was pull up import data, just, you know, kind of whatever, just to see, and saw that the imports had crashed starting 3 quarters ago, had crashed by 2/3 from the prior quarter. And yet sales had maintained and inventory was building. So it was an atypical situation for us because normally with a short, we'll have a sense of where the problems are, but we have to dig to really understand them or flesh them out. But here, the problem was staring us in the face. And so the question was, what are we missing? Like, can this be this obvious?
But I mean, they previously said that the recent buildup in inventory was intentional, right? Because they were getting ready for an increase in customer demand. So why don't you believe them?
So what we think happened, okay, so they're on a March fiscal year. So if you go back a little bit, well, 4.5 quarters ago. So we think Q2 fiscal 24, they were expecting a lot of sales and they had built up inventory in anticipation of that. And we think that sales must have hit a wall in Q2 of 24, fiscal 24, and they got stuck with a bunch of inventory. So they then told the market when they reported numbers and the inventory had gone up significantly, they said, well, most of that bump is because we've changed the way that we're sourcing inventory. We're now taking ownership of the inventory in China, and so now we're showing another 37 million in inventory on the water that we previously wouldn't have shown. Now, our research leads us to conclude that that was a completely false statement, that they have long generally taken ownership of the inventory on the China side. So their accounts, their inventory accounting should have always been consolidating the on-the-water inventory.
Right.
So what happened then, so now they have this excuse. We don't think the sales really picked up for them in Q3, fiscal Q3. So by the time they got to fiscal Q4, I think they slammed on the brakes in terms of buying new inventory because they're trying to run down the existing inventory. But even after the imports cratered by, again, 2/3, which that pattern has held for 3 quarters, their inventory balances keep climbing. And since about 80% of what they sell in the U.S. is imported from China, it seems like these two things cannot both be true. You cannot have 3 quarters of crashed imports and rising inventory levels.
So we have sent many emails. We are trying also, I need to, you know, this is a big disclaimer. We're trying to get actually the e.l.f. side, which we haven't heard anything back yet. But have you had any engagement with the company itself of regulators after your announcement of short selling yesterday? Okay,
so we don't comment on discussions with regulators ever, but or whether they've occurred. But in terms of e.l.f. itself, a lot of times when we're looking at a company, we will speak with the company. Now, we don't say we're Muddy Waters because if we do that, we're obviously not going to get the version that every other investor in the market gets. So we have spoken with e.l.f.'s internal IR, and we've asked questions. And
yesterday, after the short selling, or
before? Prior to it. I mean, so we asked about the taking title on the China side, and we received basically, we asked them to follow up by email, and because there was no good answer on the call, and the email we got back was a word salad about like, yeah, we just changed the timing on it.
What's your price target?
Oh, we don't do price. I mean, the problem is, like, just, because I don't want to make it sound like I'm copping out here, but when you know that a company's accounts are problematic, okay, when you can tell that from the outside, it's really not possible for us to know the full extent of the problems. So I can seldom sit here and tell you about a company that we're short. Like, this is what I think the real financials are. So we think they've over the past 3 quarters, we think that they've overstated probably somewhere from 130 million to 180 million of revenue. No. I can make arguments as to why that's conservative. No. I would think that this could have predated the period that we're able to identify. I don't know. So when there's rot, when we perceive rot, we just can never tell how far it goes from the outside.
Okay, and again, we have reached out to ELF. We haven't heard back. You did a parallel. You were talking about a parallel that you think was unfair between NVIDIA and ELF. What would it take for you to short NVIDIA, given where we are right now? Okay, so, all right, look. So I'm among a group of people who believe that when you're looking at the largest companies in the S&P 500, that the fundamentals don't really matter because the structure of the market right now is such that they keep receiving flows. So you have the target date funds, right? These are retirement funds. Every month, they are buying structurally, and the largest companies in the index get the most flows. And so what ends up happening there, okay, if you believe in this theory, is that even though technically the float might be this, as a larger percentage of that float is actually passive, passive will never sell until it gets outflows. So long as there are net inflows, you effectively have these ever shrinking, squeezing floats in the stocks that are, Mag 7. And so I don't think fundamentals fundamentals only matter on the margins with something like NVIDIA, with one of those really big, large weightings in the S&P. It would take a lot.
There's no point. I'm telling you, I see no point. For years, I've seen no point in shorting Tesla. We used to be short Tesla. We had crash puts on Tesla that we funded by going long the converts and clipping the coupons and buying the crash puts. Those almost paid off in 18, got pretty close. But other than that, like I've long said, I wouldn't short Tesla either, and it's a similar situation to NVIDIA. It's such a large weighting in the S&P. It's constantly getting flows. So, yeah, what would it take? It would take it not being one of the largest companies in the S&P. So, in other words, post the best time to short it is when I would consider shorting it.
Okay, Carson, thank you so much. Carson Block from Muddy Water Capital stays with us because I have 1,000,001 questions to follow up. This is Bloomberg.
Asia is at the forefront of some of the world's biggest stories. I'm Chevrian in Tokyo.
And I'm Heidi Stroud-Watts here in Sydney, where the trading day begins. We're here in the center of all the action to get you set up with the numbers, news, and knowledge you need for the day ahead.
The demand is indeed recovering. We've been waiting for this moment.
The opportunity of a century.
Join us on Bloomberg The Asia Trade. Weekdays only on Bloomberg TV. Context changes everything.
to the world of business. Joe Matthew and Kaylee Lines deliver news, insight, and analysis live every trading day. Balance of Power live around the world every weekday, only on Bloomberg. From our studios in New York and San Francisco, our expert hosts have the data and analysis about the companies you know and the startups to watch, plus the interviews you don't want to miss. Watch Caroline Hyde and Ed Ludlow on Bloomberg Technology, the only daily business show dedicated to tech, right in the middle of the trading action, every weekday, only on Bloomberg Television. Context changes everything. Get your fixed income fix. Watch Bloomberg Real Yield every Friday, right here on Bloomberg. Context changes everything.
Welcome back, everyone. Still with me, Carson Block of Muddy Waters Capital. Carson, thank you so much for sticking around. We were talking a little bit about NVIDIA and what would it take for you to short it. You said almost nothing if it's part of the Mag 7. Does the Trump administration change things for short sellers?
Well, it's interesting because I realized a long time ago that Elon Musk had identified the populism of the moment at about the same time that Trump had. And Trump harnessed that in 2016 to become president. And Elon, the way that he harnessed that populist sentiment was by creating this us against them being short sellers narrative that really helped propel Tesla's stock price upward. And so it's not a surprise then that these two are now, Trump and Elon, are pretty aligned. So again, Elon's market populist playbook is to blame the short sellers. Now Trump has a company that's public, that's named after him, symbol DJT, well, the ticker, DJT. Yeah. And he's already used Elon's populist playbook, blaming short sellers for the stock going down. I'm sure he doesn't believe that, and I don't think Elon ever really believed that short sellers, were keeping a lid on Tesla either. But I don't know how far Trump goes with that, right? I mean, so we've already had some rhetoric. We might have some more anti-short seller rhetoric. I don't know if it's going to go.
Regulation, or you just don't know?
Look, Trump hates regulation. It's a question as to who's going to head the SEC.
Yeah.
I doubt that, and I think the Trump SEC is going to roll back a number of regulations. Now, there was a recently promulgated regulation that forces fund managers to report on their short positions monthly to the SEC.
Yeah.
The reporting is non-public, but I doubt that they're going to try to roll that back. Yeah. But I don't know. I think the other issue that we have to think about as short sellers, though, is enforcement. Right. I think, generally Republican administrations tend to be lighter on enforcement. I mean, even under Biden, enforcement against corporates has been, from our perspective, as I've talked to other activist short sellers, has been lacking, severely lacking. So will that pick up under a Trump administration, especially with Matt Gaetz running DOJ? I wouldn't bet on it.
Yeah. But
we'll see.
Carson, you have to come back on also to talk about the bull market. Carson Block from Muddy Waters Capital. Well, that's it for today. Up next, Bloomberg Brief. Manus Craney, Danny Berger in New York, and this is Bloomberg.
also an owner, I should have pointed out, of 3 major sports teams.
That's right.
Right? And you're the first woman, as I understand it, first woman to own 3 major, have stake in 3 major sports teams. Is that right?
Yes, and we'll say African American.
You were approached by the owner then of the, I guess, the Washington Wizards and the Washington Caps about maybe buying the Washington Mystics, which is the women's basketball team. And what did you say?
Well, first of all, it was Abe Pollin. He did come to me and Susan O'Malley, and they said, Abe Pollin says, look, I want you to be the face of the Washington Mystics. And I said, what do you mean be the face of? He says, I want you to buy this team. His health was failing. And I have to tell you, and a lot of women can understand this, we never get these opportunities. So that was the first thing that struck me. And I was flattered. I was really flattered. I said, well, Abe, what are the financials on this? And he handed them to me. He says, well, they're not making money. But I was still intrigued about team ownership.
The countdown is on. Everything you need to get the edge at the end of the market day.
Big tech earnings kick off later this afternoon.
Gilead is coming out right now.
We have Take-Two numbers. Back to the markets, right? Our bread and butter.
NVIDIA is one of the best stories in the tech space.
That actually matters a whole lot more.
It might shock some of your viewers.
You're watching The Close.
Get ahead of tomorrow's trading with The Close. Weekdays on Bloomberg. Context changes everything. Bloomberg covers the world with unmatched reach and resources. From more than 120 countries, the moment news breaks, 24 hours a day. Bloomberg, context changes everything. It's a multi-trillion-dollar industry. We'll show you what's happening in ETFs like no one else. Bloomberg ETF IQ, Monday on Bloomberg.
Good morning from our global headquarters in New York. I'm Menace Graney alongside Danny Berger. You're welcome to Bloomberg Brief. Let's set that agenda.
So much anticipation for a mic drop moment. NVIDIA underwhelms and dips pre-market. Conflict ratchets higher. Oil and gold rally after Ukraine report on Russia firing a ballistic missile. The Treasury search continues. President-elect Trump holds meetings with contenders while mulling a new role for crypto. Good morning, Menace.
Danny, a very good morning. You're right. We're expecting so much of a drop of the mic moment, to quote Wedbush Securities. But I just want to emphasize that NVIDIA did deliver a 94% rise in revenue. Context is everything. The stock's down 3.33%, so we're moving a little bit lower as New York begins to waken up. I think there's 2 offers across the equity space this morning. One is the NVIDIA non-drop the mic moment, and also the ratcheting higher, the geopolitical, the launching of missiles from Russia into Ukraine. What does that mean? What is that escalation risk? Roll it over, have a look at the bonds. We checked their side a little bit early. There was no real movement, but suddenly now we are a little bit more momentum, yields dropping. There was an unloved 20-year bond auction yesterday, bid to cover ratio 2.34, a little bit less than the average of 2.52. Roll it over and have a look at Bitcoin. My gosh, the things I regret in my life. The things I regret in my life, not buying Bitcoin. We're on our way to 100. We're on the way to the moon. $100,000 is on the way, Danny. We've got this story, of course, that we may have a new crypto czar seated somewhere on Capitol Hill.
Well, maybe for those that live in regret of not buying Bitcoin, maybe today is the day where you can buy NVIDIA. Maybe it's the day it's on offer. I go back to their last earnings. They fell more than they're currently down. They fell some 6% and then went on to rally 20% to this point. So yes, expectations were lofty, as are valuations. Investors want something that's miraculous, but as you point out, these numbers are still staggering, even if they were just at expectations.
They are, and as I said, it's this plus or minus 2% on the number of 37.5 billion. Barclays make it very clear. Today's price reaction does not correlate typically, and we need to emphasize the caveats, typically with where NVIDIA goes post these earnings. We're going to have, frankly, a little bit later on from HSBC. He shaved the price target to $195. He just said there just wasn't the normal full bull alpha in the guidance.
Yeah, I'm still like, okay, we're upset over 73% margins instead of 75 when Intel doesn't even have half of that.
No.
Well, let's take a check on those NVIDIA shares. Man, I'll show them in a moment. They're bottom of your screen, down 3.2% this morning. So yes, it gave a forecast that was missing the most optimistic of expectations. Joining us now is Bloomberg's Tom McKenzie. Tom, what went wrong and what went right?
Well, I like the Danny Manis comparison, which is that we always build up to your show with expectation that you both, as a couple, as a duo, will both inform and entertain, and you never miss those expectations.
So
NVIDIA, though, has missed. They have not gone full bore on these results. But let's take a step back, because as you were pointing to, in the quarter in which they reported, $35 billion in terms of the revenues, above estimates. The current quarter that they guide to, the current quarter, $37 billion. Again, above the average analyst estimates, but to your point, below the most bullish target that had been put out there by some analysts of $41 billion. The demand for the Blackwell, the new chip, is still there. It's expected to ramp up into next year. The question really is whether they can supply that demand. If you're looking for little flies in the ointment when it comes to NVIDIA, is it around the engineering challenge and the squeeze that's put on the margin? With the context that you give on the expectation that you maybe go from a gross margin of 75% to shock horror 73%. As you said, more than double Intel's gross margin and 20 basis points more than AMD. Morgan Stanley is saying this was a transitional quarter. The first full quarter for the Blackwell will be in January. That will be a crucial quarter then. They expect the ramp up for Blackwell to be there. The question will be whether NVIDIA can meet the demand.
And to quote the man himself, I think it's going to be scale deployments in terms of that rampant demand. Let's just check out what the CEO, Jensen Huang, had to say about the Blackwell production. This was the earnings call, Tom.
Blackwell production is in full steam. In fact, as Colette mentioned earlier, we will deliver this quarter more Blackwells than we had previously estimated. And so the supply chain team is doing an incredible job working with our supply partners to increase Blackwell.
Now, this is about product evolution and premium evolution in the Blackwell chip, Tom, isn't it? Because being able to charge $20,000 more for a Blackwell chip is about the evolution of demand and margin.
It absolutely is. And again, the executives at the head of NVIDIA say that margin story will improve into next year. You'll get back to that 75%. The Blackwell is and this is what they'll tout, a more efficient chip in terms of what you can produce, the training, the inference for these models, that yes, you're paying a premium for it, but it does that much more. And again, no one is doubting that the demand is there. The doubt comes to whether or not they can actually supply that demand, given the well-reported minor glitches they've had in terms of the engineering front. So again, that's why the first quarter, January quarter, as Morgan Stanley was saying, is going to be so important. Here's another potential question mark for those who have a skeptical lens on NVIDIA in terms of the concentration of clients they have, the hyperscalers, the Microsofts and the Amazons of the world. The concentration actually increased, so about 50% of their revenues now come from just a handful of major customers versus 45% in the prior quarter. That will, for some, being a little concerning. They want to see that going in the opposite direction because they want to see NVIDIA expanding, for example, to enterprise, to the sovereign space, maybe at a slightly more aggressive pace. But let's, again, reflect on the numbers here when it comes to the market advantage that NVIDIA has. Just in the data center alone, more revenues coming from that unit of the business than Intel and AMD combined.
It's pretty staggering, isn't it, Tom? And of course, we've yet to talk about the power supply for these clusters. Let's see what the Trump administration's power policy will be. That's going to be integral. Tom McKenzie with all the details on NVIDIA. Well, oil is higher this morning. Traders are weighing up the escalation of the Russia-Ukraine conflict. Ukraine says Russia fired intercontinental ballistic missiles as part of an overnight attack. Russia called Ukraine's use of British long-range missiles as, quote, a new escalation. Our guest this morning is Marvin Barth, and he writes this. Foreign adversaries that fear Mr. Trump's unpredictability have a short 76 days to change the facts on the ground. Joining us now is Marvin. Marvin, good morning to you. You say that we're entering a period of where Putin could take the gloves off. We can debate whether that's part of the escalation overnight, but you say markets are seriously underpricing the gravity of political risk in this vortex period.
Yeah, that's definitely been the case. We have seen implied vols rise a bit here, but we're still well in the third quartile of implied volatilities. And yet we're in a very dangerous period. This transition period is exactly the period in which the U.S. Is adversaries, of which it has many, would like to change the facts on the ground to make sure that they are in the best negotiating position possible with the Trump administration.
Marvin, you have been so right on this, even before the latest escalation in Russia and Ukraine. Is this as bad as it gets, or do we need to brace ourselves for something worse before January, before the inauguration in this transition period?
Unfortunately, I do think we need to prepare ourselves for worse. You know, one of the predictions that I made, if you looked over the course of the last 2 years, was that Russia was very focused and driving very aggressively towards this key logistical hub in eastern Ukraine called Pokrovsk. They started to effectively stall that operation in the leading months into the election, I think because they did not want to swing the election to Donald Trump. I think the consensus is totally wrong on that. And as a result, we did see them pull back from that, but that immediately restarted as soon as the election was over. There is an aggressive push underway. They do look like they are positioning themselves for potentially an encirclement from the south, and that would be a disastrous development for Ukraine and I think for Europe, and puts European risk assets and the euro under significant risk.
Well, the euro this morning is down 0.25%. Bond markets are the immediate go-to here, Marvin. I'm interested in that the reaction function was much more limited when Ukraine launched into Russia. The reaction function from markets is much more aggressive when it's this counteroffensive from Russia. Bonds are bid, but I just wonder to what extent does that hold given the human steepener that is called Donald Trump. That's according to one of our guests a little bit earlier this week. Not my phrase.
Well, you know, it's interesting. I've actually had the opposite view on that. The steepening in the U.S. has been primarily due to the Fed's policy errors, not due to Donald Trump. In fact, you could see that steepening, particularly the 10s/30 steepening, started immediately after their 50 basis point cut, and it actually plateaued at the election. It didn't worsen from there. So this is that's much more a Federal Reserve story, and I do think, to your point about the reaction this morning with respect to the ICBM and Russia's change in its nuclear doctrine, that the bid for the long end is actually sincere here.
Marvin, the thing that this market has been hanging on to is, even though we've gotten a lot of picks for different cabinet positions from Trump that are unconventional, some would say, that the Treasury pick, markets are holding out hope that it is someone conventional, that it's someone that can sate markets and make sure things remain calm. You point out that what we've had so far is a common thread of a wrecking crew, of people that really come in and shake things up. Is the market too sanguine that regardless of who the Treasury pick is, by the way, a department that you once worked in, that we shouldn't be so sanguine on just kind of the staid, classic type of government officials that we're used to?
Yeah, Danny, that point about the wrecking crew, that is largely the domestic focused. So if you think about Justice Department, Health and Human Services, Commerce, the Defense or DNI, all of those have been focus of President Trump's ire towards those departments in the so-called deep state. And so he's putting in people who have a common thread of hatred towards those institutions they're being put in charge of, so he can count on them to go in and clean house. But notice that on the foreign policy side, he's actually chosen much more stable hands in terms of Marco Rubio. I'm blanking on the National Security Advisor right now, but these are actually solid people that project strength abroad. I think the Treasury pick is a much more difficult one because he's going to have to thread a needle here. Obviously, he has promised some sort of revolution in terms of payment systems with respect to crypto. He's also promised a reform of U.S. debt, and yet he has to make sure that he keeps foreign bondholders on board. So this is going to be a difficult needle to thread, somewhere between the wrecking crew and somebody who projects stability.
Well, you also take aside to Elon Musk and Vivek Ramaswamy. You call them unreasonable professionals. Part of the narrative is that they will take a wrecking ball, quite literally, to the number of people employed in government. That will open up opportunities, theoretically, for the private sector. This is the theory, Marvin, not yes. Mine. But you call them unreasonable professionals. How much reality is there with this DOGE? Because it's a toothless committee by all account, but they are advisors with sway.
Okay, so I used the word unreasonable. I'm thinking of Eli Broad's title for his own biography. And Elon Musk and, frankly, Donald Trump are exactly that same type of character. They're totally unreasonable to deal with. They set ridiculous expectations, and then they go out and meet them. Nobody has done that more so than Elon Musk. And so, you know, for those of us who've worked inside the belly of the beast, not just at the Treasury Department, as Danny mentioned, but also at the Federal Reserve, we know that actually taking on the U.S. government and its bureaucracy is a mission impossible. And so you don't have a better candidate for that mission than Elon Musk. But as you highlight, the risks that he fails are incredibly high. I do think, to the point about it being toothless, I doubt it's as toothless as we think. I don't think someone like Elon Musk is going to sign up for this job for something that isn't going to allow him the opportunity to do something.
Marvin, this was so instructional. Thank you so much for joining us. By the way, it is Mike Waltz, I think was the name that you were looking for the appointment of the National Security Advisor. Marvin Barth, well, thank you again for joining us of Thematic Markets. Let's get to some of the other top stories trending on the terminal this morning. Archegos Capital Management founder Bill Hwang was ordered to spend 18 years in prison for fraud and market manipulation, tied to the stunning 2021 collapse of his $36 billion family office. The judge rejected his request for no prison time, calling it, quote, utterly ridiculous.
Volkswagen is facing a growing threat of widespread walkouts as executives and unionists dig in over how to restructure Europe's biggest automaker. The talks will continue today, with warning strikes expected to start in December.
Shares of Adani tumbling. U.S. prosecutors charged the founder with participating in an alleged bribe plot. The announcement came just hours after units of the conglomerate had priced the bond offering that it ultimately scrapped. The group said that the allegations are baseless.
Coming up, Donald Trump's cabinet will need a Treasury Secretary delegate. How did the interviews go? We'll update you.
And we need more digestion time in equities. That's according to Katrina Dudley of Franklin Templeton. We're going to catch up with her later on this hour. More to come on your brief.
A reasonable rally. I mean, how much more upside is there to it?
So it's funny, about 4 years ago, I wrote a piece on why Bitcoin can reach 100,000. And I think in 2025, there may be a chance that we actually see that prediction coming across. But putting that aside, I do think that Bitcoin's value has always been holding true. The reason we are seeing it going up is exactly a reflection of markets' reaction to Trump administration, or the anticipation of Trump administration being pro-crypto, pro-Bitcoin, and also pro-economy.
Huge things are coming. What exactly are we looking out for? What would be a game changer in terms of regulation, easing of regulation? What would prompt that rally to go higher?
I think there are actually two sides. One is really market expectation about how the Trump administration's policy will affect the macro economy in general. General policies around tax cutting, general policies around health healthcare spending, around their external policy, and the impact on labor market. That's one side. I think generally right now, at least, the market is very optimistic about what the new administration will do and how it will actually help support the market. I think the other side is about what the market is expecting about the administration's policy toward crypto, right? In general, like clearer policy, clearer regulation, whether there will be actually a federal regulator instead of, in current state, it's very much state-by-state approach. Is SEC or CFTC going to take the realm? How long will the industry see actually certainty? And that actually have a huge impact on how the banking industry, particularly the tier one banks, their appetite in accepting crypto business and providing on-ramp to crypto platforms, which obviously have a downstream impact on crypto price in general.
First, let me say how striking it is, the contrast between how many other nominations have gotten out the door ahead of Treasury, which is such an important pick. Last night, we saw him name a prospective U.S. ambassador to Canada. So we're still waiting for Treasury, but we have our representative in Ottawa, at least, in line. Look, you named the four contenders who are still in the running: Warsh, Rowan, Senator Bill Hagerty, and Scott Bessent, who are still in contention. This is taking a while because it is a consequential pick for Trump. He realizes that it has to sit well with Wall Street, and he has always viewed the financial market and the stock market in particular as a benchmark for his performance as president. So if his selection for Treasury doesn't go over well and causes some market dyspepsia now or down the road, it could reflect poorly on him, and he is aware of that. And remember, he needs the Treasury Secretary to do a couple of things. He's got to wear two hats. One is, of course, to be an advocate on Capitol Hill and in global capitals as well for his tax cut and tariff agenda. But this person also, as your prior guest alluded to, has to be somebody who can be a crisis manager. And things can pop up out of nowhere very quickly. We've seen the escalation recently in between Russia and Ukraine. And those kinds of things can weigh on markets, and you need a steady hand at the tiller at Treasury. And that is what Trump is also looking for, too.
Well, it's going to be interesting whether he goes with a slightly more conventional pick or the unconventional. We know that the rollout of these names, the process of vetting them, has been anything but conventional so far. And it looks like he's about to skip over the FBI vetting process for his nominees. Now, you've got a 60-year precedent on this. How's the Senate going to react to this? Because Vance and Gates were there yesterday sort of lobbying for support. So talk me through the risks here.
They're already on Capitol Hill expressing a lot of chagrin over Trump's apparent intention to not have the FBI do any vetting of his nominees. He would rather have somebody from the outside, according to CNN, handle this scrutiny of nominees' backgrounds. And in a way, this sort of reflects his suspicion of the Justice Department and the FBI. He and his supporters have long claimed that those agencies and others in the government are part of a deep state that is out to get him. And of course, they haven't offered evidence to back that claim. So it would be odd for him to then turn around and say, okay, well, you can have the FBI, this agency that I have reviled and really would like to change, do all this scrutiny of my selections. This is most striking when it comes to his choice for the Justice Department. Matt Gaetz, who's been surrounded by allegations of sexual misconduct. These are claims that he has denied, but there was a Justice Department investigation that ended up closing without any action. And the House Ethics Committee has also looked into this too. So lawmakers want as much paperwork and paper trail from an agency like the FBI that has been doing this for nominees, thousands of them for 60 years, as you said.
Okay. Shep, thank you very much. Michael Shepard there, tracking the very latest from Washington. We'll tell you what's on the front pages in just a moment. We'll give you a little old crypto check. There's SPOOs at the moment, on a 31%. Good morning from New York.
invest in, buy, and own the backbone of the global economy. When the water gets delivered to your house, the road you drive on, the pipeline that brings different things to your community, the telecom towers that transmit your phone, the data center, the real estate that you live in. It's what we own and build, so it's really what drives the economy, and you don't often see our name.
Is that a good or a bad thing?
You know, it's just because we're behind the scenes, but it's big with $1 trillion of assets almost. We're behind a lot of the things of the global economy.
So being low-key, do you think it gives you strength?
We just try to be quiet and do our thing, and sometimes it helps and sometimes it doesn't. But I'd say on balance, it's been good for us.
Bloomberg covers the world with unmatched reach and resources. From more than 120 countries, the moment news breaks, 24 hours a day. Bloomberg, context changes everything. From our studios in New York and San Francisco, our expert hosts have the data and analysis about the companies you know and the startups to watch, plus the interviews you don't want to miss. Watch Caroline Hyde and Ed Ludlow on Bloomberg Technology, the only daily business show dedicated to tech, right in the middle of the trading action, every weekday, only on Bloomberg Television. Context changes everything.
Front pages look a little bit like this from around the world. We're going to kick it off with the Financial Times. They start with Ukraine saying that Russia launched an intercontinental ballistic missile during an attack. Now, it appears that the first reported use of the missile since the beginning of the war. Russian officials have yet to comment on the alleged missile launch.
Next up, we have this on the Washington Post, that Elon Musk's artificial intelligence startup, XAI, has told investors that it raised $5 billion. That means it's more than doubled its valuation from the spring. The primary product is Grok, a competitor to OpenAI.
And Bloomberg leads with, you got it, Bitcoin. We are almost at $100,000, fueled by optimism. The President-elect Trump's support for crypto, the crypto market as a whole, has gained $900 billion since Trump came to power. I mean, look, there's lots of angles to this story, aren't there? But the latest is that we may have a crypto czar appointed. It would be the first ever White House crypto role. And that's about power, access, and influence. And we see how valuation works with power, access, and influence so far.
Yeah, I mean, look, we've gotten bulled up on Bitcoin before, and it's disappointed. Same might go for Tesla. The thing is that these shifts in policy take years to materialize.
Yes.
So is this going to be a market that becomes impatient waiting for that materialization to happen?
Well, it's about what policy do you actually deliver. But to get out ahead of it, MicroStrategy, at the start of the week, they were going to do just over $1.5 billion of convertibles to gear up to buy more Bitcoin. That's up to $2.6 billion and counting.
In 2000, post-Napster, generally everybody wrote off the recorded music industry, including the investment community. And I didn't mind that chapter because then I got left alone. And actually, I think out of that period, we started to create better art because the pressure wasn't on from the technology to be the most powerful chapter. And then iTunes came in, and iTunes, to Apple's credit, did have a boutique taste mentality about the store, which meant that I think they understood. I can tell you from that period that the artists that came through were of a very high quality because it was encouraged to be boutique. Now, ironically, this chapter has made us more money times 5 than the iTunes chapter and the post-Napster chapter. But an algorithm tells you what you want, not what you might like. And there's a difference between what you want, but with streaming, the downside is you have incredible penetration, and we have hundreds of millions of people around the world. And so that has been very lucrative as a business.
There is this real momentum from Wall Street.
We are basically deep in the European earnings season.
Take a look at how we're faring when it comes to Asian markets.
From our global headquarters in New York, welcome to Bloomberg Brief. Danny Berger and Manus Cranny, let's set your agenda.
So much anticipation for that mic drop moment. NVIDIA underwhelms and the market dips. Conflict ratchets higher. Oil and gold rally after Ukraine report on Russia firing a ballistic missile. And the Treasury search continues. President-elect Trump holds meetings with contenders while mulling a new role for crypto. Danny, good morning.
Good morning. Well, when you have a PE ratio of something like 50 times, investors want something that looks miraculous, not just good. And we got very good for NVIDIA, but still shares down 3.2% pre-market. It's taking the rest of the futures session with it. S&P, NASDAQ, Russell, all down this morning. NASDAQ obviously leading those declines, 0.4%. A bit into bonds. We did have a weak auction yesterday that led to a sell-off. Today, it is about risk of Russia-Ukraine. Again, Manus mentioned the headlines there. That's also driving money into crude this morning, up 1.4%. Now, when it comes to this overall market, Katrina Dudley of Franklin Templeton writes this, that there's a rotation under the surface. The tape has broadened out since the beginning of Q3. You can see that with the equal-weighted S&P 500 outperforming since the end of June. Katrina, I'm pleased to say, joins us now. Katrina, the broadening out has happened. And at the same time, we've had disappointment from NVIDIA. Does this signal a leadership change, all of these facts together?
I think we wanted to see some of that because we have been talking for the first half of this year, and even more about that, about how much pressure there was on that Magnificent Seven, and we were looking at them with their earnings growth expectations and their need to deliver. And the fact is the market has broadened, so it's more people and more companies are bearing, the kind of earnings growth lift that you need to sustain the market at these levels. So we're actually really happy about where this market is at.
Now, you say red sweep, look at the data, look at the history, outperformance will be delivered. I'd like to just counter that slightly and just say, going into 2025/2026, does that thesis endure for 2025 but becomes more challenged in 2026 when you actually know the tax, the tariffs, and the deportations? We have a window of where this rally can endure.
Okay, so first of all, thank you. We're talking about 2025, finally. I mean, we went through all of 2020 until just recently, and all we could talk about was the election and what was going to happen in the immediate term, and the market is starting to forecast into the long term. So, I just have to thank you for doing that. So that's the first thing. The second thing, let's look at 2025 and the setup going into that. We've got a Republican sweep. If you go back to 1932, it's about 23% of the time when you have such a bullish indicator in the markets where you have all of the houses aligned. So I think that we've got some really good setup from that in terms of passing policy that makes sense. On the tariffs, if you believe him at his word, it is slightly negative for the markets. The more bullish interpretation is this is the quintessential negotiator. And whenever you buy a house or whenever you start negotiating for anything, you always start with a low bid. So you want to look at these tariffs as kind of being an opening bid, and that he'll start to not backtrack, but we'll start to see softening exemptions, things pulled out. So that's another aspect which is slightly bullish versus where expectations are for 2025. In terms of the deportation, yes, it is a concern. We've seen that the election is really happening in the bottom income stratas, even actually moving into our middle class, and losing some more of our employees would be difficult in those workers. But let's not forget we have the Doge and we have some efficiency coming through government. So maybe we do have a little bit of transition and shift of workers.
But what is the starting point? Because I think about going into 2024, we were all talking about recessions. We were talking about equity markets not performing. And here we are with stellar returns from this equity market. Are we starting from a base that is more bullish with less room to run? Or have we kind of reset in the past week, let's say?
So when I came on the show in kind of late October, early November, we talked about how cautious and how bearish the market was. So I think what we've seen in this rally is really just the resolution of some of that bearishness, and you've seen the shift of the market, and it's just losing the bearishness. I'm not necessarily sure that becoming less bearish is becoming optimistic.
It's interesting, we've got political resolution, but we've got monetary policy procrastination. And pause is the new word.
Actually, no. I'm going to take the other side of this conversation here.
For
because
all of my bids this morning, Katrina wants the offer. Go on.
But I think we have been in the position for some period of time, if I look at our fixed income team, that these cuts would be shorter and shallower. And I think the market has actually come to us. So I'm not necessarily sure you want to say that this is a Fed with a lack of direction. I think you want to listen to the fact that the Fed is paying attention to the data. We look at the action that they took in November, and I think they kind of gave us that second rate cut. But as I look into 2025, it's probably like a coin toss as to whether or not you get a significantly more rate cuts than where we're at. Maybe we get one adjustment, but the Fed is adjusting. And that's actually really good. That actually is a great narrative because they're actually adjusting rates to suit where the economy is at. And that's a position of strength.
And I mean, in the meantime, we have seen the bond market go back and forth. And for all the volatility in treasuries, credit has not had that. We're at spreads that are the tightest of the century. Is this just still post-pandemic animated suspension? Are we in a credit cycle? What is your read that you get from that?
So the credit spread tightening is so interesting because you're really not getting paid to take on risk. But if you look at the absolute return that you're getting, because rates have moved up, these are yields that you're getting that are significant and much higher than you've seen. I think people haven't focused on that credit spread. We've seen a number of our portfolio managers having a look, and they're basically saying we're not getting paid enough to take on the risk of high yield. So people are sitting in treasuries. Obviously, when people are sitting in treasuries and they're sitting in government debt, the next element of that conversation is going to go into our fiscal deficit and the projections that we've seen there.
Just very briefly, Torsten Slog had a note out the other day, $2 trillion went in. When we started the hiking cycle, $2 trillion additional dollars went into money market funds. And I want to go to 2025 again. I mean, that's an additional alpha to risk if that comes out as we continue in the cutting cycle that you suggest.
Yes, so I think that there is a lot of money that is still sitting on the sidelines. Going back to our earlier comment, people were fairly cautious and nervous going into year end. And I don't think the election, a lot of people are still digesting those results and digesting what's going to happen in 2025. They didn't suddenly wake up the day after the election and go, all in, let me put all my money market. And if you're sitting in money market, you're naturally just a conservative investor. So I think that you're going to see that money bleed into the market. And so it's going to perform kind of a base level support. You combine that with share buybacks coming out of corporates. And I think the outlook for 2025 is good and strong.
Katrina, we'll have you back very soon. Let's see how the rest of the year pans out. That is Katrina Dudley, Senior Investment Strategist at Franklin Templeton. Coming up on the show, NVIDIA, we'll dig a little bit deeper into the results. We've got Frank Lee at HSBC. He's with us next on Bloomberg.
countdown is on. Everything you need to get the edge at the end of the market day.
Big tech earnings kick off later this afternoon.
Gilead is coming out right now.
We have take two numbers. Back to the markets, right? Our bread and butter.
NVIDIA is one of the best stories in the tech space.
That actually matters a whole lot more.
It might shock some of your viewers.
You're watching The Close.
Get ahead of tomorrow's trading with The Close. Weekdays on Bloomberg. Context changes everything.
European countries need to think, do you want to compete as a small country or do you want to compete as Europe? I don't think they have a choice because the US and China have already started the race. And Europe needs to follow. There isn't a European company in the top 20 largest firms in the world. That is a problem.
But what does it mean for individual countries within Europe?
You can have more control and less growth, or you can have less control and more growth. If countries trust each other more and they build more European champions rather than each country having its own national champion, growth is going to be better, productivity growth is going to be better, the welfare is going to be better. But there is going to be less control at the national level. So right now, each European country wants to have its own telecom company, its own couple of large banks,
Its own bank.
its own large energy companies. And the question is, are you willing to surrender some of this control to European firms, which are going to be more productive, but you are going to have less control at the national level?
It's the world's second largest economy with a growing influence in global affairs. But geopolitical uncertainties, deflationary pressures, and questions about foreign investment linger. Bloomberg, the China Show, brings you the unmatched expertise you need to keep track of breaking news, in-depth market analysis, and the most influential newsmakers in and around China. Bloomberg, the China Show. Weekdays around the world, right here on Bloomberg. Context changes everything.
It's your Bloomberg Brief. I'm Manus Green alongside Danny Berger here in New York. NVIDIA extending its post-earnings drop. This is the chip maker. The outlook fails to keep investors satisfied despite a strong quarter. Frank Lee is the global head of tech and hardware for semiconductors over at HSBC. He's dropped his price target. You've shaved it by $5 from 200 to 195. You still have a buy rating on this. I mean, Frank, can you just give us some context here? Because there was a lot of hyperbole around the guidance, that it just didn't guide to $40 billion. How underwhelmed are you by the guidance? Let's start there.
Yeah, I think, going into this quarter, there was a lot of expectations that got ratcheted up. I think it was a solid set of results, but just quite not bullish enough for a significant beat and raise, as I think the market has been hoping to see. So in some ways, it's very similar to what we saw last quarter. But I think, there are some silver linings to take away from this result as well. For one thing, the Blackwell ramp is going, I think, fairly well. And in fact, the company has talked about, their Blackwell revenues for the fourth quarter could exceed what they were previously looking for. So, and there was a lot of noise, I think, the last couple of months about supply chain bottlenecks and delays. So that's a pretty positive takeaway from this.
I mean, Frank, you look at the stock market reaction, which, okay, isn't massive for NVIDIA the way it swings, but it's enough to drive yourself crazy to say this market was disappointed by 73% margins instead of 75. These are still really chunky numbers. I just wonder, Frank, is this kind of the new norm for NVIDIA, that they're going to put up huge numbers, but they're not going to do the massive beat and raise anymore, that this is the new normal?
Yes, I think that's a really good point. I think, the last two quarters, we haven't seen the significant beat and raise. That being said, though, I think the setup for next year is still very positive, and we still think there's a possibility that we will see a quite significant upside to where the market is, or most of the analysts are looking for next year. If you see what next year, the CapEx trend for hyperscalers continue to be quite positive, don't show any signs of slowdown. And also, I think the other key takeaway is the enterprise market is now a much bigger part of the end market. The hyperscalers now are probably a little more than 50% of their revenues, of data center revenues. But a year ago, this number was closer to 70, 80%. So it shows you it's a much more diversified customer base. And I think the last thing is just that supply chain that we see in Asia continue to see upward revisions. So that's also a very positive sign going into next year.
Part of the discussion, Frank, which is about whether you're at peak data center, but it is about where do you spread out and where does the evolution come to? Where do you see the next leg of growth beyond data center?
I think the data center story still has a long way to go. So I don't necessarily believe that, you need to look for something immediate beyond data centers. I think if you think about the first year of the AI story, it was really about just training the AI models. And now it's become a move to inference where NVIDIA continues to dominate. So I think, just that alone, I think, can carry them for quite some time. So I don't necessarily think we need to look outside of the data center space, because I think the investment cycle is still in the early stages.
Frank, Jensen Huang on the call was asked about the political landscape. I just want to read you what he said. Whatever the new administration decides, we will, of course, support the administration. What is the regulatory risk for NVIDIA at this point with a Trump administration coming in next year?
I think it is definitely, I think, a difficult question to answer to answer right now. But I think, as he said on the call, they will respond to whatever the administration's moves are going to be. So if that means higher costs because of the potential tariffs on the semiconductor manufacturing out of Taiwan, then that's what NVIDIA would do. They will have to basically find a way to pass on these costs to the customers or absorb some of it. So I think they will continue to basically navigate around whatever policy changes they are. But I think the fundamental story is unchanged, which is the demand is still strong. And I think as long as that remains the case, I think the story it doesn't really deviate from what has been for the last 18 months.
Frank, to what extent do you consider the delivery of power? Power is critically important for the building of the clusters, the American policy of keep building in America. How important is the Trump policy on power and the development of power for the escalation and the development of the data center and the clusters?
I think the power is definitely an issue that supply chain has encountered as well. That has, in terms of finding better solutions, is something NVIDIA is constantly trying to do with its roadmap. And I think they have continued to find more efficient ways. It will be, some sort of a stress on the overall power grid system. But again, I think the chips that are coming in the future are going to become, more efficient as well going forward. And I think so far we haven't really seen this as although it's an issue that's been well talked about and flagged, it hasn't really been an issue that's held back the overall deployment of data centers.
Frank, just quickly, Jensen Huang also joked on the call, almost every company in the world seems to be involved in our supply chains. Less than a minute here, but where among the supply chain do you like? If anything's going to get bid up with NVIDIA, where do you want to look to?
I think, you want to see where the biggest content growth opportunities are, right? And the ones that can ride along with NVIDIA. Obviously, there's a very deep supply chain in Asia, particularly in Taiwan with the semiconductor and then all the hardware assemblers. You also see some of that in the US in terms of, on the optical side, there'll be some content growth as well. So I think those are going to, along with memory is going to be another area where you're going to see significant content growth. So those are going to be the areas I think benefit the most.
Frank, we really appreciate that. Frank Lee there of HSBC after NVIDIA's earnings. Okay, let's get you an update now on tensions between Ukraine and Russia. Oil and gold are gaining this morning. Risk is selling off. Ukraine says that Russia fired an intercontinental ballistic missile at a central city in Ukraine. It'd be the first use of an ICBM in combat since its development in the Cold War. For more, let's bring in Bloomberg's Kevin Whitelaw, who joins us now. Kevin, this is something that actually moved oil markets. The news yesterday on Ukraine launching a U.S. long-range missile didn't. So is this escalation? What should we fear here?
Well, I mean, I think we first need to say it's not fully confirmed yet. This is what Ukraine has said has happened. Russia hasn't confirmed it. And at this point, we don't have Western, either U.S. or European officials confirming that this was indeed a use of this missile. But if it's confirmed, it shows that both sides are starting to up their tactics in the sort of run up to when Donald Trump is going to move into the White House. And I think that you're seeing an understanding that if there is going to be any kind of a conversation down the line about a ceasefire or some kind of a broader settlement, each side wants to have the best possible negotiating position. They want to be in the strongest possible place, and that means then trying to take whatever bits and pieces of advantage it can. For Ukraine, that's been trying to strike some of these ammunition sites and some of the other operating bases that Russia is using inside its own territory to stage attacks into Ukraine. And obviously, Russia is trying to show that it has additional ways to respond and additional ways to inflict pain on Kyiv. So it's a dangerous time, and obviously it's a cycle where you're seeing both sides sort of step things up in ways that are risky.
Kevin, we have a vortex that we are in between one administration ending the Biden and the new Trump administration arriving. To what extent now will the baton for de-escalation or at least keeping the status quo where we are, will it fall to the Europeans? We know Scholz has been on the phone. He was derided for that. Macron does not have the power. Meloni has the power in Europe. What happens to the voices of reason here?
Well, I mean, I think that the U.S. would say that it's simply trying to help put Ukraine in the best possible position, and if there is going to be some kind of a negotiation, and it's trying to deliver whatever weaponry and others it can before there's a risk that U.S. support to Ukraine gets cut off. I think, you know, for Europe, it has also been in that position of trying to make sure that Ukraine does get that support. So broadly, Europe has been supporting these efforts, and there's been conversations within the EU about the need to allow the use of Western weaponry deeper into Russia. There's not full agreement on that, of course, but I do think that the broad construct is understood, that there is a nervousness surrounding what Trump is going to do and how that's going to play out if he does indeed try to open some kind of a negotiation with Vladimir Putin.
Okay, Kevin, thank you very much. Kevin Whitelaw there. Markets are moving on the back of this story. Oil, gold, bid up this morning and moving over the past 45 minutes. Let's shift our attention back to Washington. President-elect Donald Trump still doesn't have a Treasury Secretary, but he has spoken with some of the contenders for more on the chase to win the position. Let's bring Bloomberg's Megan Crane around the desk with us this morning. Megan, we know some of these interviews took place yesterday. Hegarty spent the day with him at SpaceX on Monday, but yesterday was all about Wash and Rowan. Do we think we will get a decision before the end of the week? How close is it?
Well, it seems close, right? He's having second, third interviews with prime candidates, but it looks like Trump is really looking for the perfect candidate. And the problem is contradictory demands, you know, conflicting interests in what he wants, which is someone, you know, who's respected by Wall Street to buoy markets and, you know, keep sort of the system going. But he's also promised change, and he wants to satisfy his populist base that's interested in tariffs and crypto and sort of different, you know, sort of sweeping changes in how it works. And those two things it's going to be hard to find the perfect messenger for that.
And it does just stand in contrast to the flurry of other appointments that we've had. And on that, Trump has said that he's going to skip FBI vetting, something that has 60 years of precedent. What do we understand of the Senate's willingness, not just to let him do that, but do other things that Trump wants to do? For example, like recess nominees. How easy of a time is Trump going to have getting these appointments through the Senate?
Right. So I guess my theme this morning is sort of contradictory demands, because that is another great example. Senators are pretty loath to give up their power. They have, you know, a constitutional responsibility to advise and consent. That tradition stands with, you know, interviews and hearings, and those are all based on FBI background checks. Trump hasn't said he's not going to do them, but he also hasn't started them. So it's sort of one of those things that's a little bit unclear. He doesn't trust the FBI, doesn't trust the Justice Department. That's been a big part of what he's talked about in the past. But also, if you have private companies and private individuals doing the vetting, like who are they? Who vetted them, right? So it becomes less credible for the senators. So they don't necessarily want to give up their power, but also we don't have a long list of examples of the Republicans in the Senate really standing up to Trump. So, you know, how that works out is unclear at this point.
We have this op-ed from Vivek Ramaswamy and from Elon Musk in the Wall Street Journal. They're talking about a number of different things, but the real criticism is, of course, unelected officials making decisions, and they also want to drive to bring people back 5 days a week. This is a privilege that they say needs to be done away with.
Yeah, so interestingly, that's one of the things that they can really sort of implement pretty quickly, right? You know, they can, the president can say that people need to come back to the office 5 days. However, a lot of those organizations are unionized workforces and maybe have different work from home arrangements in their contracts. And I'm not necessarily sure that that's the best way to cut a lot of employees, because it's a pretty blunt instrument, right? Like, you're not necessarily cutting the people you want. You know, the ones who refuse to come back. So it's a little unclear how effective that would be, but it is something that they can do. It's something that they can certainly, and it would be really popular among the leadership of Washington, D.C., who want people in the office.
Well, again, it goes back to untangling the beast that is bureaucracy to sort out these things. Megan, we love having you in New York. Thanks for coming in again. That is Bloomberg's Megan Crane. We will set you up for your day ahead next.
Asia is at the forefront of some of the world's biggest stories. I'm Sherrian in Tokyo.
And I'm Heidi Stroud-Watts here in Sydney, where the trading day begins. We're here in the center of all the action to get you set up with the numbers, news, and knowledge you need for the day ahead.
The demand is indeed recovering. We've been waiting for this moment.
The opportunity of a century.
Join us on Bloomberg The Asia Trade. Weekdays only on Bloomberg TV. Context changes everything.
It's a multi-trillion-dollar industry. We'll show you what's happening in ETFs like no one else. Bloomberg ETF IQ, only on Bloomberg.
As we spend some time here on the broader presidential race,
let's focus in on European politics.
Makes you wonder how politics might play out.
It's the countdown to the market open as we bring you the first trades across Europe.
We'll debate the most important stories and what will drive the big investment decisions throughout the morning. I'm Guy Johnson.
I'm Kriti Gupta.
And I'm Anna Edwards. Join us every weekday morning for the opening trade, live at 7 a.m. here in London.
Only on Bloomberg. Context changes everything.
Get you set up for your trading day on this Thursday. We're going to get jobless claims 8:30 a.m. Eastern. Then we'll get existing home sales. That comes at 10 a.m. We also have more earnings. Deere before the bell, Ross Stores and Gap. Those come after the market close. We're going to get some more Fed speak too. Goolsby, Hammock, Bar. All of that kicks off at 8:45 a.m. Manis, what you got for movers?
Guess what? Kick it off with NVIDIA, extending their loss down over 3% now after the quarterly results. They just didn't hit those lofty expectations on the revenue side. We just had Frank Lee, he cut his price target to $195. And Snowflake shows jump, strong product sales and a growth outlook for them up 21%. And MicroStrategy on fire. The crypto stocks are higher this morning. You've got Bitcoin closing in on that $100,000 level. And MicroStrategy gearing up, we understand, to maybe buy a little bit more Bitcoin. That's it from Bloomberg Brief. Surveillance is up next. Good morning from New York.
Stefana. I am the owner of the family office and the company called Company I Limited. I also have a live streaming channel for startups. It's SG Trader, so anybody, we let startups to pitch investment community on our channel. I give them 3-minute pitch. We publish their video on our channel, and everybody who is interested, please welcome to send me your video, and I will roll for almost a month your video for all financial community. The channel is live, it's streaming live 5 days a week, from morning to night.
Another thing that startups need to look for is a market that is either started to undergo or is soon going to undergo exponential growth. I think this is actually related to one of the biggest mistakes investors make when evaluating startups. Investors always say, well, what's your growth rate? We care about the growth rate. Investors will forgive smallish revenue today if it's growing quickly. For some reason, people don't think about markets this way. But if you think about the most important startups, they are the ones that start in small markets that are growing very, very quickly. 11 years ago, the market for iPhone apps was $0. It's now huge. And I think if you only think about the TAM today, you'll make a big mistake. What you really want to do is identify a market that's going to grow every year and be able to ride that up elevator.
I will show you how to get the best funding for your startup idea. Let's get started. Here's the deal. If you have an amazing startup idea and need funds to fuel it, we're here to help. Simply send us a video where you explain your idea. Make it clear, concise, and compelling. Hook us in with your passion and vision. Don't forget to include your contact details so investors can reach out directly. This is your chance to shine and get your idea in front of people who can make it a reality. Imagine turning your startup dream into a thriving business. It all starts with that one simple step. So what are you waiting for? Grab your phone, hit record, and let your idea fly. The future of your startup could be just one video away. Remember, be clear, be passionate, and most importantly, be you. We can't wait to see what you've got. Let's get funded now.
Run without losses on the S&P 500. Your scores look like this on the S&P right now. We're negative by 0.25%. On the Nasdaq 100, we're down about a third. This stock right here, the only stock to watch this morning, Nvidia. Nvidia just a little bit softer, failing to beat, Lisa, some huge expectations.
Basically, the year-ahead forecast was higher than the average, but not as high as potentially some of the highest estimates, and therefore you're seeing a nearly 3% decline. We're all crying for it because it's only up 195% now year to date. But there is this question of how high is the bar for a company that seems to be gaining market share and frankly transforming a lot of industries. The problem still is demand is outstripping their ability to supply. Their sales are doubling and quadrupling. People want more.
In many ways, this is the market. It's about 9% of the Nasdaq 100, around 7% of the S&P 500, which explains why equity futures are just a little bit softer so far this morning.
And Bloomberg Intelligence is coming out and saying the concern over the forecasts are likely to be short-lived because of everything Lisa just outlined. When you look at this company, they missed analyst estimates on a quarterly revenue once in the past 5 years, is continuously exceeded expectations. If you're looking for maybe something to be a little bit worried about, is it the fact that their customer base is so concentrated? Is it the fact that maybe they are going to deal with tariffs or maybe more export controls when it comes to China? But this is just really on the margins of this story.
Do you want some worries? Check out the bond market yesterday. Here we go. Lisa getting excited.
Yeah, definitely.
Yesterday afternoon, it was very quiet, almost snoozy in the bond market, and then a 20-year auction happened. And it wasn't very good.
Yeah, just to put it this way, bespoke, put it this way. Simply put, demand was horrible. Everyone was coming out with this sort of drama. But here's the issue. It's a $16 billion of 20-year notes. The 20-year note has sort of been the bastard child of the entire bond market since it was reintroduced in 2020. This was the second largest underperformance when it comes to how much it sold off after it came out since the reintroduction in 2020. A real question here. Does this indicate waning potential for treasuries to be a haven at a time of great concern for inflation? Is this the hallmark of concerns of the bond vigilantes, or is this a messy 20-year auction at a time where, frankly, people don't know where it fits in their portfolios?
So we're totally on the same page. The 20-year is a very unloved maturity. I wouldn't use your language. Unloved maturity, the 20-year. But what it did tell me yesterday, Lisa, is just how concerned people are about upcoming auctions, how sensitive they will be to other auctions in our future.
The fact that an unloved 20-year auction is one that captures the entire bond market attention at a time when other auctions have actually done pretty well. This, to me, still is front and center. As much as we have seen a recent bid into treasuries, the fact that it's fading, even on some of the geopolitical concerns that have come back to the fore overnight, there is a question here. Are they really going to be the ultimate check on this president's policies? And are they actually getting concerned? Or is it basically the same story all over again?
This is why Game of Thrones down in Palm Beach, Florida is so important. Will it be Walsh? Will it be Rowan? Will it be Besson? Will it be Haggerty? We still don't know.
We still don't know. The decision is in flux, and it went very late into the evening. Scott Besson having a meeting with President-elect Donald Trump last night after he met with Mark Rowan and Kevin Walsh, but still no decision. Nancy Cook and Saleha Mohsen leading the coverage this morning. This is the line that stands out to me. None of the remaining roster of candidates were seen as perfect, according to people familiar with the information. no one is seen as perfect. He's still in search of his perfect treasury pick.
We'll come back to that story a little bit later. In the bond market right now, yields softer by 2 basis points, the 10-year just south of 440. Coming up this hour, we'll catch up with Cameron Dawson of New Edge Wealth, saying tech earnings estimates look too high. Matt Bryson of Wedbush, as NVIDIA's outlook falls short of big expectations. And we'll speak to the former Google CEO, Eric Schmidt, later this hour on the future of AI. We begin this hour with stocks falling after NVIDIA delivered a disappointing fourth-quarter revenue forecast. Cameron Dawson of New Edge Wealth looking ahead to 2025, saying tech earnings estimates are too high. Bloomberg Intelligence shows consensus forecast for tech going from plus 14 this year to plus 27 next year, even with NVIDIA going from 140 this year to 50 next year. We don't see the everything house in tech able to deliver that kind of growth. Cameron joins us now for more. Cameron, good morning.
Good morning.
Is the bar too high for 25?
I think the bar is too high for that re-acceleration in tech because we don't get it from the other big tech weights. You don't get an acceleration from Apple. You don't necessarily get a big one from Microsoft. You get a deceleration from NVIDIA. So it means that the market is pricing and effectively the everything else in tech truly re-accelerating. We're not quite sure if you can get that. So if you look at the 272 numbers for 2025 earnings, you look at tech, you also have to look at healthcare, which is the other area where there's a big acceleration that's priced in. It's set to go from 3% to 20% next year. But remember, expectations were for 20% this year, and all we got was 3%.
Let's stay on tech. AI, NVIDIA, doing really well this year. The rest of the semi space, not so good. How do you explain the difference between the two?
It truly is AI and everything else. If you look at the equal weight semiconductor index, it's actually down 3% this year, which tells you that there is still a malaise in the old industrial, auto, China, old manufacturing part of semiconductors. That does reflect this weak manufacturing environment where we've been in, where we've had this historically long stretch of a PMI sub 50. So the question is, we do think that PMIs will start to recover only because of better sentiment. We saw that post the election in 2016. Does that translate to better manufacturing activity on a global basis? Or do you get this offset from tariffs where you still see this malaise take hold and it truly stays this world where you only have AI demand and everything else is weak?
So basically, what you're talking about is the AI side of the story that's really powered this market. A lot of people have come on the show and said, they agree with you that probably expectations are too high for AI to keep leading, but that just gives everything else a chance to catch up. Those semis are going to actually have their turnaround day. You hear those types of words from the likes of Micron and Intel. Why do you think that's not the case, that the rest of the market will just play catch up, even as AI maybe doesn't grow quite as much as some people hope?
Hope does spring eternal, and we do know that if you look at these very cyclical semiconductor industries, we know that it's the most cyclical industry in the world, that you have been in this weaker environment for a couple of years. So the bar is lower for a recovery, but the big question still comes back to tariffs. Will you see companies still want to invest in big manufacturing plants that would support the demand for these semiconductors? If there's a question mark about where the tariffs will come from, where should they be? And so that's that offsetting factor. Yes, the demand has been weak, but does it remain weak because of tariff uncertainty?
So everyone who's come on the show since the election has basically said, are you bullish on the U.S. or are you really bullish on the U.S.? And then I saw your outlook for this upcoming year. And basically, you're casting a whole bunch of cold water on this. And you're basically saying that it's going to be choppy. Stop being so exciting. Either you get chop that could create some drawdowns, or you get a bubble, which will end badly. Why aren't you more excited?
Well, look, we're excited. We're still bullish on the U.S. and we're still fully invested. The point is, though, is that if you think about 6,400, 6,700, all of that glosses over the path you take to get there. And the path is going to be really important. We think it's going to be different than 23 and 24. 23 and 24 was broadly up and to the right. But what we see is that because you're going in with high valuations, high sentiment, high positioning, as well as stretched expectations for earnings growth, you have this big high bar to jump over, which just suggests to get used to more volatility. So what we're talking to clients about is to say that if that volatility comes, what will you do with it? The classic Walter Deemer line of, when it comes time to buy, you won't want to. So we're trying to get our minds in process of accepting this volatility, wanting to step into it versus running away from it. But certainly we think it's that wide choppy range, not necessarily low vol up and to the right.
Is it choppy because of underlying economics or because of policy?
Probably policy. And policy, of course, could drive and influence the underlying economics. We think that big sweeping tariff policy is certainly a dampener of growth. It raises the question around at supply chain disruptions, which could be inflationary. But those policy wildcards of, do we get tax reform, tax cuts or not? Do we get higher tariffs? All of these things are potential sources of volatility. And because you're trading at such high valuations today, there's not a lot of wiggle room to absorb that higher uncertainty.
So tariffs for you definitely are a tail risk. A lot of individuals have come on and said that. But a tax cut and a big tax plan, that would be a boost. How do you think about the sequencing of all this?
Yeah, well, that's the thing that we think it could be inverse from the 2016 sequencing, where we got tax cuts first and then we got tariffs, and that's one of the reasons for the weaker market that we had in 2018. This time around, tariffs could happen first, and we still have a big question mark as to whether or not you even get that corporate tax cut, simply because you are negotiating $4.7 trillion of existing taxes with a very slim majority in the House. A big question mark if you can get us down to 18% on the corporate tax rate, given everything else you're negotiating.
Let's finish on Bitcoin. Just took out 98K, all-time high, multiple choice. A risk asset on steroids, an important diversifier for portfolios, or a proxy to play some huge momentous societal shift over the next few years. Which one is it?
D, A, and B. Meaning that we think it is definitely a liquidity proxy. This is a proxy for how much liquidity is sloshing around in the market. We certainly have seen that play out in other cycles, that when the Fed is removing liquidity, Bitcoin is typically done poorly. This is a world that, given the Fed is cutting rates with financial conditions so easy, that is supportive of this kind of asset. We think it is also a psychological commodity that captures fears about dollar debasement, the fact that you have high fiscal spending, the fact that you're talking about even more monetary spend or stimulus, which just supports this notion that there are people who are afraid of dollar debasement, and thus this is their way of being able to get access to that risk.
So Lisa would like to know some form of inverse correlation between the performance of a 20-year auction and Bitcoin. Is that right?
All I can say is a psychological commodity. Tulips were a psychological commodity. You could say pretty much anything. Or how
you're going to get so much love mail this morning.
Or I'm not just saying that crypto is tulips, but I will just say that a crypto platform founder of Tron, Justin Sun, bought a banana that was duct taped to a wall for $6 million yesterday.
I saw that headline.
So I'm just looking at this and I'm like, is that psychological kind of commodity, sort of to ease your fears?
I think that that is the bubble scenario into 25, is that we get a spark of speculative fervor. And that is the scenario where you could see runaway markets because people start YOLOing on bananas taped to walls. And that could be something that would make its way into broader equity markets, where you see valuations push up into even more rarefied air.
You don't sound like a crypto purist at all. I remember these conversations years ago when we were trading down near 10K. Same conversations, and here we are up by 100.
Totally. I think that anyone who's been bearish on crypto has been humbled massively. And there's a lot of questions around exactly the idea of blockchain and how it could be used in supply chains and across a whole host of different asset classes. So there is a lot of value here.
That's a good cleanup effort, that one right there. Bitcoin right now, 98K, all-time highs, up this morning by around about 4%. Cameron, thank you.
Thank you.
Good to see you. Thank you. Cameron Dawson of New Edge Wealth. Let's get you an update on stories elsewhere this morning with your Bloomberg Brief. Here's Danny Berger. Hey, Danny.
Hey, John. U.S. prosecutors have charged Indian billionaire Gautam Adani with helping drive a massive bribery scheme. The charges allege that Adani and other defendants promised to pay more than $250 million in bribes to Indian government officials in order to win solar energy contracts, and then concealed the plan in order to raise money from U.S. investors. It's a stunning blow to one of the world's richest people and India's most powerful businessman. Volkswagen is bracing for an employee walkout. Company leadership and union members are still at odds over how to restructure Europe's largest car maker. VW, for its part, is seeking much bigger reductions that it insists are needed to slash excess capacity, including selling 2 car plants in order to cut costs. Talks will continue today, with warning strikes expected to start in December. Sources tell us that Starbucks is exploring options for its Chinese operations, even the possibility of selling a stake in the business. It's been speaking to advisors about ways to grow its operations in China. That includes the potential introduction of a local partner. Starbucks is still evaluating its options and hasn't made a decision about whether to proceed. That's your brief. John.
Hey, Danny, thank you. More from Danny in about 30 minutes. Up next on the program, NVIDIA's tall order.
I actually think that the results are great, right? And what happens is you have these lofty expectations, and so it's hard to beat lofty expectations. It's literally their game right now. And of course, people will catch up eventually, but I think that they're too far away.
That conversation is up next, live from New York City this morning. Good morning.
Middle East and Africa. Vibrant resources and high-yield investment opportunities abound. Join me on Horizons Middle East and Africa for the stories, newsmakers, and insight from this exciting region. Now weekdays, only on Bloomberg.
Jumpstart your trading day on Bloomberg Open Interest.
2 hours of single stock stories that are driving the opening bell action. We'll take you to Wall Street, Main Street, the C-suite, and beyond.
These are companies that are growing their market.
The great companies in the U.S. are the companies hitting the cutting edge. That's a different story.
Get the inside track on what's buzzing in markets.
With the players who are shaping the narrative.
If you have bad earnings reports, you're going to get punished.
They're not buying what the industry is selling. Join us on Bloomberg Open Interest. Every trading day, only on Bloomberg.
Key investors, top executives, global innovators. Join me for in-depth conversations with the biggest newsmakers on the day's top stories. Insight with Haslinda Onen, only on Bloomberg.
Equity futures right now on the S&P 500 negative by almost 0.1%, recovering slowly. In the bond market, yields are down by, let's call it 2 basis points. The 10-year fall, 39. Under surveillance this morning, Nvidia's tall order.
I actually think that the results are great, right? And what happens is you have these lofty expectations, and so it's hard to beat lofty expectations, but they did give you that, extra 2% in either direction, and they're within the range of the outlook for Q4. They're the #1 supplier of chips to hyperscalers, to quantum computing, to supercomputing, to data centers. I mean, it's literally their game right now. And of course, people will catch up eventually, but I think that they're too far away.
So here's the latest this morning. Nvidia shares inching lower following the company's blockbuster earnings report. The AI giant sales forecast falling just a little bit short of the highest estimates, despite reporting strong demand for its Blackwell chip. Matt Bryson of Wedbush writing, given the quarter's strength with management's commentary also seemingly addressing any minor investor concerns, we see no reason to shift our positive outlook on the stock. Matt joins us now for more. Matt, good morning to you, sir. Thanks for making some time for us this morning. What did you learn yesterday afternoon?
I think we learned that NVIDIA is still executing amazingly well. Look, they beat numbers again. Kind of consistently, they've been beating by $2 billion. They did better than that. They gave a guide that maybe was a bit light of the most optimistic forecasts out there. But when they give that guide, again, they've been beating consistently by over $2 billion. So, are they really guiding for 37.5? Or are they really guiding for closer to 40? And I don't think anyone would be disappointed with the latter.
Matt, it's pretty clear they don't have a demand problem. There's been some questions about supply over the last few quarters. Where are we now? Did you get enough clarity yesterday afternoon?
Yeah, so I think in terms of Hopper, which is their current chip, that all supply issues have been resolved, and that there is plenty of availability of Hopper. In terms of ramping Blackwell, you'd call it a supply problem in the sense that they've said they're going to be short product for the next couple quarters, but I think it's rather a demand problem. where they're ramping as quickly as they can, and they just can't meet the amount of demand from the large customers out there for that new Blackwell chip.
Anne-Marie mentioned this earlier in the show, and this really is a main concern for a lot of people, that the concentration among the hyperscalers is increasing. That you saw the share accounted for by the customers, including Microsoft, AWS of Amazon, as well as some of the other cloud providers, accounting for now 50% of the overall sales versus 45% rather from the prior period. Does that concern you?
It doesn't concern me in the sense that if you look at total IT spend out there, the cloud providers are becoming a larger and larger portion of total IT spend. Also, when you think about these large language models that are being trained, I tend to believe that at the end of the day that maybe there's 3, 4, 5 large models that end up dominating. And so again, those customers are going to be those model builders are going to be your largest customers if you're NVIDIA. And so it makes sense to me that there's going to be some concentration. So I mean, it's only a concern in the sense that if you lose a customer, that's a problem. But I think it's the nature of the market versus there being specific risks to NVIDIA.
So what is your main concern, Matt, at this point? Because people are looking for concerns, basically. They're looking for a reason to consolidate some of their gains after almost the shares doubling in terms of valuation. You see incredible gains when it comes to just sales in general. Is there something that does create a concern for you that maybe they are reaching the limit, or do you just basically think that they're sandbagging the market once again?
I think that they're guiding the same way they've guided, so that they're leaving themselves a fair amount of cushion and setting themselves up to beat expectations. I think from a concern standpoint, it's not so much about this quarter, next quarter, the quarter after that. I think we're going to see those large customers take lots of Blackwell chips. That's going to allow them to grow revenue. They gave us a path to better margins. I think if there's a concern, it's end of 2025, 2026. So we're still waiting for a wave of applications based on generative AI to show up. And at some point, you need those applications to show up. You need generative AI to start creating a lot of revenue to justify all this CapEx. And so I think the concern is really, if those applications don't show up, then do we get this worry that at some point spending doesn't continue? But that's not, again, that's not this quarter, that's not next quarter, that's not 2025. It's really heading into next year.
Matt, do you have any sense about tariffs potentially with the incoming administration and how that could constrain NVIDIA's China business?
So I think from a tariff perspective, NVIDIA has no choice but to use Taiwan Semi. So if there's a tariff that is slapped onto everything, they're going to end up most likely something's going to be tariffed. It might be the NVIDIA chip. It might be the server the NVIDIA chip gets built into over in Asia and is imported to the U.S. I don't see that NVIDIA has a way around that. In terms of their China business, I think it depends on how the new administration thinks about these kind of processors that NVIDIA is shipping there. They've already restricted the amount of technology that NVIDIA can ship. Potentially things get harsher. NVIDIA, I think, told us China was around 20% of revenues, if I remember correctly. Some of that would be at risk. Some of that, though, is gaming. So it's not all data center. It wouldn't all be at risk. But that's kind of how I'm thinking about things.
Well, what about the idea of like any disruption to the supply chain that it's using, so mostly in Taiwan?
Yeah, I don't think that there's a substantial risk of disruption to the supply chain, right? So if NVIDIA's supply chain was disrupted in the sense that TSM couldn't produce, it's not an NVIDIA problem. It's a worldwide problem. Because at the same time now, Apple can't make a phone. You can't buy an AMD processor. So 30-some-odd% of servers, similar amount of PCs aren't getting shipped. TSM produces a lot of silicon going into automobiles, the end consumer devices. So this is a problem for the world. I don't think it's an NVIDIA problem.
Hey, Matt, appreciate your time, sir. Thank you. Matt Bryson there of Wedbush on the latest following NVIDIA earnings. That stock recovering just a touch. We're down by a little more than 2%. Broader equity markets recovering as well. Some earnings already this hour. They come from Deere. It's a tug of war, a little bit of tension between a really big beat for earnings and a very tepid forecast looking out, Lisa, to 2025.
And it's the why that's really interesting. You can see shares are doing okay, and Deere's trying to recover after a trough following some of the boom during the pandemic and the media aftermath. But this, to me, I thought was fascinating. A real question mark with Deere around what tariffs on goods that Deere makes. Remember, this is the biggest farm manufacturing goods product. Any products that they make in Mexico would be tariffed before coming into the U.S. And that's part of the reason why they had a more tepid forecast, with the CEO saying, amid significant market challenges this year, we proactively adjusted our business operations to better align with the current environment. This, to me, is what we should be looking for in a lot of earnings. What type of telegraphing about what kind of scenario analysis CFOs are doing around tariffs?
Well, we know a little bit because in September, President-elect Donald Trump, when he was campaigning, told us how he felt about Deere, and basically said if the company does not abandon its move and idea of putting some production from the Midwest to Mexico, the walls were going up. This is why USMCA, trade between Mexico and Canada, is going to be so interesting in how he deals with that on day one.
It's going to be interesting to see how the tariff story plays out more broadly for this company, for farmer sentiment, not just for where they produce the tractors if they go down to Mexico, for sentiment for the farmers as well, given how much volatility we saw off the back of that trade war with China last time around.
The fact that they're not necessarily investing as much, is it because there is this concern? At a certain point, how do you plan for planting crops if you aren't sure what kind of demands or walls are going to be up in terms of exports? And that, I think, is the reason why the Deeres of this world are very important to watch.
Deere right now in early trading positive by 1.2%. Up next on this program, we'll catch up with the DT Barve of Bank of America after they slashed their expectations for Fed rate cuts heading into next year. From New York City this morning, good morning to you all. This is Bloomberg.
I think one of the dirty little secrets of credit is that the businesses generally don't pay you back, right? The markets pay you back, M&A pays you back. So what is the most important thing is to always make sure that the borrower is worth more than the loan. And as long as the borrower is worth more than the loan, then it might be a rocky ride, but you're going to get your money back. And this world where there's these disruptive companies that have, let's call it 100, 200, 300 million of ARR, are looking to not raise equity capital because of the fact that they raised it in 2021 or 2022, and no one really wants a down round. But there's a lot of capacity in the capital structure to have, let's call it a structured solution. We think that there's a lot of opportunity with those businesses.
Welcome to the world of decentralized finance.
Massive outperformance from Bitcoin.
Bloomberg's covering all things crypto, the people.
The tectonic shift emanating from Washington.
All we're looking for is clear rules and the ability to build in the United States.
Crypto shouldn't be partisan.
The transactions.
Really a record-breaking moment.
Crypto VC is back.
And the technology.
It's really the beginning of a global on-chain economy.
And if America doesn't embrace it, we're going to be left behind.
Bloomberg Crypto, only on Bloomberg.
In a commercial break, equities very briefly turning positive, just about unchanged on the S&P 500 now. On the Nasdaq 100, only down 0.1%. With Nvidia, yesterday after the close, dropping numbers and dropping initially by something like 4 or 5%, and we've recovered since then.
Yeah, basically people looking at the numbers and realizing, okay, they've doubled their revenues, okay, they really are still beating across the board, and they probably are lowballing estimates going forward. So how much can we really dampen enthusiasm for this company? There has to be a big sea change in this company before you start to see some of the hopes truly dampened, given the fact they've still beaten every single earnings period except for, what, one over the past couple of years. So, still pretty good.
Stock is down about 2.2%. It's up this year by something like 200.
Yeah.
So it's doing okay. It's doing better than okay. Let's turn to the bond market. Switch up the board, turn a page, and get to this bond market story. The 20-year issue yesterday had an auction from an unloved maturity. Lisa calling it something else. I'm far more polite.
Oh,
I
yeah.
won't go there.
Yeah,
Yeah, that's
you're
me.
just,
That's
acme
me.
of politeness.
It's a very weak auction yesterday, which triggered a sell-off in bonds, pushing the yield higher.
Yeah, basically people coming out and saying it was horrible demand. Just to put this into some numbers, the auction tailed by about 3 basis points, meaning that after it was sold, the yield was about 3 basis points higher than when it was before it sold. If your eyes are glazing over, basically this is really terrible. This is the second worst since this was reintroduced in 2020. And a question here about whether this indicates a broader tempering of some of the enthusiasm we saw for a hot second for bonds, or if this is just an unloved maturity with some choppiness.
Some of these issues breathing some life back into the US dollar, the euro weaker, 105.27, also in some way contributing to this move. Bitcoin, all-time highs, up by 3.7% early this morning.
Wait, do you actually think that the auction had anything to do with Bitcoin being up almost 4%?
Deficit concerns and the debasement of the dollar are a factor in some people's long view of Bitcoin.
I mean, I guess that it's hard for me to really understand exactly what is driving Bitcoin, considering that we might get a crypto czar from President-elect Donald Trump. So that also could be generating some enthusiasm, this idea that we're going to make crypto great again in the nation. There is also this bigger sort of gut check that when there were geopolitical concerns, bonds were bid, gold was bid, Bitcoin was not. So even when there is some sort of geopolitical hiccup, we're not necessarily seeing an obvious reaction in crypto. It's more confusing. It's a psychological commodity safe haven that we were just talking about.
We do know that Trump talked to the Coinbase CEO, Brian Armstrong, and I'm just sitting here wondering, do we get a crypto czar in the West Wing before we get an announcement of the Treasury Secretary? And maybe that's why Bitcoin is getting a little bit of love.
I'd love to know what their policies would be. Bitcoin crossing 98K for the first time ever a little bit early this morning. Under surveillance this morning, Nvidia's outlook falling short of big expectations. The chip maker predicting fourth quarter sales of about 37.5 billion, with analyst estimates ranging as high as 41. The CEO, Jensen Huang, saying the company's Blackwell chips are on track to ship this quarter. Lisa, that stock down by 2.2%.
So its sales are poised to double for the second year in a row. It now notches more money and profit than it used to generate in total revenue. You're talking about a company that keeps quadrupling and quintupling its earnings every single year and dwarfs the market share of all of its competitors combined. When you start talking about maybe, have they reached the limits to their exponential growth just simply by virtue of how big they've gotten, okay, you can have that conversation, but it's not exactly going to rip the rug out from under this name.
Two potential issues is just the concentration of its customers and maybe down the pipeline what's going to happen with supply chains, with tariffs, with an incoming administration. But Dan Ives yesterday, after it came out, said print the press release, put it in the Louvre. It is going to be green. The AI revolution is just beginning. And he gave his whole, it's 9:30 p.m. at a party that ends at 4 a.m. in the morning.
Doesn't he say that every quarter?
Sometimes it's 5 a.m.
You know, sometimes it's 5 a.m. Okay, I love Dan, but I basically hear that every quarter. It's working. Can't argue with it. The stock is down by 2% this morning. It's up big time through 2024. Let's turn to this story. Ukraine saying Russia launched an intercontinental ballistic missile in a central Ukrainian city. The strike appears to be the first reported use of an ICBM since Russia invaded Ukraine, marking another escalation in the war through this week.
This is a serious escalation, and I think what we can expect is there's going to be tit-for-tat escalations given the fact that we have an outgoing lame duck president that gave Ukraine this ability to strike into Russian territory. And then we have President-elect Trump saying he wants to end this. So if you know that there's an end point from the American president that wants to end this war, you're going to do whatever you can to get yourself into a better negotiating stance. I will say as well, the U.S. Embassy yesterday said that they received specific information. They were expecting a potential air attack and was telling all U.S. citizens in Ukraine, when you hear those sirens, because I've been there, sometimes you hear those sirens and people are so used to it, they shrug it off. They said, when you hear those sirens, you have to go to a bomb shelter.
What strikes me is that markets are basically considering this the escalation before the de-escalation. What would change that? And that's my key question, because we're talking about some pretty significant moves that would be considered escalations in a prior iteration of this conflict.
Couldn't agree more, and we've seen a series of them over this week alone. Let's get to this story. President-elect Donald Trump's search for a Treasury Secretary continues, with Apollo's CEO, Mark Rowan, among the contenders for the role. If selected, Rowan's exit would put a non-founder in charge of Apollo for the first time in its 34-year history.
Yeah, that's actually a really key question, considering how much he's grown Apollo. There's a bigger issue of whether he actually makes the market for private assets that much more attractive at a time where there seems to be a battle between banks looking for fewer regulations so they can compete with them, and then the private investment market looking for some sort of further establishment in the financial system. Nonetheless, a real key question for a lot of these potential nominees: how do they divest of assets that they have with their firms?
He is one of the best operators in financial markets anywhere on the planet.
100%.
If he gets this job, it would be a phenomenal pick. There are other really strong candidates as well, and I think I repeated this several times yesterday. Any of the four would be a tremendous, I think, for the United States of America. For Apollo alone, though, we've got two co-presidents kind of ready to go. Scott Kleiman, Jim Zelter, two people we know well on this program, ready to take the helm if they need to.
Right, so if he slots in, they will have a succession plan all ready to go in place. For Mark Rowan specifically, this would be a huge tax incentives because you have to sell, but he can, defer the tax payments on that. Interesting, when I heard his name being floated around the Trump circles, I went back to a sit-down he gave at the Economic Club of D.C. with David Rubenstein, and when he was asked, if you were ever tapped and asked to go serve your country in any capacity, Treasury, the Fed, would you go? No hesitation, a resounding yes.
Watch this space. Let's turn to the Federal Reserve. Investors bracing for a busy day of Fed speak. The team over at Bank of America revising their outlook for the Fed, writing, we still look for another 25 basis point cut in December. We then expect the Fed to slow down to a quarterly pace of cuts based on the data flow alone. For next year, we forecast 2 more 25 basis point cuts in March and June. Aditya Bave of Bank of America joins us now for more. Aditya, it's good to see you.
Thanks for having me.
What's behind this change, and help us understand the mix between better than expected data over the last few months and anticipating policy changes over the next year?
Right, so let's just start with the data. We've been really impressed by productivity growth in the US over the last several quarters. Starting from before the pandemic, we're now growing at 1.9%, almost 2% in just productivity, right? And that's significantly above where we were before the pandemic. So acceleration relative to the previous cycle and significant divergence from the rest of G10 for the record, right? Most other countries have actually slowed down on productivity. So that's very impressive. It's a combination of new business formations, CapEx, hybrid work, really working in certain job functions. So you put all of that together, that means higher potential growth, and then obviously higher terminal rates as well. On the side, inflation's also been a little bit sticky. That's another reason why the Fed probably wants to slow down. You heard that from Fed Chair Powell last week. So just based on all of that information, they probably sneak in a cut in December, although even that's gotten to be a close call now, and then we think they slow down to a quarterly pace. After that, you get to the risks around potential tariffs. Huge uncertainty here. We have to pick some base case, but things are going to evolve quickly after January. So based on the tariffs, we think if as much as has been sort of threatened is actually announced, then you could get them pausing by June.
So is this basically what you're reading into the Fed speak that we've been hearing? A hesitance in terms of cutting too quickly because there is this feeling the neutral rate is higher, the economy has been doing better than they previously thought, and there's this policy risk that they don't want to talk about, they don't want to say that they consider, but they absolutely do consider and could potentially be inflationary.
They could be considering the policy risk. It's hard to say because, as you said, they just don't want to talk about that, and that's very reasonable. But just based on the data, they can say for now that we're going to slow down, and then we'll figure things out as the policy priorities become clearer.
So is your base case now that they're going to skip next month and that basically they're going to take a look at whether the risk of reinflating inflation is once again very much on the table?
So our base case is that they do cut in December, but after that they skip. So they skip January, right? We have cuts in December, March, and June. And December is admittedly a very close call. It's going to depend on the jobs data. It's going to depend on CPI and PPI, which we get before the December meeting. But for now, we think they sneak in that December cut. Markets are priced around 60-40, which seems fair to us for now.
So there's a larger question here, and we've been asking on the show for a number of weeks, which is there a signal from the fact that the long end of the yield curve, that longer-term bonds, that yields have gone up so much since the Fed cut rates by 50 basis points and then again? Do you think that they have to reference that essentially there's been a real tightening of financial conditions at the places where a lot of the consumers who got hurt by it feel it the most, like mortgage rates?
Yeah, we thought the 50 basis point cut was a mistake, to be honest. We didn't think it was necessary. Obviously, that's easier to say with the benefit of hindsight, but markets are now saying we're concerned about inflation, we're concerned about a higher terminal rate, and that means long-end yields move up, right? And markets are also concerned about issuance because of the potential for more fiscal stimulus.
If the Trump administration moves very quickly with tariffs, do you think there's a chance that we see no hikes next year? No cuts?
No cuts. Everything's on the table, to be honest. So one of the things that we said in our report is that our base case is sanguine, but our conviction is low. So I think really everything is on the table, and we're only going to learn more as we kind of get a better sense of where policy is going.
Do you think you have a grasp at all on what the sequencing could look like in terms of tariffs and tax cuts?
There's many ways to think about this. One would be that tariffs are easier to do quickly because they can be done mostly via executive action. Another is that they might want to, time them sort of simultaneously just so that any potential downside from tariffs is offset by upside from potential tax cuts. So there's a few different ways of thinking about it.
I still don't think we appreciate how quickly they're going to move in the next 12 months. They could move really quickly in the first few months.
Absolutely, because when it comes to things like tariffs, it's that unilateral executive order that President-elect Donald Trump could rely on in January. And they've been doing the work leading up to this potential win. Maybe not him and his very close team right now, but other individuals who had worked in the Trump 1.0 that were thinking about, I might go back in.
You get the impression they might be ready to hit the ground running. Aditya, it's good to see you. Thank you, sir. On the outlook for 2025, Aditya Bhavid there of Bank of America with an update on stories elsewhere with your Bloomberg Brief. Here's Danny Berger. Hey, Danny.
Hey, John. Archegos Capital Management founder Bill Huang has been sentenced to 18 years in prison for fraud and market manipulation. This summer, a New York federal jury found the 60-year-old guilty of manipulating stock prices and defrauding banks. The Archegos meltdown in the spring of 2021 led to the downfall of Credit Suisse, caused significant losses at Morgan Stanley and UBS. The Justice Department and a group of states have proposed major changes to Alphabet's Google, including a forced sale of the company's Chrome web browser, confirming Bloomberg's earlier reporting. In a proposal filed late Wednesday, the DOJ argued that a sale would free the search market from Google's grip, while also seeking to impose restrictions on its AI models. Google said the proposals would harm Americans' privacy and security and hinder Google's investments in AI. Donald Trump's transition team is holding discussions on whether to create a new White House role dedicated to cryptocurrency policy. Sources say Trump's team is vetting potential candidates for the role, with crypto executives visiting Mar-a-Lago in recent days, where the president-elect's team is holding personnel discussions and interviewing prospective candidates. Sources say that crypto industry advocates are pushing for the role to have a direct line to Trump. That's your brief, John.
Danny, thank you. More from Danny in about 30 minutes. Bitcoin this morning, briefly, through 98K. Up next on the program, the rise of AI.
The real fight now is AI.
Winning the AI battle for the United States is paramount from a military and an economic perspective.
This is potentially an industrial revolution for America.
Next on the program, we'll catch up with the former Google CEO, Eric Schmidt. From New York, this is Bloomberg.
In case you missed it on Bloomberg Technology.
We're excited to really change the expectations for space companies where you have this always-on, reliable, and frankly dynamic satellite connectivity that you would expect of your power grid or of your cell phones. And so we think that this is a huge opportunity space, and our first contribution to it is through shared infrastructure.
You can see this whole ecosystem developing, and you have an exponential growth right now because easier access to space means more demand for space, and that's the definition of an exponential growth function. So if you think about someone like Varda, who is only possible now because access to space is cheaper and easier, we're demanding more access to space.
I think that's what's so exciting from a business perspective, is the fact that if you can do it, you're one of the few numbers of organizations in the history who've actually pulled it off. And so it creates a very defensible position, because again, space is very, very hard.
Don't miss Bloomberg Technology live every weekday.
David Weston. Join me for the next generation of Wall Street Week, telling stories of capitalism from business, markets, economics, tech, and climate. Each week, we'll go on the road for a look at what lies behind the headlines of today and what will likely be the headlines tomorrow.
Above all else, is emissions.
Done nothing but grow immensely. To me, that's an extraordinary sign.
We can be the change that we want to see.
Watch the all-new Wall Street Week. More than what you need to know, it's what you need to think about.
Good morning. This is Bloomberg Surveillance.
Welcome back to the opening trade.
This is Bloomberg Technology.
This is the Asia trade.
You're watching the close. Welcome to Balance of Power.
This is Bloomberg.
Bringing you up-to-the-minute financial news whenever and wherever it happens. I'm Michael McKee at the Federal Reserve, and this is Bloomberg.
Live from New York City, welcome to the program. Here's a snapshot of the price action for you. Equity futures on the S&P up by close to 0.1%, turning positive. And Nvidia was down by 4 or 5 percentage points after the close yesterday, recovering through this morning. In the bond market, yields down by close to a basis point, the 10-year, 440. Under surveillance this morning, the rise of AI.
The real fight now is AI.
Winning the AI battle for the United States is paramount from a military and an economic perspective.
This is potentially an industrial revolution for America, where the artificial intelligence infrastructure, which is wildly insufficient for AI adoption, that could come very quickly.
Whether it's chips, technology, AI, and there's going to be very little to no grounds for kind of movement with China. We are going to be at an economic kind of Cold War with China.
So here's the latest this morning. Leaders in artificial intelligence preparing for a second Trump administration. The build-out in AI, fueling competition for chips energy, and raising tensions with China. The former Google CEO, Eric Schmidt, joined us on his latest book, Genesis, Artificial Intelligence, Hope, and the Human Spirit. Eric joins us now for more. Eric, welcome to the program, sir. I want to pick up on that one word, hope, and ask you how much hope I should have that this goes right, and start with this quote from Foreign Affairs magazine. It reads as follows: in cases where some humans might face off militarily or diplomatically against a highly AI-enabled state or against AI itself, humans could struggle to survive, much less compete. Such an intermediate order could witness an internal implosion of societies and an uncontrollable explosion of external conflicts. So you've got to calm me down, Eric. Should I have hope that this plays out well?
Well, let's start with a hope that, by the way, your show is incredible. The previous guest talked about 2% productivity. Imagine that productivity goes to 5% a year because of this technology. So there's every reason to think that there's enormous land, businesses, inventions, science, health, and so forth to get invented. But the same is also true for the invention of conflict and war. And if you think about it, it makes absolutely no sense to put somebody in a fighter jet up in the air and have them be shot at by another missile. It makes much more sense for that fighter pilot to be sitting on the ground and having a swarm of the equivalent of those jets, let's just call them powerful robots, powerful drones, that act in synchrony to achieve the objective of this attacker or to defend yourself. And the future of war is autonomous and networked and AI-driven.
This is something that a lot of people have focused on, in particular, how the U.S. is going to evolve in this manner, as well as how China is going to evolve in this manner, how they're going to use some of the space satellites to help coordinate that effort. Eric, do you feel like right now one superpower is winning versus the other? What is the best way to gain preeminence in a military AI sphere?
Well, when Dr. Kissinger and I went on his last trip to China, I was convinced from that meeting that China was 2 to 2.5 years behind us, but I am now wrong. It turns out that in the last couple of weeks, China has brought out software models, what are called large language models, that are rivals of the best American ones, which I never thought would be possible. One is called Qwen, another one's called Hongyang, and it looks like they've caught up, or they're very close behind. And it looks like China has decided that it's another part of its industrial policy, along with its focus on cellular, dominating the battery industry, dominating the car industry, et cetera. So they're willing to spend the money. What's interesting is that it does frame the narrative of China versus the U.S. as the defining narrative. And one of the more interesting questions, which we discuss at some length in the book, is what happens to deterrence and what happens to all the other 195 countries that are not China and not the U.S. These questions are really important because the power of this technology upends society in so many ways, economically, the way we govern, the way we reach, language, and so forth and so on.
So there are a lot of questions within this, and this could be a half-an-hour discussion. But one of them is who should be financing and who should be leading the national efforts to gain preeminence in this sphere. And you have to wonder, you talk about China as a state-organized, state-funded type of effort that is coordinated in that manner. How should it be directed in a place that does consider itself capitalist, like the United States?
Well, the Chinese model is what is called civil-military fusion, where they subsidize their biggest companies. No one in America, not even in the companies, thinks that the largest American companies need to be subsidized. But let me make an argument that if general intelligence, that is human intelligence, is to be invented, it should be invented in the United States and under control of Americans and the American government. And I don't mean managed, but I mean under the legal control of our country and our citizens and our democracy. And getting there first is a big deal. A number of us have talked for some time that there should be an AI for America initiative where the government works closely with the private companies and figures out a way to make sure that we are ahead of time. In truth, however, the financial industry that you all invented, for which we are incredibly grateful, has been incredibly generous in terms of the ability to fundraise the billions of dollars that are required. And I should state, by the way, that you guys have done such a good job in raising money, and we've done such a good job in actually getting the computer scientists around the world and the data and so forth and so on. What we now need is energy. We are prolific consumers of energy, and we're going to run out. One estimate is that the U.S. will run out of all sources of energy by 2028 at our current growth rate.
There's another topic you discuss in this book, which is AI to check AI. How can that work?
if you think about it, one of the things that happens is in AI systems is you have compositional generations. What happens is you take one piece and another piece and you interlink them, and they've never been linked together before. And it looks like when you combine those two, you get emergent properties, right? So that's in and of itself interesting. So the question is, what is the limit of that? How far can that system go up? I think it will get there. And I think that it's probable that we can build systems that are, the technical term is super intelligent, where you have a single system that is at the 90th percentile of physics, math, chemistry, and arts, and so forth. No human can do that. It looks like these systems will be not only available in the next 5 years, because we already have examples of passing these tests already, but also that they'll be broadly available for all of society. That has huge implications. We've never had an experiment where each and every one of us has a polymath, you know, the Einstein-type scientist at our beck and call. And furthermore, that scientist, whatever you want to call him or her or it, is capable of writing code, doing agents, and making things happen.
How do you think the United States competes with China when we have an incoming administration that wants to put up tariff walls, and even this administration who's been putting export controls on some of our high-tech semiconductors?
I am not in favor of broad tariffs. I never have been. I'm the son of an economist and a grandson of an economist. And tariffs are essentially taxes. What I am in favor of is restrictions or limitations for strategic reasons. It's really important that we win in this race against China. And so the things that the Trump administration and Biden administration to limit, for example, hardware access were really smart. And I know because I was part of a commission that recommended it way back when. And it in fact was adopted. Great job. So the question here is, ignoring the tariff question, which I just don't like, and I think is just another tax. How do you control and limit what China does, and how do you amplify what America does? And you sit there and you go, well, you're doing pretty well, right? Everybody's making a lot of money. There's all this growth. NVIDIA's doing well. All the tech companies are doing well. But let me explain what happens. You have a slope that's like this, and it keeps going up and up and up with humans. At some point, the industry believes that there will be AI scientists, that is non-human scientists, and he or she who gets there first gets a slope like this, and all of a sudden, boom, right? We're really, really growing fast. These network effect businesses are what we do in our competitive environment against each other under U.S. regulation. I want that to be true globally for the U.S.
Eric, I can tell you we're all in favor of having you back soon to continue the conversation. Congratulations on the new book, sir. We appreciate your time. The former Google CEO, Eric Schmidt. Up next on the program, coming up, Gandhi Chowdhury of BlackRock, Monica Guerra of Morgan Stanley, Jason Draho of UBS, and we'll catch up with Samantha Dart of Goldman Sachs. The second hour of Bloomberg Surveillance, just around the corner.
From our studios in New York and San Francisco, our expert hosts have the data and analysis about the companies you know and the startups to watch, plus the interviews you don't want to miss. Watch Caroline Hyde and Ed Ludlow on Bloomberg Technology, the only daily business show dedicated to tech, right in the middle of the trading action, every weekday, only on Bloomberg Television. Context changes everything.
Will be easy, but at least there's a theory of change.
The countdown is on. Everything you need to get the edge at the end of the market day.
Big tech earnings kick off later this afternoon.
Gilead is coming out right now. We have Take-Two numbers.
Back to the markets, right? Our bread and butter. NVIDIA is one of the best stories in the tech space. That actually matters a whole lot more.
It might shock some of your viewers.
You're watching The Close.
Get ahead of tomorrow's trading with The Close. Weekdays on Bloomberg. Context changes everything.
Always on the heartbeat of the tech
spread across global markets.
The real-time data aspect is going to be important.
We're going to bring you expert analysis on that. Sure. Don't miss Bloomberg's interview with the
It's the world's second largest economy with a growing influence in global affairs. But geopolitical uncertainties, deflationary pressures, and questions about foreign investment linger. Bloomberg, the China Show, brings you the unmatched expertise you need to keep track of breaking news, in-depth market analysis, and the most influential newsmakers in and around China. Bloomberg, the China Show. Weekdays around the world, right here on Bloomberg. Context changes everything.
There has to be a real rethinking by the new administration of how do you want to interact with the world.
Tariffs are probably going to hit both consumers and corporations.
The mandate is to move fast, and that means more volatility.
The folks that argue that tariffs are just absolutely negative and inflation causing, they're playing checkers.
The math is very clearly easy. Politics and implementation is what is difficult for 2025.
This is Bloomberg Surveillance with Jonathan Ferro, Lisa Abramowitz, and Anne-Marie Hordern.
I don't know about you, but over the last few weeks, struggling to keep track of what day it is. It is Thursday from New York. The second hour of Bloomberg Surveillance starts right now. It's been a blur since the election. Equities right now on the S&P 500 just about positive. On the Nasdaq 100 down by only 0.1%. The focus on one stock, of course, this morning after the closing bell yesterday. Nvidia came out with earnings. The forecast, can we use the word tepid? I mean, maybe just a little bit relative to the biggest expectations out there. As the session grows older, this stock recovers even more. Lisa, we're down by 1.7% in early trading.
Let's put some numbers on tepid. The tepid forecast was for fourth quarter sales of about $37.5 billion. That was tepid compared to the average analyst estimate of $37.1 billion. Oh, wait a second. It was more than that, but it wasn't the $41 billion. It was at the highest end of those estimates. And I guess people are trying to figure out, can we start making these grand assumptions that they're at the end of their expansionary phase, or are we being a little bit picky and maybe just a little bit having indigestion after a 200% gain so far this year?
Then the attention starts to turn to the data. In about 88 minutes' time, we get jobless claims in America. The estimate in our survey, pretty decent, robust stuff, 220. 220 is the estimate in our survey, 217 was the previous read. We heard from Aditya Bharve of Bank of America about 20 minutes ago. He made the point that he's expecting fewer rate cuts in 2025 than he had previously anticipated because the data was better than expected. It wasn't about the outlook and policy changes. It was because the data over the last few months has surprised to the upside.
That's exactly where I was going to go. Aditya Bharve, I think, put a bow on this very well, that essentially there's already been a transformation in markets before Trump won, and you saw that in the yield curve. You saw that with yields picking up. He said that it was probably a mistake for the Fed to cut by 50 basis points. Whether you can attribute it to that or not, the economic surprise index has been inflected higher to the highest levels since around April. As you see, better than expected jobs, better than expected production, as well as this idea that maybe inflation's a little bit stickier than people thought.
I think we're all hoping, though, that we can get some clarity on the individuals in charge of the policy. So let's go through the names. You know them well by this point. Besson, Warsh, Rowan, Haggerty. That's the horse race at the moment. Who's in the lead?
Well, what we know is that the president is very picky right now when it comes to this. And our colleagues and myself last night reporting, we still do not know a name. I would say potentially I would lean into Kevin Warsh and Scott Besson, because we had reported that people around the president thought that those two could be paired very well in terms of maybe Fed and then the National Economic Director. And then in 2026, they both can move on to other jobs, going to from Treasury to Fed for Warsh to NEC to Treasury for Besson. There's a lot of 3D chess going on in Mar-a-Lago, but what we know is that the president has yet to find his perfect treasury pick.
Either way, it makes great TV, and I think a lot of people are very excited to see how the horse race continues. There is this overlying reason why people are so focused on it, other than just the drama. It's the idea that it really will telegraph the sequencing of some of the policies and how they're going to be put in place, whether we get tariffs first, how significant they will be, and whether they actually are being used as negotiating tools rather than an end in and of themselves. And that, I think, is what people are looking for in this pick.
What's prime time for TV? Weeknights, Thursday night? Feels like a Thursday night announcement, right? Doesn't that make sense going into Friday?
I don't know. What is it? Is it prime time or prime TikTok? Prime Instagram?
The president-elect is an executive producer at heart.
100%.
Feels like a Thursday night, Sunday morning kind of decision, no?
Yeah, I think, well, if it's Thursday night, I think you would want it for Friday morning shows to talk about markets opening up, going into the weekend. Maybe if he wants the Sunday shows to talk about it, he drops it just before Sunday morning, kind of, you know, rejigs their guest lineup. Let's see. But you're right. Oh my God. He could be producing this all.
Primo's laughing. This is all about casting.
I know it is.
Selecting people from central casting.
Who's handsome.
Yeah. That is a factor. No one denies that.
No one denies that. But, you know, honestly, it's a good marketing tool, and essentially it makes people pay attention, and maybe that's the new political regime that we're in.
It's truly gripping stuff, that's for sure. Here's the lineup this hour. Coming up on the program, we'll catch up with Gagi Chowdhury of BlackRock as NVIDIA fails to meet some very lofty expectations. We'll speak to Monica Guerra of Morgan Stanley as Trump's Treasury pick remains in flux. And we'll catch up with Samantha Dunn of Goldman Sachs on why gold is heading back to 3K. We begin this hour with stocks little changed as NVIDIA recovers after failing to deliver on very, very lofty expectations. Gagi Chowdhury of BlackRock saying this: Mag 7's earnings premium is forecasted to compress in quarters ahead. The gap is set to narrow, a catalyst that we think can further the broadening out trade in 2025. This underscores our preference for a sector-neutral approach to quality rather than tilting more deeply towards tech. Gagi joins us now for more. Gagi, good morning.
Good morning. Great to be here.
Just explain to us, and good to see you, what you mean by broadening out. Is that domestically here in the United States? Does it include international? How are you thinking about that process?
Absolutely. So we're definitely thinking about that very much in the U.S. I think over the next few months, what we're going to see is continued outperformance of U.S. equities over the rest of the world. Within that, one of the things that we've been focusing on, especially over the last month or so, couple of months, is just seeing this earnings growth coming through, not just in tech. So it's certainly not away from tech, but broadening out besides just tech. So thinking about areas like financials, which obviously this year or this quarter have had a close to 10% earnings growth, earnings surprise. Looking at things such as broader, looking at very specific value sectors, which again are closing the gap to growth. So I think that's the trade there. Don't move away from tech, but consider other parts, especially of value, of large cap value specifically, that we think can have its moment for the next couple of months.
Without a doubt, financials are in focus. So let's sit on that sector just for a little bit more. There seems to be some exuberance. This idea that the incoming administration can unleash this huge burst of capital markets activity. Is that how you're thinking about it? Is this unexpected policy changes, or is it something else?
No, I think it's something else. And we were talking about financials. If you look back to our fall investment outlook, we were talking about IAI and broad BLCV as two of the tickers to play that financials trade, even from September, where we obviously didn't have an idea of what the regulation or the deregulation would look like. It was much about the expected earnings growth coming back, M&A activity coming back, maybe a little bit of steepening of the yield curve, which we certainly haven't gotten so far, but if that does arise, that could be better for banks as well. And of course, I will say that now there might be a little bit more tailwind from expectations of deregulation, but that alone does not make the trade. You have to have the earnings growth, which we're beginning to see, and we're beginning to talk about that all the way from fall.
We are seeing the earnings growth in financials. You point to another area that hasn't been as loved that you like, which is small caps, because of some of these dynamics. And what I find fascinating is there was a time when the yield curve steepened that was bad for small caps. And when you saw the long end of the yield curve go up, that also was negative because these are the more leveraged companies that weren't necessarily profitable. Why is this time different, given that people still expect yields to remain high?
Yeah, actually, we're very focused on large caps. We're telling investors probably move away from small caps a little bit. I think small caps have had a few periods of outperformance. It's very hard to see that sustain. We've certainly seen the flows into IWM, but we don't think it's going to be a lasting and a sustained rally. Exactly to your point, Lisa, it's hard to yet see the profitability come through, where much of the index, much of the small cap names are still suffering from pretty high yields. I mean, yes, yields have begun to come down. The Fed has lowered rates, but if you look at what's happened since the Fed has moved rates, long end rates are higher. So small caps are not able to benefit from rates coming down. And as of right now, we think any rally in small caps can be short-lived, and investors are and have been playing that via upside and call options and IWM, as well as, focusing on ETFs, which you can sort of get in and out nimbly with, but I don't think it's a sustained rally.
And that's one reason why I think there is some skepticism. But at the same time, when you start looking at active management, which I know you're a proponent of, how much are you actually looking at companies that get most of their revenues from the United States and that might not be as exposed to tariff regimes and some of the other policies that could come down the pike?
That's exactly right. And that's obviously something that we've been focusing on more recently with respect to some of the active managers that are focusing on U.S. policies and where can we, especially whether it pertains to manufacturing, focusing on friendshoring and reshoring, whether it also looks at tech independence as a theme. Obviously very top of mind, especially given some of the news from last night. But all of that is pointing to my opening comment that U.S. first and U.S. outperformance, or the U.S. exceptionalism, will be with us for some time, and we're certainly telling investors to step out of cash into U.S. equities, keeping a focus on large cap and quality with that.
We already see the markets, though, pricing in a lot of Trump policies. So when they actually come down the pipe in 2025, potentially, is that a sell moment, or do you want to get more invested?
One of the things that I was just talking to a client about is this isn't just about the election. So I think if we look back coming into sort of the second half of this year, we had three things going for us. One was much stronger than expected GDP. Right? So getting that 2.8%, expectations of a high twos based on at least the GDP Now forecast. So that was one. You had this strong growth backdrop. On top of that, earnings, the corporate fundamentals continued to be very strong, and if anything, surprised to the upside. And then the last factor was that the Fed has, again, begun easing. They have told us that they still believe we're in restrictive territory, which means that they're poised to cut more. All of that is actually very good for risk assets. So this isn't just about the elections. This isn't about the GOP sweep. It's very much about the fundamentals being a very strong underpinning of this risk rally we've seen.
But Powell also opened the door to maybe pausing in December, or at least the market has interpreted as such. So how do you think about the Fed for 2025?
Yeah, I think that's a really important point. I think they did open the door, I would say, to not being in a rush, not being in a hurry, to use his terms. I don't know if that necessarily applies to the December meeting. I would like to see them conduct another 25 basis points of easing. And then next year, I think it depends on how sticky inflation continues to be. Lisa, you made that point around inflation. We saw another 0.3 in core CPI. I don't think that sits well. If we don't see that deceleration come through in OER and broader services inflation, I think that allows the Fed to be a little bit slower in their approach. But I do think front end of fixed income and locking in yields, you've got this incredible opportunity to own securitized assets, to own high yield at these all-in levels of 6.5%, 7%, and the Fed has allowed that to happen or given us this amazing opportunity. I think that makes sense for investors.
To wrap it together, there's this question Mohamed El-Erian really crystallized, which is the economy in the U.S. he sees as bigger but not hotter. This idea that it could grow and that you could see that investment, the Industrial Revolution, without necessarily an explosion of inflation. Do you see it in that way?
I think so. Based on the data that we have at hand right now, we think that the U.S. economy, again, given our expectations, think back to 12 months ago. Many of us thought that we could have gotten the recessionary outcome, right? Yep. Not only did we not have that, but we had 7 straight quarters of above-trend growth. On top of that, you have a little bit of deregulation, you have a little bit of fiscal policy, and yes, some concern around tariffs, and maybe net-net, you end up having growth with still above potential at a time when interest rates are normalizing and corporates are strong.
I was going back over your last appearance back in September. Don't worry, nothing to be nervous about. I often do that. And I was going back to September and I was thinking we were having a discussion about the start of a rate cutting cycle. And here we are a few months later talking about the end of one in December. How quickly this cycle keeps moving one way and the other over the last 12 months.
No landing, hard landing, soft landing, no landing, hard landing, soft landing. I mean, basically, we've been on this repeat. It does seem like an increasing number of people are saying their views for stickier inflation now doesn't have to do necessarily with Donald Trump, but just that the data has been better and that maybe this is a more resilient economy.
You know what stands out to me in Outlook season so far? And I've read many. I know you all have. This is what stands out for me. If you look for the forecast for bond yields in 2025, I can't find a single person that thinks we're going to 5%. In fact, the top end that I see was from SocGen, and I haven't read them all just yet, so if you know of one, point it out to me. But the biggest I've seen is 450 over at SocGen, and they think that's the upper end of the range.
I have not seen one person raise a specter of a rate hike. I have not seen one person raise a specter of real acceleration in inflation. A number of people keep pointing out the tariffs tend to be disinflationary, even outright deflationary, when in practice in prior uses. Fascinating if you are a contrarian to look at that.
Gaki, good to see you.
Good
Great
to
to
be
catch
here.
up. Thank you. Gaki Chowdhury there of BlackRock. Let's get you an update on stories elsewhere with some breaking news with your Bloomberg Brief. Here's Danny Berger. Hey, Danny.
Hey, John. We begin with that breaking news. The International Criminal Court has issued an arrest warrant for Israeli Prime Minister Benjamin Netanyahu and former Defense Minister Yoav Gallant. The ICC accused the two of crimes against humanity and war crimes. The ICC unanimously rejected Israel's appeal. That warrant means now that the ICC's 124 member states would be obliged to arrest Netanyahu and Gallant if they were to enter their territory. Netanyahu has previously called the ICC's application for arrest warrants absurd and false. Ukraine's Air Force Command says that Russia launched an intercontinental ballistic missile at the Ukrainian city of Dnipro. The strike, if confirmed, would be the first use of an ICBM in combat since its development during the Cold War. Ukraine claims the missile traveled over 600 miles and damaged an industrial facility in the city. The development also follows an earlier report of Ukraine firing UK-supplied long-range missiles at Russia for the first time. Bank of Japan Governor Ueda hinted that the central bank might discuss raising interest rates at its next December meeting. Around half of economists predicted a rate hike in the country in 4 weeks. Ueda reiterated that the bank will watch the impact of foreign exchange rates on inflation and the economy. That's your Bloomberg Brief. John.
Danny, thank you. Up next on the program, the search for Treasury continues.
I want to see exactly who's in that role because the tax policies, the debt limit all come back. They need to have a conversation with Capitol Hill. And we need to see exactly how that person has a relationship with the Federal Reserve.
We'll catch up with Monica Guerra of Morgan Stanley and get you the latest reporting from Anne-Marie in just a moment. From New York, good morning.
Bloomberg covers the world with unmatched reach and resources. From more than 120 countries, the moment news breaks, 24 hours a day. Bloomberg, context changes everything.
Asia is at the forefront of some of the world's biggest stories. I'm Sherrian in Tokyo.
And I'm Heidi Stroud-Watts here in Sydney, where the trading day begins. We're here in the center of all the action to get you set up with the numbers, news, and knowledge you need for the day ahead.
The demand is indeed recovering. We've been waiting for this moment.
The opportunity of a century.
Join us on Bloomberg The Asia Trade. Weekdays only on Bloomberg TV. Context changes everything.
there is this real momentum from Wall Street. We are basically deep in the European earnings season.
Take a look at how we're faring when it comes to Asian markets.
I tell you, check out NVIDIA. That move's getting bought. We're down now by only 0.7% on that stock, and equity futures starting to drift higher as well. On the S&P 500 up by 0.33%. Under surveillance this morning, the search for Treasury continues.
I want to see exactly who's in that role because the tax policies, the debt limit all come back. They need to have a conversation with Capitol Hill, and we need to see exactly how that person has a relationship with the Federal Reserve. It's going to be a cabinet that was probably somewhat similar to the first administration, where there was a team of rivals.
So here's the latest this morning. Donald Trump has yet to solidify his pick for Treasury Secretary. The president-elect holding interviews at Mar-a-Lago with top contenders including hedge fund executive Scott Bessent, Apollo's Mark Rowan, and former Federal Reserve Governor Kevin Warsh. Senator Bill Hagerty of Tennessee remaining a dark horse candidate for the job. Joining us around the table, Monica Guerra of Morgan Stanley. Monica, welcome to the program.
Yeah, thanks for having me.
The to-do list for whoever this person is so long in 2025. Have you established any underlying assumptions on what the sequencing will look like, what the emphasis will be, how long the timeline is? How are you thinking about those things?
When we're thinking about just policy generally, right, it is about the magnitude and pacing. So, for example, if there are policies that drag on the economy, right, on markets, that could essentially be exacerbated if it's then followed by inflationary policies. So we're essentially going to be tracking that rather closely, especially as it relates to some of these picks.
When it comes to these picks, I mean, we'll have to wait for that, right? It's really narrowing down, I think, to 3 out of the 4. But what is going to be the first job of this individual? Is it going to be maybe pushing back on some of Trump's impulses when it comes to broad tariffs, or is it going to be going down to the Hill and trying to get that extension of TCJA?
So what's going to be interesting is that Congress, the way that it's structured, is going to be really battling out over these details. So even though we have a unified government, the thin margins in the House essentially mean that the negotiating around the tax agenda is going to be critical. And so the next Treasury Secretary is going to be a part of that, equation as far as figuring out what is the point where essentially the debt and deficit becomes untenable. So that number is what they're going to have to suss out through their initial conversations.
With such slim majorities that the Republicans are going to hold, do they potentially maybe get Democrats to vote for this if they include things like an expansion of SALT or an expansion of the child tax credit? You're laughing, so I think that's a no.
Yeah, I say no, right? That they have a majority. Even though it's a slim majority, they have a majority. And it's just going to be about the party coming together on what those priorities are. So maybe we actually don't see every single thing in TCJA get extended. Maybe it's you have an argument over how low do we cut corporate taxes. And so it's going to be those details that we see essentially get fleshed out in those first 100 days.
When you look at the makeup of Congress, do you see individuals that maybe will push back and say, we have to get our fiscal house in order?
Yes, I mean, you see that initially with the, a selection of John Thune, right, as majority leader in the Senate. So the House side, you have Johnson, who is still trying to negotiate and get business done. And then in the Senate, you have Thune, who's old guard, if you think, right? He's essentially one of the last man standing, right, of that old tradition. And so we do think that there is, I think, pressure from the top to move quickly to try to get these negotiations done as they head through 2025.
Based on who has been already selected for different cabinet positions, do we have a sense of what the priorities are and what the order they will be rolled out in by the Trump administration?
I mean, I think it's pretty clear that the immigration piece is going to be one of the first sort of day one issues that has, essentially is under the purview, right, of the executive branch. I think that there are, legal frameworks that come into play that could slow down maybe the pace of their action, and that we get a less aggressive approach than initially, considered. And then deregulation is going to be on the agenda from an executive branch perspective. And so that, does give us, again, that pro-growth policy piece. So our view is that even though there is this potential, the way that we've been thinking about immigration, tariffs, deregulation, that they're in these big magnitudes, that the reality is actually going to be much more tempered and that you're going to get something that is more tolerable to markets and the economy over the long run.
So just sticking with immigration, do we have a sense of what it will look like in practice? Because for billions of people to actually be deported, it would take actually a budgeting of $1 billion, that's according to some estimates, to actually get the infrastructure in place to do that. Do we have a sense of what could actually get done and how that would affect the population? And the reason why I ask is because from an economic perspective, this has actually been a big question mark.
Yeah, and you citing 1 billion people is exactly what I'm talking about as far as large magnitudes that are out there. I've heard everything from 1 billion down to, 400,000. And so if you're looking at a more realistic 400,000, because annually you get about 300,000 folks that are deported through the legal system. So is that 400,000 in addition, or is that ultimately on a net basis 100,000 in addition? So it's really, how are they going to be messaging this? And so that's what we're going to be watching. And I think that the actual practicality of it, as far as moving these cases through the court system, is going to be at a much more tempered level.
I don't like to advocate for certain policies, but I think it's a view we probably all share. I hope they do something about legal immigration. The process in this country, believe me, I've gone through it, is so difficult. And if I wasn't as fortunate to have the attorneys that we have access to at a company like Bloomberg, I would find it even harder. I don't think I'd be able to do it. It's that hard.
When I've talked to tech executives, they say we need the H-1B visa to come through. When I talk to other executives, same thing. And at a certain point, you have to wonder, this is an administration that has recently sounded more amenable to that. Will they move that in parallel to some of these other immigration policies that they're rolling?
Well, on the campaign trail, Trump said the foreign students who are graduating from top colleges, especially things like science, math, and they get a degree,
staple a green card to
they
them.
should get a green card along with it.
Yeah, saw that comment on the campaign trail a few times. Monica, it's good to see you. Appreciate your time. Thanks for being with us. Monica Guerra there of Morgan Stanley. The race for the next Treasury Secretary. This is what's important. Framing this almost perfectly, Marko Kolanovic, remember him, formerly of JP Morgan? This is what he had to say. The issue in selecting Treasury Secretary is not who can enact changes, but who can best manage the market response, the volatility that could undermine those changes. I think that is so important. It's not about who can push the policy. It's about who can deal with the consequences of it, given the policy shift we might see over the next year.
Which takes a lot of massaging to be able to communicate it and to make it sound amenable on a day-to-day basis when some of these policies are inherently volatile, and we've seen some pretty volatile reactions in the past.
Which is why you need a real market technician in a moment like this one. Which is why I'm encouraged to see names like Besson and Rowan doing the rounds.
Are you about to make an endorsement?
Of a particular candidate?
Yeah, that's, I thought that's where you're going to go.
I've said what I think about the list of those 4 names.
Are you going to order it?
Are very, very strong names.
Let's see your lid.
That's all I'm going to say.
Okay.
Okay. Up next, Jason Draha of UBS on the outlook for 2025 from New York. This is Bloomberg.
countdown to the market open as we bring you the first trades across Europe.
We'll debate the most important stories and what will drive the big investment decisions throughout the morning. I'm Guy Johnson.
I'm Kriti Gupta.
And I'm Anna Edwards. Join us every weekday morning for the opening trade, live at 7 a.m. here in London.
Only on Bloomberg. Context changes everything.
As we spend some time here on the broader presidential race,
Let's focus in on European politics.
Makes you wonder how politics might play out.
U.S. jobs numbers are released. Bloomberg has the report under surveillance with crucial data and expert analysis at terminal speed. Nobody covers jobs day like Bloomberg.
Jumpstart your trading day on Bloomberg Open Interest.
2 hours of single stock stories that are driving the opening bell action.
We'll take you to Wall Street, Main Street, the C-suite, and beyond.
These are companies that are growing their market.
The great companies in the U.S. are the companies hitting the cutting edge. That's a different story.
Get the inside track on what's buzzing in markets.
With the players who are shaping the narrative.
If you have bad earnings reports, you're going to get punished.
They're not buying what the industry is selling. Join us on Bloomberg Open Interest every trading day, only on Bloomberg.
2 hours away from the opening bell in New York City, 60 minutes away from some jobless claims in America. Equity futures right now positive by, let's call it 0.25%, recovering on the Nasdaq 100. We'll get to the why in just a moment. The Nasdaq is up by 0.2%. The small caps up by 0.6. With 2 hours until your cash open with your morning movers, here's Manus Cranny. Good morning, Manus.
Jonathan, good morning. Maybe we've all become a little bit complacent expecting these drop the mic moments from NVIDIA. This stock was down 5% at one juncture yesterday evening. We've clawed all our way back. The pre-market this morning since we went on air. What is our complacency? This is a company that delivered a revenue growth of 94%. How does it extend that? The margins. You're complaining about a 73% margin level. That will get back to 75% next year. The demand for Blackwell is staggering, according to them. We caught up with Frank Lee a little bit earlier on from HSBC. He's one of the few that's actually cut his price target from 200 to 190. He still has a buy. The silver lining is the ramp up in Blackwell. So we have traveled all the way back up, and that is giving you a little bit of heft to the overall index. By the way, the dominance, it's sustained dominance with those four hyperscalers has gone from 70% of the revenue to 50%. Deere, don't forget, President-elect warned 200% tariffs to come on anything you sell into the United States of America. The bottom line is this company has managed to eke out a small gain despite the guidance that they gave to the market this morning. They're going to make 5 to 5.83 billion. That is a bit lighter than the market had anticipated. Maybe some of the bad news is already in there on the possibility, the risk from tariffs. Of course, the rhetoric can be sometimes more aggressive than the actual fact. We know that. Let's roll it over and finish off with Snowflake. How do you collate all your data, put it all in the one place, all at the one time? That's pretty much what Snowflake does. The 542 customers spending over $1 million each, and the revenue, it's the ramp way to the cloud, excuse the pun. $906 million to $911 million. This is a relief, I would say. Piper Sanders said investors were frigid going into this numbers, but this is about stabilizing in demand. Jonathan, good morning.
Manus, good morning to you, sir. Looking forward to catching up with you again in about 1 hour from now. Manus Cranny there. Under surveillance this morning, NVIDIA revenue continues to surge, but it's not enough for markets. The AI giant failing to live up to some lofty revenue expectations, but assuring investors its advanced Blackwell chips are still on track to ship this quarter. We were talking to analysts yesterday about what to look for. Look for how the market responds to the numbers. Initially down by 4 to 5%. Lisa, it got bought. We're down by only 0.8% this morning.
There wasn't that much to dislike. I mean, doubling revenue in terms of fourth quarter expectations, talking about just the incredible rise that you've seen in adoption and the fact that demand is far outstripping supply for the Blackwell chips. You have to think people are trying to nitpick about the consolidation of the hyperscalers as purchasers, but at the same time, they're minting money, and it's not clear that they're going to stop minting money, and I think that that is the response you're seeing.
You look at me, but this is, you're trying at the margins, as you say, trying to find reasons to not like this. I love this stat. They've only missed analyst estimates on a quarterly level once in the past 5 years. The bar is just too high for this company. But Dan Ives, Bloomberg Intelligence, got it right. Maybe not exactly. It's not green yet, but we're on our way to the stock being green again.
68 buys, 7 holds, only 1 sell now. Just 1 sell.
Who?
I'm not going to call them out, but just 1 sell. Elsewhere, the Port of Los Angeles moving record levels of imports last month as businesses prepare for heavy tariffs under a second Trump administration. The executive director, a good friend of this program, Gene Soroka, saying 905,000 containers passed through the country's busiest port in October.
And this is supposed to be actually more of a quiet time for ports. You already see companies build up for the holiday. This is about going into next year, and potentially it's a double whammy for these ports and these companies. And they want to build up inventory. Why? Because you're really unclear about how far President-elect Trump is going to go when it comes to things like tariffs. Then January 15th, that's the new date for the port workers and this strike. Do they go on strike? Do we potentially see port workers on the eastern seaboard saying, we're not working, and then we replay this all over again?
It's so hard to run a business in this environment, and we saw evidence of that. An inventory disaster over at Target just yesterday, with that stock cratering in yesterday's trading.
That's exactly where I was going to go. Just shows the hazards of stockpiling ahead of potential tariffs. And I wonder if that hazard is more in certain industries, which is the reason why people are looking at retailers in particular that have really struggled through fickle taste and the pandemic and stockpiling disasters after stockpiling disaster, and investors are running out of patience.
That's the danger in the sector for the next few months. Some inventory landmines for a couple of names, not for the whole industry, but just some select names, and we saw that with Target yesterday. We didn't see it with TJX, and of course we had decent numbers from Walmart as well. I want to finish on this story. Elon Musk and Vivek Ramaswamy looking to force federal workers back to the office. The pair leading Trump's new Department of Government Efficiency, or DOGE, say the move will lead to a wave of terminations, writing in the Wall Street Journal, if federal employees don't want to show up, American taxpayers shouldn't pay them for the COVID-era privilege of staying home.
So I will say this might actually be a welcomed opinion piece for D.C. Mayor Bowser, who's asked President Biden to bring federal workers back because you have less of a local, robust economy when it comes to restaurants. You also have office vacancy rates that have been an issue in Washington, D.C. So this actually might be welcomed in Washington, D.C., but a lot of federal employees, actually the majority, work outside D.C., and maybe that's potentially going to have a little bit of a fight with the incoming administration.
The majority of federal employees actually go to work every day, and I think that that's an important kind of gut check, because more than half already work in person because they're food safety inspectors and healthcare workers that have to physically be there. Of the rest, even those who do work remotely some of the time, an average of 61% of their hours are in the workplace. They still are going to the office. My question is, number one, do you get the attrition you're looking for? Is this their sort of big idea to try to cut some staff?
Without a doubt.
Okay, but number two, do you get the attrition that you want? Because at a certain point, you have to wonder, is there a coherent look at which agencies have which people that are actually important for the functioning of government?
It's a very important point, and I guess we'll find out, because we're going to see this experiment play out in real time.
Yes, we will.
Over the next 12 months, potentially. Looking ahead to the next 12 months, UBS expecting slowing but solid growth in the United States. The team writed the following. Our base case for 2025 is benign growth in the US, still near or above 2%, but moderating from the pace this year. We expect the Fed to cut rates by 25 basis points in December and another 100 in 2025. Jason Draho of UBS joins us now for more. Jason, good morning.
Good morning.
Got to start with December before we get to 2025. Yeah. Some people believe that the communication from the Federal Reserve is starting to change. It's shifted over the last few weeks, and it might be consistent with the pause in December, reinforced by the incoming data. How do you see things?
I think there's still going to be data dependent. Let's see what the November data with inflation and jobs play out. It's still going to be noisy because the after effects of the October data being distorted. A lot of focus on Powell's comments a week ago, like, we're very patient, but it was very consistent with what he said at the FOMC. So I think there's a little bit of maybe reading too much into the shifting narrative or looking for breadcrumbs of what they might do. I think my inclination is they would still want to cut unless the data comes in really hot in some way.
Let's set some thresholds. Here's the calendar. December 6th payrolls, 11th CPI. Let's start with payrolls. I'm looking at the estimates on the terminal. There aren't many right now. I can pick out one from Brett Ryan over at Deutsche Bank, 175. What's really strong for November, given the bounce back we're all looking for? What's strong? What gets them to back away from a rate cut?
So probably something over 200,000 plus the prior months are revised higher. So October ends up seeing not like 11,000. It ends up being something in the neighborhood of 100,000 plus. I mean, that seems unlikely, but something along the lines of what we saw when we got the revisions, for the September numbers, and the summer numbers were revised higher. So something pretty significant there. But I think that's probably not the labor market that's going to cause them to pause. It's more if core inflation, for example, ticks up on the high side. And then you're looking at core PCE, by the time we get in December, is getting close to 3%. I think that's when they start to get iffy. As long as it's staying below 3%, I think they still move forward.
When you extend out, there's a real question about what the highs and the potential lows are for, say, 10-year yields. And we were talking earlier how very few people are calling for 5% or even higher 10-year yields, yet you say that the most underpriced market scenario is actually the opposite. It's continued disinflation, and this idea that you could see yields just continue to drift lower with Fed that keeps cutting rates. Why do you think that is the more underpriced scenario?
Well, I think it's a situation where investors are looking at what are the policy implications of the Trump administration. You're talking about potential tariffs, maybe high tariffs, worried about tax cuts that could be stimulative. All that could be inflationary. And so I think people are focused on the upside tail risk for inflation, not that perhaps they're actually surprised by not doing significant fiscal expansion. Perhaps tariffs aren't that significant. Inflation continues to go lower. If that happens, the economy cools, the Fed keeps cutting, rates could go lower. So I think it's just more of where investor focus is, much more on the risk of going upside versus things could actually be okay. And that might just be reasonable hedging scenarios. But I think as a result, there's just, I think an under amount of confidence in things could actually be okay on the inflation and rate front.
So there are a lot of implications in that for risk assets. If you have cooling growth, that's kind of the opposite of what a lot of people are pricing in on the equity side of things, on the credit side of things. Are you less bullish on those sides while getting more bullish, say, on bonds?
I would say moderating, not cooling, and these are semantics, but going from 2.6% growth to say 2.2, 2.3, something that's still again around the 2% or a little bit higher. So I think it's a still robust kind of economic environment. To me, if you have that, you have inflation going lower, and you have the Fed cutting rates, that's a benign macro environment. All else equal, that should be good for risk assets.
You say that potentially people are thinking it's too inflationary. It might be less inflationary, some of these policies we might get from Trump. But what about the retaliatory measures we can see from some of these countries, even if the tariffs are not as big as some are expecting?
Well, then you have to think about from the U.S. perspective, how inflationary are tariffs? So the estimates from, say, 2018 was at 0.3%. Now, if the tariffs are bigger this time, then you could be talking about a bigger inflation impact. You'd get probably measured responses by other countries. From an overall inflation perspective, this kind of is for the Fed. If this ends up being a relatively modest tariff shock, the Fed's going to look through that. They're going to think this is a one-off increase in the price level. It's not going to deter them. So as long as the underlying components and sort of drivers of inflation are still disinflationary, I think it lets the Fed keep going. That's why we're sort of still sticking with 25 December and also 100 next year. I mean, obviously it could be less, but I think, the markets are down to only 3 cuts. I think that's a little too extreme at this time.
We hear a lot about tariffs, cutting of taxes, deregulation. What about immigration and this potential for deportations? What can that actually mean for the labor market?
Well, what we know is the past couple of years, the immigration surge has been positive for growth. All is equal. It's probably been positive for wages coming down, inflationary. I think what the administration, or the incoming administration, is like to do is certainly curb legal immigration to some more moderate level. Given that the backlog from an economic perspective, the backlog of people who've immigrated who still haven't worked, I think there's still a positive immigration story into the labor force probably well into next year. You're looking at maybe by 26, where that's going to really start to perhaps impinge. I think it's hard enough to predict next year, let alone 2026. So I think that's a story for down the line, but it's probably not a key driver for the macro outlook, at least for the next 12 months.
In your macro outlook, you go to what we've heard from Ed Yardeni, which is the Roaring 20s, and you say there's a lot of evidence that we're in the Roaring 20s. And I keep wondering how much of some of these year-ahead outlooks actually, how much have they changed from the election that we've gotten in the United States? And people have been pushing back against that. How much of your benign outlook really does hinge on what just happened versus just the momentum that we're seeing play out in economic data that's backward looking?
I'd say if we sat here a month ago, our benign outlook would be the base case. What's changed is, I think, the range of outcomes. So the tails have gotten fatter because just the policy, whether it's extreme on tariffs, larger tax cuts, or perhaps, they don't go as extreme on those measures, and there's actually, benefits on deregulation, things of that sort. So I think the range of outcomes, the tails have gotten fatter. To me, the base case hasn't changed, but because ultimately, again, we don't think it's going to be the most extreme situations on tariffs. We think on tax cuts, they extend the existing tax cuts, but the deficit is just too large for anything more significant, stimulus. And the bond market this time, maybe more so than the stock market, could be what incoming President Trump thinks about. But I kind of think of it as a Trump put, but not so much on equities, but on treasuries, because if rates rise too much, the equity market's going to be responsive. So that might be sort of the novel thing this time. I think that's going to be the discipline more so than the equity market.
You talked about the balance of risks around the base case. Can we just finish on that? If you believe the balance of risks around the base case have shifted, and you're in the position of a policymaker who has to manage risk, shouldn't you approach the policy shift as well?
So I think ultimately the right policy is probably, don't make two extremes either way, right? And kind of staying the course, to me, with modest adjustments at the margin is probably the best thing, because then the macro environment sort of plays out with growth is still solid, inflation comes down, the Fed cuts rates. You get rid of the uncertainty that can impact businesses. It's hard to plan when there's uncertainty. So I think not extremes, to me, would be the best outcome for the economy. I think for the markets as well. Like, the markets don't like uncertainty, don't give uncertainty, right?
Jason, it's good to see you. Appreciate your time. Thank you. Jason Draho there of UBS, looking ahead to the next 12 months. We'll do a lot of that over the next few weeks, and then we'll finally get to year-end and we can enjoy some holidays. Let's get you an update on stories elsewhere. With your Bloomberg brief, here's Danny Berger. Hey, Danny.
Hey, John. The White House is seeking to forgive half of a $9 billion loan to Ukraine. According to a letter obtained by Bloomberg News, the Biden administration told Congress that it plans to cancel $4.65 billion of the debt owed. It's another move to support Ukraine before President-elect Trump takes office. While Trump has said his priority is pushing Russia and Ukraine towards peace negotiations, there still is a concern that he might cut off aid as part of that push. Bitcoin is nearing $100,000. It's currently just under $98,000. Optimism on President-elect Trump's crypto support and MicroStrategy's plans to accelerate purchases of the cryptocurrency fueled gains. People familiar also said that Trump's transition team is holding discussions over a White House crypto role. The market itself has gained $900 billion since Trump's election win. Now, speaking of crypto, digital currency entrepreneur Justin Sun bought a piece of conceptual art yesterday at Sotheby's for $6.2 million. The art in question, you can see it there. It is a banana duct taped to a wall. Titled Comedian, it debuted at Art Basel Miami Beach in 2019, where attendees there couldn't figure out if it was a joke or art. Sun said the piece, quote, echoes with our idea of decentralization in the crypto world. Because this is conceptual artwork, it's impossible for you to destroy the artwork itself. That's your brief, John.
Well, you can eat it, and people have done that. And Danny, thank you. And I'm sure you've all got the same question, so I've got an answer from Vogue magazine, tremendous publication, who say this: what happens when the banana goes bad? We all want to know. Apparently, the owner can replace it, according to the artist's instructions. There you go. Okay?
I can't even.
Is another question we've all got.
I actually did an art project in college where I put bananas in a bag and people smushed it, and then I hung it, and I got a bad grade on it.
No comment. No comment to Lisa's bad artwork.
Best not to comment on this one. Up next on the program, go in for gold.
Ultimately, if inflation comes back, gold will be a good place to be. So I would say maybe buy the dip in gold. I still think $3,000 an ounce is kind of the target for next year.
$3K for next year, echoing that call. Goldman Sachs up next.
We invest in, buy, and own the backbone of the global economy. When the water gets delivered to your house, the road you drive on, the pipeline that brings different things to your community, the telecom towers that transmit your phone, the data center, the real estate that you live in. It's what we own and build. So it's really what drives the economy, and you don't often see our name.
Is that a good or a bad thing?
You know, it's just because we're behind the scenes, but it's big with $1 trillion of assets almost. We're behind a lot of the things of the global economy.
So being low-key, do you think it gives you strength?
We just try to be quiet and do our thing, and sometimes it helps and sometimes it doesn't. But I'd say on balance, it's been good for us.
Welcome to the world of decentralized finance.
Massive outperformance from Bitcoin.
Bloomberg's covering all things crypto, the people.
The tectonic shift emanating from Washington.
All we're looking for is clear rules and the ability to build in the United States.
Crypto shouldn't be partisan.
The transactions.
Really a record-breaking moment.
Crypto VC is back.
And the technology.
It's really the beginning of a global on-chain economy.
And if America doesn't embrace it, we're going to be left behind.
Bloomberg Crypto, only on Bloomberg. From the world of politics to the world of business, Joe Matthew and Kaylee Lines deliver news, insight, and analysis live every trading day. Balance of Power live around the world every weekday, only on Bloomberg. Bloomberg loves earnings.
I know it's like your Super Bowl, right?
I can't wait. It's like opening presents in the morning.
All right, it will be exciting.
Nobody covers earnings like Bloomberg.
From New York City, welcome to the program. Equity futures on the S&P 500 recovering as the session grows a little bit older. We're positive by 0.25% on the S&P 500. Under surveillance this morning, going for gold.
In the short run, we think gold could go down to $2,500 an ounce, and part of it is just that those tariffs, the downside risks. We're also seeing interest rates going up in the U.S. These are important elements for gold because gold was pricing in a pretty steep rate cut path. If that doesn't happen, it's going to be choppy for gold for a bit. Ultimately, if inflation comes back, gold will be a good place to be. So I would say maybe buy the dip in gold. We still think $3,000 an ounce is kind of the target for next year.
So here's the latest this morning. Gold catching a bid through this week, rising alongside demand for haven assets as geopolitical risk and policy uncertainty hits markets. Samantha Dutt of Goldman Sachs writing, U.S. policy uncertainty and recent consolidation provide an attractive entry point for our high conviction long gold view. We keep our view at 3,000 for the end of 2025. Samantha joins us now for more. Samantha, good morning.
Good morning.
Before we talk about where we're going, I think we need to talk about where we've been and where we are right now and what's behind it. You've identified a whole host of tailwinds for gold. Central bank buying, fiscal sustainability, trade tensions. Of all of the reasons, what's the dominant factor for you in 2024?
Yeah, it's central bank buying. In fact, it's been the dominant driver of the upward gold move since 22. The moment that Russian financial assets were blocked, then that sparks a lot of concern from a lot of emerging markets and China in particular that, who knows, this might happen to them one day. So central bank buying has stepped up significantly, fivefold from the average that we observed prior to 2022.
Do you see that continuing in 2025? And do you see policy changes in the United States that will just exacerbate some of the trends that we've seen?
So on the EM central bank buying, we definitely see that continuing. When you think about how much reserves they have in gold, it's still very low compared to what DMs hold. So the structural driver is there. But I think on top of that, the other interesting story is that for the longest time, ETFs were not a part of the story. And I think the moment the Fed started cutting, then that's what opens room for ETFs to come in as well. So when you think about physical buying in this market, central bank buying is the primary driver, but now you have on top of that the cyclical support from ETF buying as well. So safe haven is just the cherry on the top, right?
So this is actually a really important point at a time when sometimes when gold goes up, people call it an inflation hedge. Sometimes people call it a haven trade if there's geopolitical risk. Are you saying that that's all just creating a narrative around a fundamental structural story that's playing out with central banks and what they're doing with gold?
Yeah, I think especially the safe haven aspect is very much a part of the risks ahead. There is a lot of policy uncertainty ahead. Clients have been very focused on, will there be a tariff escalation scenario? And that can bring uncertainty, and that's usually what triggers higher positioning and that notion of safe haven buying.
Well, I guess that the reason why I ask it this way is because we're wondering how clean some of the previous haven trades are. We ask that about treasuries, given the fact that people are worried about the deficit. We ask that about oil, given the fact that the supply-demand dynamic has changed, given the renewables. And we ask that about gold, given that there are some other unique benefits. Do you think that gold and oil in particular are still the best hedges for that uncertainty, even more perhaps than other asset classes?
I think even gold more than oil. When we think about inflation, oil is a fantastic hedge when that inflation is coming from a supply disruption, to be sure. But the risks ahead, I think, include more than that. Yes, there is a concern with what's going to happen to Iranian supply. That's fair. But on top of that, tariff escalation risk, or even, as you mentioned earlier, that growth fears. So I think gold offers more reasons for investors to belong right now. And really what I think the dominant driver has been is this structural support from central bank buying. Just like the sheer tons being bought, and we just got the latest data for September, which shows that high rate of buying has continued. So this is really the primary driver, and the safe haven notion, the hedge against inflation, we think goes on top of it. In fact, when we think about the highest risks associated with tariff escalations, with debt fears, we think this can take prices even above our 3,000 forecast for the end of next year. It's not a base case, but it is a risk that we have been highlighting.
Samantha, when you put all these tea leaves together, especially the central bank buying, is this the start of de-dollarization that we could see bleed out, even in a bigger way, in the global financial system?
We don't see it that way. We see it as maybe a rebalancing of the way that financial and monetary authorities hold their reserves. So just being a little bit more diversified.
I was talking about this, we all have over the last few weeks. I still remember something that I think it was Kashkari said of the Minneapolis Fed a number of years ago when he was asked about the deficit and whether the bond market was starting to get concerned. And he pointed to foreign exchange. And he said something like, the dollar's not getting sold. And if the dollar was getting sold, then you'd have that EM dynamic where you were worried about the deficit. It was showing up in bonds and people were backing away from the US dollar. You're not seeing that again, but you are seeing it in gold. It's the dollar depreciating against gold, which I think a lot of people are flagging over the last few months.
Because it's not necessarily that there's another currency that actually is gaining that haven trade. It is that these central banks are buying gold. And that, to me, is a structural change that maybe you can't play in the currency pairs, but you can play when it comes to the precious metal.
Because where else are you going to go? Europe?
Well, but this is my point. I mean, honestly, I do want to go to Europe, but
no,
not
I want to go to Europe too, for the record.
Especially when it's parity.
I've got plans to go to Italy again next year, keep it at 105.
You said, do you want to go to Europe?
Say, you know, I don't have trade recommendations, but I'd love it if euro dollar stayed at 105.
100%. I mean, when you say that, you know, yeah, I would go there. But I mean, what other currency, you know, could you really get your head around?
Samantha, it's good to see you. Appreciate it. We'll let you miss out on that one. You can escape that. Samantha Down of Goldman Sachs on gold. Gold going back to 3K, according to Goldman, and according to BofA as well. Coming up on this program, we'll catch up with the former NEC director, Gary Cohn. Looking forward to that conversation. We'll speak to Dana Peterson of the Conference Board and Christina Campmany of Invesco. From New York, the third hour of Bloomberg Surveillance. Up next.
DraftKings hit a milestone in the second quarter of 2024. For the first time as a public company, it turned a profit.
Is this a new era for DraftKings?
There's an inflection from when you're cash flow negative and you're operating off of equity raises from the past to when you're self-funded and you're cash flow positive and able to control your destiny a lot more.
You've had your first quarters of profitability now. Does that take pressure off? Does it increase pressure?
I think it increases pressure. I mean, once you start making profits, people expect you to make more, and all of a sudden you're valued on a multiple of those profits as opposed to the theoretical what could be. So very important, I think.
When you're cash flow negative, you've sold a vision of what the company should be working on, and you're very focused on working on that and delivering against that. When you've pivoted to profitability, the world of what you can work on is a little bit open, and there's a lot of different ideas, and it requires more focus than ever to make sure that you are prioritizing on the most important things that are going to deliver the most value.
DraftKings' solid standing in a booming sector gives them the luxury to play the long game. They're not under pressure to cut costs.
When you have really strong revenue growth, you don't need that. If you look at where we are today and where we want to be and where we believe we will be, the vast majority of the incremental EBITDA is not coming from any cost reduction. It's coming from increased revenue.
We don't feel like we need to cut costs because we're growing our revenue so much. We want to grow our revenue into our existing cost structure, and there's no need to reduce the cost as long as we're being efficient with what we allow our cost growth to look like.
David Weston, join me for the next generation of Wall Street Week, telling stories of capitalism from business, markets, economics, tech, and climate. Each week, we'll go on the road for a look at what lies behind the headlines of today and what will likely be the headlines tomorrow.
Above all else, it's a mission.
It's done nothing but grow immensely. To me, that's an extraordinary sign.
We can be the change that we want to see.
Watch the all-new Wall Street Week.
More than what you need to know, it's what you need to think about.
European countries need to think, do you want to compete as a small country or do you want to compete as Europe? I don't think they have a choice because the US and China have already started the race. And Europe needs to follow. There isn't a European company in the top 20 largest firms in the world. That is a problem.
But what does it mean for individual countries within Europe?
You can have more control and less growth, or you can have less control and more growth. If countries trust each other more and they build more European champions rather than each country having its own national champion, growth is going to be better, productivity growth is going to be better, the welfare is going to be better. But there is going to be less control at the national level. So right now, each European country wants to have its own telecom company, its own couple of large banks,
Its own bank,
its own large energy companies. And the question is, are you willing to surrender some of this control to European firms, which are going to be more productive, but you are going to have less control at the national level?
From our studios in New York and San Francisco, our expert hosts have the data and analysis about the companies you know and the startups to watch, plus the interviews you don't want to miss. Watch Caroline Hyde and Ed Ludlow on Bloomberg Technology, the only daily business show dedicated to tech, right in the middle of the trading action, every weekday, only on Bloomberg Television. Context changes everything.
We think that the opportunities are mostly in U.S. large cap stocks.
For longer term investors, the debate on NVIDIA is, are they selling razors or razor blades?
As good as this bull market is, any news that sort of disrupts the narrative can cause volatility.
Every time there is like increased pressure on NVIDIA, they can always, scale back and deliver.
NVIDIA is 20 times the size of some of these markets. So that's why it's so critical here to portfolios.
This is Bloomberg Surveillance with Jonathan Farrell, Lisa Abramowitz, and Anne-Marie Hordern.
The third hour of Bloomberg Surveillance starts right now, live from New York City, with equity futures on the S&P 500 recovering higher by 0.25%, a three-day run on the S&P with no losses so far, closing yesterday almost totally unchanged. We're positive on the NASDAQ 100, even with NVIDIA yesterday afternoon, down by 4 to 5% after hours following earnings. That stock recovers in early trading. Check this out right now on NVIDIA. NVIDIA stock at the moment is lower, Lisa, but only by about 1%.
Yeah, at a certain point, you have to wonder what was exactly bad in this forecast. They actually beat the average estimate. They just didn't supersede. And even then, I mean, this is a company that likes to sandbag Wall Street. They like to set estimates really low and then blow them out of the water. And people basically see a pipeline that promises to do the same.
That's 2025 and the year ahead for NVIDIA. Basically, low bar, big beat. That's what people are looking for. In about 30 minutes, we're looking for jobless claims. I'll show you the bar. It's 220. That's the median estimate in our survey. The previous week was 217. This data is really quite decent. As you're anticipating the year ahead, you're thinking about policy changes. We need to talk about the lineup to be the next Treasury Secretary. You know the names by now. Besson, Walsh, Mark Rowan, Senator Bill Hagerty. It's still those four.
It's still those four, and yesterday he was with three of them, and some of these meetings went a little bit late into the evening, and yet he has not come out and decided who he's going to pick. Our story this morning, and alongside reporting with Nancy Cook and Saleha Mohsen, Josh Green, he's looking for his perfect Treasury Secretary. He's very picky about this, and he has yet to decide on one of those names. So now people are speculating potentially, does he go an unorthodox route? There was a list of names he could have chosen from, say, for Attorney General, and he decided to go with someone that was controversial, Matt Gaetz.
Jason Draho just put it really well. The base case hasn't changed for the economic and market outlook for next year. But after the election, the tail has increased. That potentially the extremes of these policies could make the scenario very different one way or another. The reason why the Treasury Secretary is so important is because it'll highlight the risk or not of one of those tails and just how much that could be moderated.
The range of outcomes is like this wide and getting wider and wider by the day. Coming up this hour, we'll catch up with IBM Vice Chair Gary Cohn as markets weigh potential Trump trade policy. Dana Peterson of the Conference Board reacting to jobless claims in about 27 minutes. And Kristina Campmany of Invesco as the Fed tries to buy optionality heading into 2025. We begin this hour with Trump's Treasury pick still very much up in the air. Following meetings with Apollo's Mark Rowan and former Fed Governor Kevin Warsh, investors still waiting for President-elect Donald Trump to make a final decision on the individual who will go into 2025 facing down a huge to-do list. Joining us around the table, the IBM Vice Chair, the former National Economic Council Director, Gary Cohn. Gary, good morning.
Good morning. Thanks for having me.
Good to see you. Thanks for being here. I think we need to take a big step back, in fact, go several years back to 2016, 2017. Just frame for us what you had to face down in 16 going into 17 and how long the to-do list was back then.
So I think we should take even a bigger step back and remember what the environment was. If you go back to the economic environment as we were going through this exact period, we had a environment where we had just barely started to come out of the Fed's zero interest rate policy, quantitative easing, and a decade of Fed articles, will there ever be inflation again? We were just starting to turn that corner. We had come through an Obama 4 years or 8 years of basically saying, you know, there's been a very tough business environment, highly regulated. You know, how do we get business re-engaged? And Trump won this victory. It looks very similar to where we are today, except, you know, Fed funds were 76 basis points back then. They're 4.5% today. National debt was about 20 trillion. We're at $35 trillion right now. So we're in a pretty fundamentally different place. And then as you look where we are today, not only have we a pretty decisively different position in rates and debt, I think the president-elect is walking into an environment with that high interest rate environment where housing prices have gotten really out of touch for most Americans. And there's a real push to try and make housing more affordable. You look at the way Treasury has decided to fund that additional debt. They've been very short-dated on the curve, which I think provides an enormous amount of risk in refunding. And we all worry about refunding of Treasury. So I think we've got to have a real refunding situation where we roll out maturities. You know, I remember talking to the president like 8 years ago about doing a 50-year and a 100-year. I still think we should have done a 50-year and 100-year when rates were low. And then you think about the situation with state and local governments. State and local governments were not in great position 8 years ago. Now think of what's going on with the migrant population, how much money some of these cities and states have spent